Welcome back to the deep dive, where we take these complex, sometimes really dense source materials and, well, we try to turn them into crystal clear knowledge.
And today, we are definitely wrestling with some dense material. We're looking at the architecture that, in a way, provides confidence in our financial markets.
That's right, the COSO Internal Control Integrated Framework.
Mm-hmm. And for anyone joining us, we've got a deep stack of sources here, all focused on the Committee of Sponsoring Organizations of the Treadway Commission, or COS, as everyone calls it.
Yeah, thankfully.
For serious investors, for executives, look, understanding this framework is just non-negotiable. It really is the language of control, of accountability, and of course, risk mitigation.
So our mission today is to decode that structure. We want to analyze how it's evolved, especially with the big 2013 update, and really get into how it's applied in the world's largest companies.
Let's do it.
Okay, so let's start with a really fundamental question. The core problem facing, every single business from a giant multinational to a tech startup is actually pretty simple on the surface.
It sounds simple.
Right. How do you guarantee, with a high degree of confidence, that the financial information you're reporting is materially true?
Mm-hmm. And the other side of that coin, which is maybe even more critical today, is how do you build a fortress strong enough to prevent some catastrophic company-ending fraud?
Exactly.
To really get why the COSO framework is so important, you kind of have to look back. You have to see how inadequate the answers to those questions used to be.
Oh, absolutely. Our sources lay this out so clearly. Early auditing practices were incredibly narrow, just laser focused on routine, easily auditable transactions.
The simple stuff.
This simple stuff. Cash receipts, checking accounts, counting inventory. The whole approach was transactional, not systemic at all. It was like they were meticulously inspecting the leaves on a tree.
Wow.
While completely ignoring the fact that the tree itself was rotting from the inside out. That's a perfect analogy. And the result of that narrow focus was, well, it was inevitable. Decades of these spectacular business failures, accounting scandals, they all revealed these fundamental systemic weaknesses.
And that's when we all realized, okay, controls aren't just about stopping a clerk from stealing petty cash. That's part of it, sure. But they need to address management failures, weaknesses in how information is processed, a systemic lack of oversight.
But here's the bind, right? Let's say a company wanted to improve its whole control ecosystem. There was no standard to go by, no common vocabulary, no measuring stick to judge if their controls were actually effective at a holistic level.
And that void, that complete absence of standardization, is precisely what drove the formation of COSO. It was 1985, and it followed this really intense period where financial fraud and audit failures were just dominating the business news cycle.
So they were established to sponsor the National Commission on Fraudulent Financial Reporting. Most people know it as the Treadway Commission.
Right, and their initial charge was very specific. It was to study and report on the causal factors, the why behind fraudulent financial reporting.
But that mission, it didn't stay narrow for long. It expanded pretty significantly over time. It sort of morphed into this drive to improve the overall quality of financial reporting.
And the cornerstone of that drive became the development of guidance on internal control.
Which brings us right to the centerpiece of our deep dive today. The Internal Control Integrated Framework, first published in 1992 and then, significantly revised in 2013. This is, in essence, the rule book.
It is the rule book for corporate accountability. And our sources, they just hammer this point home again and again for our audience. In the U.S., COSO is really the only game in town for internal controls over financial reporting, or ICFR.
The only game in town. The SEC mandates that public companies have to use a suitable controls criteria for their ICFR assessment. And COSO is it. It's the recognized, accepted standard.
And even for private companies, the AICPA guidance for auditors constantly references COSO components. Now, you might hear about other frameworks internationally.
Like COSO in Canada or the Turnbull Report in the UK?
Exactly. But they just haven't achieved the same ubiquitous adoption as COS. And honestly, conceptually, they owe a huge debt to COSO's integrated model.
So before we dive into the architecture of the framework itself, let's just lock in the definition, because it really sets the stage for everything we're about to discuss.
Okay, so based on the revised framework, internal control is defined as a process affected by the entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives relating to operations, reporting, and compliance.
That is a dense definition, but it tells us three vital things right off the bat. One, it's a process that involves everyone from the board all the way down. It's not just an accounting thing.
Right, it's not just the bean counters.
Two, it's designed to provide reasonable, not absolute assurance. That's a key distinction. And three, it covers three broad areas of objectives: your operations, your reporting, and your compliance with laws. And while COSO covers all three, our focus today, and really the focus for most public company mandates, is squarely on that middle one: reliable financial reporting.
That's where the stakes are highest for investors.
Absolutely.
Okay, so now we get to the core structure. The enduring strength of the COSO framework really lies in its 5 interrelated components.
And what's so fascinating is that these 5 components have stayed conceptually the same since 1992. That's decades of consistency.
It is, and it's a powerful testament to the idea that the framework got the fundamentals of corporate governance right from the very beginning.
And this is where it gets really interesting for managers and investors listening. You just cannot view COSO as a simple, sequential checklist. You can't.
No, if you do that, you've already failed.
Yeah.
It demands this holistic, integrated view. COSO is intentionally an ecosystem where these 5 components, they all relate to and influence one another in this non-linear, almost organic way.
So if you try to enforce, say, control activities, but you don't have a proper control environment, the whole thing just collapses.
It's not a partial failure. It's an integrated collapse.
Yeah.
Exactly.
So how do we visualize this? CSO has been represented in a couple of ways over the years. The original 1992 model was a 3-sided pyramid.
Right, and that was so effective because it visually established the hierarchy. It put the control environment firmly at the base. It implied, everything else rests on that foundation.
And then you have the cube structure, which they kept in the 2013 revision. And that cube is, I think, indispensable for any complex decentralized company.
Oh, for sure. It shows that controls don't just exist for the whole company at once. They can apply specifically at the divisional level or an operating unit or even just a functional level like HR or IT.
So if you're a global company with operations in, 20 different countries, that cube helps you map exactly where you need specific controls, structurally or geographically.
These visual models are just excellent training tools. I love that little historical tidbit in our sources about that pen product that was developed right after SOX came out.
The 5-component pen.
The 5-component pen. You click it, and a new component would be revealed. It sounds kind of trivial now, but it shows you how hard practitioners had to work to just etch these 5 components into the minds of everyone responsible for financial reporting.
I still want one of those pens. But okay, let's move from the visuals to the definitions. We have to start at the bottom. The absolute bedrock, the control environment.
The control environment is all about the culture, the atmosphere, the tone. It provides the overall discipline and structure for the entire organization. This isn't about documents in a binder. It's about behavior.
And it all comes down to the tone at the top.
It's 100% determined by the tone at the top. Senior management has to set an appropriate tone that positively influences the control consciousness, the integrity, and the ethical values of every single person in that company.
So if the control environment is sort of the soul of the organization, how did the 2013 update make sure it wasn't just, corporate window dressing?
They got specific. They expanded this component with 5 principles that must be present and functioning. These are things like demonstrating a commitment to integrity and ethical values, establishing a clear structure, defining authority and responsibility.
And demonstrating a commitment to competence, right? Which means hiring and training people effectively.
Yes, and crucially, enforcing accountability. That's principles 1 through 5.
That emphasis on accountability, principle 5, seems particularly powerful.
It is. It means management and the board have to hold people responsible for their internal control duties. It's not optional. If a manager cuts corners to hit a number and nothing happens, the entire environment just suffers.
The message is sent.
The message is sent. If the control environment is weak, the attitude towards control will be passive or even antagonistic, and that just permeates and undermines the effectiveness of every other component.
Okay, so that culture of accountability leads directly into the second component, risk assessment. Once you have the right attitude, the entity has to actively, scan the horizon for threats.
Right. Threats to its objectives. And as we said, the high-level objective is often fair financial reporting in accordance with GAAP.
So what's the core task of risk assessment?
It's multifaceted. You have to set clear objectives first. Then, identify the risks that threaten those objectives. Then you have to analyze how severe those risks are. And finally, develop ways to manage them.
We often focus on transaction risk, day-to-day stuff. But our sources show that in financial reporting, the really big, tricky risks are often hiding in areas that require management judgment. Estimation.
Oh, absolutely. Think about the estimation risks when you're calculating a complex allowance for uncollectible accounts or reserves for future warranty claims.
Or valuing some complex derivative contract that doesn't trade on an open market.
Exactly. These non-routine risks are where fraud loves to hide and where controls so often fail.
And the revised framework, it really beefed up the specificity here, didn't it?
It did. We now have 4 essential principles in this component. And critically, Principle 8 is directed specifically at assessing fraud risk. This forces management to explicitly consider the potential for fraud, including management override, when they're designing their controls.
And Principle 9, which focuses on identifying and analyzing significant changes. That forces the control system to be dynamic, not static. It has to react to new business conditions or economic shocks.
It has to be a living system.
Okay, so risk assessment is the reconnaissance mission. That reconnaissance leads us directly to component number 3, control activities. If you know the threats, what actions are you actually taking to stop them?
Control activities are the boots on the ground. They're the policies and procedures that get executed every single day or, on a periodic basis.
So day-to-day would be like sales and expense transactions.
Yep. And periodic would be things like month-end accruals, complex journal entries, or consolidations. The explicit goal is to make sure all transactions result in complete, accurate, and timely accounting recognition and valuation.
And the principles here are focused on what?
It's twofold. First, you have to select and develop control activities to mitigate the risks you just identified. That's Principle 10. Second, you have to deploy those controls through clearly defined policies and procedures. That's Principle 12.
So if risk assessment flags a high risk of misstating revenue, the control activities would be things like segregation of duties, multi-level review of sales contracts, reconciliations.
All of that. The specific checks, the balances, the sign-offs that create the audit trail.
Okay, moving outward from there, we get to information and communication. This component feels like the connective tissue.
It is. And that old pyramid visual, it was deliberately shown running up and down the edges to show it's in constant necessary interaction with everything else.
So this is basically the entire accounting and reporting infrastructure, whether it's manual or automated.
That's right. It dictates how people capture and exchange the information they need to manage and control the operations effectively. I mean, if you don't have accurate, timely financial data, you can't have effective governance, you can't assess risk.
And you certainly can't implement the right control activities. It's the classic garbage in, garbage out problem.
Perfectly put. And communication here is multi-directional. You have internal communication between management, internal audit, the board, and you have external communication to shareholders, creditors, regulators.
And there are 3 principles here, P13, 14, and 15, that demand using relevant quality information and communicating effectively both internally and externally.
Right. The entity has to have clear channels to report control deficiencies and strategic information to the right people.
Okay, finally, that brings us to the function that closes the loop and drives continuous improvement. Monitoring.
And monitoring is fundamentally a management responsibility, not the auditors. I want to really stress this point because it's a source of so much confusion.
Say that again.
The independent auditor is explicitly not part of the entity's system of internal control. Management is expected to monitor the entire control process on a regular, ongoing basis to ensure controls are present and functioning as designed.
So the whole point of monitoring is to make the system dynamic. It means you're proactively identifying and correcting problems, hopefully before they become material.
Yes. You're not waiting for the independent audit to come in and find a problem 6 months after you've already released your financial statements. It's a real-time health check on the whole control system.
And this is codified in the last 2 principles. Principle 16 requires conducting ongoing or separate evaluations,
which is often where an internal audit function would fit.
And Principle 17 focuses on evaluating and communicating deficiencies in a timely way within the organization.
And our sources are crystal clear on this. If the monitoring function is absent, or it's poorly designed, or just ineffective, that failure is highly likely to be considered a material weakness all by itself.
That interrelationship is just so key. They're not 5 departments in a company. They are 5 aspects of a single, unified, organic system. You change the control environment.
Yeah.
You inherently change how you do risk assessment, and on it goes.
Okay, so the fact that the 5 components were retained in the 2013 revision was clearly strategic. It kept the core philosophy intact.
It did. But the business landscape between 1992 and 2013, it went through this massive, irreversible change. You have the rise of the internet, global supply chains, incredibly complex regulations. COSO had to evolve.
Right. And the 2013 framework's answer wasn't to throw out the components, but to add a layer of specificity.
Exactly. They introduced 17 principles which they deemed essential elements for an effective system of internal control. This was a critical shift. It was driven by regulators and practitioners who were saying, we need more consistency and less subjective interpretation in how we apply this framework. And if you look at how those 17 principles are distributed, it really shows you where COSO placed its emphasis. 5 for the control environment, 4 for risk assessment, 3 for control activities, 3 for information and communication, and the last 2 for monitoring.
And the guidance is unequivocal. For a system to be deemed effective, all 17 of those essential principles must be present and functioning. No exceptions.
Okay, so let's talk about what we call the historical curse of the framework. This difficulty in trying to force complex, pervasive issues into just one of those 5 component buckets. The 2013 update really had to grapple with this.
It did, especially with technology and fraud. Let's take information technology, or IT. In 1992, IT was, an emerging concern. By 2013, it was the spinal cord of every modern business.
So trying to assign IT cleanly to just one component is basically impossible?
It's futile. IT failures impact the control environment because the board needs accurate, timely data for governance. It's inseparable from information and communication because that's where all the data lives, and it's integral to control activities, with automated controls now being the backbone of transaction processing.
So how did COSO handle that? The pervasive nature of IT forced them to weave computer and network issues into the discussions of 14 of the 17 principles.
14 of 17. And, critically, the framework codified Information Technology General Controls, or ITGC, as its own specific standalone principle, Principle 11.
And what does that principle require?
It requires management to select and develop general controls over technology to support the achievement of objectives. For our executive listeners, this is where things like cyber risk and system availability are formally brought into the financial reporting structure.
So if a company's network goes down, or if their access controls are so weak that anyone can post a journal entry, that is a direct failure in Principle 11.
A direct failure, and one that could easily lead to a material misstatement. Suddenly, addressing cloud computing risks, data integrity, system backups, that all falls directly under the COSO mantle now.
A similar problem comes up with the pervasiveness of fraud risk. Principle 8, which is in risk assessment, specifically mandates assessing management's anti-fraud programs. But fraud risk is inherently multi-component.
Precisely. Fraud risk is so deeply associated with the control environment because the highest risk of fraud often comes from management override.
A leadership decision to just circumvent an otherwise functioning control.
Right. That is a failure of integrity. It's rooted in the environment. And of course, fraud is carried out through failures in control activities. Collusion between an accounts payable clerk and a vendor to bypass disbursement controls.
So the 2013 framework forces management to see fraud risk not just as some compliance item on a checklist, but as a holistic, systemic threat.
And beyond grappling with these pervasive issues, the 2013 revision also codified 2 massive business trends that just fundamentally changed the world since 1992.
The first one is the widespread use of outsourcing.
Huge. Modern business relies so heavily on delegating functions. Payroll, IT hosting, treasury operations, supply chain management. The list goes on and on.
But our sources are so emphatic on this point. Outsourcing does not remove that function from the scope of internal controls over financial reporting.
Not at all. If you outsource your billing, you are still 100% responsible for ensuring the controls over that outsourced billing process are effective. The responsibility doesn't transfer.
That is a tremendous burden. Outsourcing is so common now that it's referenced in the discussions of 12 of the 17 principles.
And the SEC saw this risk coming early. Since 2003, they've required entities that outsource significant functions, especially financial reporting ones, to include a right to audit clause in their service agreements.
And that right to audit clause is key.
It is. It ensures the entity can go in and verify that controls are effective, even if they're happening in some distant outsourced facility. And this reliance on third-party assurance, often through what are called SOC reports, Service Organization Control Reports, has become standard practice.
But the company's management still has to assess the adequacy of those reports and integrate them into their own ICFR framework.
Absolutely. If the SOC report has a failure, the entity's ICFR has a failure. The buck always stops with the reporting company.
Okay, so the second major trend involves a much more sophisticated approach to risk metrics.
Yeah, this is really interesting. Before 2013, risk assessment was mostly focused on two dimensions. Magnitude. How big would the financial loss be, and likelihood, how probable is it?
Pretty straightforward.
The updated guidance significantly enhanced this by adding two new measures: velocity and persistence.
So these concepts, they shift risk assessment from being a static exercise to something much more dynamic.
Exactly. Think of velocity as the speed or the intensity with which a risk event hits you. A massive systems failure or a sudden cyber attack, that has very high velocity.
And persistence is how long it lasts.
It's the duration, the staying power of the event. How long does the damage last and disrupt your operations?
And the guidance uses natural disasters to illustrate this, which I thought was perfect.
It is perfect. Take a major, unlikely event like Hurricane Sandy or Katrina. The likelihood might have been low, but the event strikes with extremely high velocity. The destruction is instantaneous.
And crucially, the persistence is just devastating. Supply chains are disrupted for months. Infrastructure takes years to rebuild.
And the financial reporting consequences, inventory write-downs, insurance claims, operational losses, they last for multiple reporting periods.
So this forces organizations to rebalance their risk effort. You can't just focus on the routine threats anymore. You have to evaluate how your system handles events that are both unlikely and devastating.
And that requires a whole different set of response controls. It's not about daily reconciliations anymore. It's about business continuity and disaster recovery plans. This move towards more sophisticated risk modeling is just essential for any modern executive.
So this shift towards sophisticated, articulated risk assessment brings us right into the practical world of application. For our executive audience, this is where the rubber really meets the road when you're implementing COSO.
And one of the core tenets here is objective-driven design. The framework demands that internal control must be built into an entity's processes, not just bolted on as an afterthought.
You can't just sprinkle some controls on top at the end.
No, it has to be integrated. Management has to follow this rigorous four-step sequence. First, establish clear business objectives, operations, reporting, compliance. Second, identify all the risks, internal and external, that threaten those objectives.
Third, determine how to manage those risks. And it's important to remember putting in an internal control is only one of your options.
That's a great point. You could also just accept the risk, or avoid it, or share it through insurance, for instance.
And the final step is establishing controls that are designed and implemented specifically to meet those stated risks.
Right. If your objective is reliable revenue recognition, and the risk is premature recognition, the control has to be designed to prevent that specific risk. If a company fails to do that comprehensive objective setting and risk identification upfront,
it's highly likely they have a material weakness in the risk assessment component itself.
That's it. And this leads us to a really crucial efficiency distinction that caused, immense headaches during the early days of Sarbanes-Oxley compliance.
The widespread misunderstanding between controls versus processes.
Yes. This is such a vital efficiency concept. COSO and all the regulatory requirements are directed solely at controls, yet management teams historically wasted millions of hours and dollars meticulously documenting processes.
And that confusion just buried the true controls in these mountains of documentation. Let's be crystal clear on the difference here. A cash payment, the act of actually cutting a check, that is a process.
The control is the mandated review of the vendor invoice and the payment support by someone other than the accountant who cut the check, specifically looking for things like duplicate payments.
Okay, another example. Recognizing a sale on credit is a process.
The control is checking that customer's available credit rating before you ship the goods.
So the statutory requirements are to document, assess, and test the controls. The policies and procedures designed to mitigate risk and ensure the reliability of financial assertions, like completeness or valuation.
Not the entire business process narrative.
Yeah.
And that's what companies did. They created these 100-page documents that led to incredibly inefficient updates, review burdens, and audits that just couldn't find the actual control points amidst all the narrative sludge.
The cost of that confusion is just immense. The strategic takeaway here is that smart implementation focuses on documenting the controls that mitigate risk, not the steps that execute the operation.
It's about concise focus. COSO asks, where is the risk of a material misstatement, and what control ensures it doesn't happen? That's the question.
So to get to that level of efficiency, we have to talk about the triangle of efficiency.
Successful COSO implementation isn't linear. It requires getting 3 specific types of knowledge simultaneously before you even start the documentation and testing project. If you fail to address any corner of this triangle, you're going to waste enormous amounts of time and money.
Okay, corner number 1 is knowledge of entity and auditor requirements. For public companies, that means knowing the SEC rules, understanding standards like PCAOB auditing standard number 5. What exactly does the auditor need to see?
Corner number 2 is knowledge of COSO.
Yeah.
The framework, the components, the 17 principles, you have to know the standard you're being measured against.
And the third corner is knowledge of your own company's controls and processes.
And historically, so many companies started their SOX implementation by jumping straight to that third corner. They started documenting every single detailed activity-level process in sight.
Without fully comprehending the first 2 corners.
Exactly. They were documenting low-risk, activity-level controls without understanding the high-level entity-wide risks that PCAOB AS number 5 prioritized. This failure to consider the triangle all at once was the root cause of all those early complaints about the cost and time of SOX compliance.
And this necessary knowledge, it also underscores that entity responsibility and documentation are just paramount.
They are. The entity's management, not the auditor, is responsible for the design, the documentation, and the implementation of the control system.
And our sources make this almost uncomfortable point. An entity that just lacks the internal expertise or the manpower to document its controls well might be viewed by the auditor as having a control deficiency itself.
And that's because inadequate documentation suggests a fundamental lack of organizational competence, or maybe a deficient attitude toward control, which by definition implies a failure in the control environment.
So management has to view internal control as an investment, not just another regulatory hurdle to clear.
Proactivity is key.
So once that commitment is in place, the technical task becomes mapping to COSO 2013. For companies that were still relying on the 1992 framework, this shift meant mapping all of their existing controls to the new structure, with its 17 principles and over 80 points of focus, or POFs.
In the POFs, they can look pretty daunting. But they're incredibly useful tools. They're not a required checklist, and not all 88 will apply to every single company.
So they serve more as a helpful reminder.
Exactly. A reminder of the intended scope and depth of a principle. By mapping your existing controls against those POFs, management can systematically identify subtle gaps in their control documentation and design.
Can you give an example of how that would work?
Sure. Let's say you identify a weakness in the control activities over your treasury function. The POFs for the control environment might then remind you that the root cause is actually a lack of demonstrated commitment to competence principle 4, because your treasury staff hasn't been adequately trained on complex derivative accounting.
I see. So the mapping exercise forces you to consider those interrelationships that COSO keeps emphasizing.
It does. And we also have to touch on the scoping conundrums. Control scoping has to be broad, it has to be strategic, and it has to be entity-wide.
And there is definitively no 80-20 rule for U.S. generally accepted auditing standards applications.
None. The benchmark threshold is materiality. Could the item alone or with others result in a material misstatement? But history shows us again and again that auditors and management have been constantly surprised and embarrassed when controls over some seemingly esoteric area were initially missed.
Our materials have some great historical examples of this. Back in 2004, companies were just caught flat-footed when the PCAOB announced that controls over the hiring and use of specialists were in scope.
Specialists like actuaries, engineers, or valuation experts who help determine fair values or allowances.
Right, and why were those in scope? Because if your control environment doesn't ensure that the specialist is competent and that their work is adequately reviewed, then the valuation is unreliable. That could lead to a material misstatement.
The control isn't over the accounting entry itself, it's over your reliance on the expert.
Then, years after SOX, there was the infamous discovery of widespread stock options, manipulation backdating, and spring-loading.
An activity that most auditors and management teams had completely failed to include in their early scoping exercises. They just missed it.
Why did they miss it?
Because it wasn't a standard routine transaction. It involved subtle timing decisions, board minutes, It often reflected a failure in the control environment, a lack of integrity, and a failure in information and communication with inaccurate dating.
And finally, those spectacular failures involving high-stakes derivative activities. The Barings Bank collapse in 1995 from rogue trading, the Orange County bankruptcy in 1994 from complex interest rate swaps.
Both of those demonstrated that exposures from these difficult-to-assess, non-routine activities can just dwarf the apparent size of the underlying operation. Control scoping has to be aggressive and dynamic. You can't just ignore the hard-to-assess stuff.
And if the scoping is wrong, the controls are deficient.
And if the deficiencies are severe enough, we come back to that critical term for our investor audience: material weakness.
A material weakness is a deficiency, or a combination of them, in internal control over financial reporting, such that there's a reasonable possibility that a material misstatement of the company's financial statements will not be prevented or detected on a timely basis.
That is the investor's nightmare. If management or the auditor finds a material weakness, it means the entire system of ICFR is ineffective. Management has to disclose that failure publicly, and it often triggers restatements.
Which is why getting the application of the COSO framework right from the tone at the top through risk assessment all the way to detailed scoping is just critical for market confidence and shareholder value.
Okay, so having established the stakes, let's also manage expectations. We defined internal control as providing reasonable assurance. It's a high threshold, yes, but it is explicitly short of absolute assurance.
It's an acknowledgement that perfection is impossible in human systems.
It is. The COSO framework is designed to be highly resistant to failure, but it recognizes these inherent limitations. The existence of an isolated internal control failure, something less severe than a material weakness, that doesn't automatically invalidate the entire system.
But we have to understand why even a really well-designed system can fail.
There are three major inherent limitations, and they are all rooted in the human element. The first one is simple: human error. People are fallible. They make mistakes. They have errors in judgment. They misunderstand instructions.
And that's why things like compensating controls and independent reviews are so essential.
The second, and maybe the most difficult one to control, is management override.
Right. Even in a company with stellar documented controls, managers, especially senior ones, can circumvent controls for selfish purposes, often to meet aggressive performance targets or to manipulate earnings.
And since management is usually outside the scope of the day-to-day controls, preventing this often requires real vigilance from the board or very strong whistleblowing controls.
And the third limitation is collusion.
Yeah, when two or more people work together, they can often bypass otherwise effective controls that rely on segregation of duties. For example, the clerk who initiates a transaction could collude with the manager who's supposed to authorize it.
Which is why control activities sometimes have to rely on less frequent detective controls, like periodic reconciliations or analysis of non-standard activity.
Or independent fraud investigations.
Yeah.
Because these limitations exist, management is constantly making these nuanced cost-benefit judgments.
And this brings us back to that idea of flexibility, not a checklist. COSO is a conceptual framework, not a rigid, prescriptive rule book.
That's right. What works for a massive publicly traded bank with thousands of transactions a day, say an elaborate three-way match control over cash disbursements, that might be overly burdensome and just prohibitively costly for a smaller, non-public manufacturing company.
So management has to adapt the framework to the entity's size and its complexity.
They do. For a smaller company, they might rely more on compensating controls. For instance, having the CEO or CFO personally review every single non-routine transaction. That could achieve the same level of reasonable assurance, even if they don't have the staff for traditional segregation of duties.
So the key isn't which specific control you use, but whether the controls you have in place appropriately meet the risks you identified, given your cost constraints.
A generic checklist of best practice controls is explicitly discouraged by the COSO guidance.
And this adaptability is what ensures the system can remain effective in a dynamic business environment. It's why Principle 9, analyzing and responding to change, is so crucial.
Absolutely. If the company expands globally, or moves its IT to the cloud, or acquires a new line of business, the internal controls have to evolve to address the new risks. Stagnation is a fast route to a material weakness.
Ultimately, everything we've talked about, from the control environment all the way to monitoring, it all hinges on the people factor.
It does. Internal control is affected by people. It spans the entire organization. You can have the highest quality documentation, the most sophisticated IT systems, They're worthless if the human element is compromised.
And that's why the control environment is the foundation. People aren't just influenced by written policies or some annual training module they click through. They're profoundly influenced by the actions taken by senior management. That tone at the top.
If the CEO flies first class while demanding employees cut every minor expense, that sends this negative, integrity-destroying signal that just undermines the entire control environment.
Actions matter more than words.
So much more. And as we noted earlier, effectiveness also depends on the competence of your personnel. This requires a real ongoing investment in hiring, in training, and in communication to make sure people not only know what controls to perform, but they understand why those controls are necessary to manage risk.
But despite all the value in this framework, the debate continues.
It does. After SOX, there was significant resistance, especially from smaller public companies. That led to legislative exemptions in acts like Dodd-Frank and the JOBS Act, which relieved certain companies from some of the requirements.
And detractors still argue that the cost-benefit analysis just doesn't justify the regulatory burden for smaller companies.
But the historical counter-argument is so compelling and clear. Inattention to internal controls was consistently at the root of massive business failures and the erosion of investor confidence before 2002.
I mean, that alarming increase in financial restatements we saw in the late 90s and early 2000s, that was a direct result of weak ICFR.
It was. And since SOX and the widespread adoption of the COSO framework, we've seen notable improvements and reversals of those downward trends. So while controls are expensive to implement, the evidence really suggests that the medicine seems to be working. It's reducing fraud losses and increasing the reliability of financial statements.
And the 2013 revised framework just ensures that this structure stays relevant in a world that is now completely dominated by technology and complex global supply chains.
So to summarize the core value we've extracted today, COSO is so much more than just a compliance tool. It provides the necessary conceptual structure, the 5 integrated components, and the 17 essential principles to transform the inherent chaos and risk of business into the bedrock of reliable financial reporting.
It's an integrated process that adapts to modern realities like pervasive IT and global outsourcing, and it's constantly seeking to provide that reasonable assurance that strategic objectives are being met.
It provides the language, the architecture, and the crucial guidance that allows executives, boards, and auditors to systematically assess, design, and maintain a robust control system.
For anyone serious about understanding corporate risk, governance, or valuation, mastering COSO is just absolutely necessary.
And we established that the natural state of complex systems is deterioration. That means continuous effective monitoring is really the only way to avoid a material weakness.
We also noted that controls ultimately depend entirely on people, and that people are influenced most strongly by leadership's actions, not just their words. That makes integrity the true foundation of the control environment.
Which leaves us with this final provocative thought for you, the learner. We've talked a lot about the importance of the tone at the top and accountability. So if you were an employee or an auditor assessing a company's culture, what single non-monetary action taken by a CEO or founder, maybe a decision about how resources are allocated or how bad news is handled, what action would immediately signal to you that their company has a truly effective and deeply rooted control environment?
Something that connects the rigorous oversight required by that monitoring function all the way back to the core values of integrity and ethical behavior. Think about that benchmark of accountability as you evaluate the next company you encounter.
We hope this deep dive into the COSO Internal Control Framework has provided you with the strategic knowledge and insights you need to navigate the financial world with greater confidence.
Until next time, keep digging.
Okay, let's unpack this. We are diving deep today into one of the most critical yet often unseen processes in organizational management. We're talking about how companies set the scope for assessing their internal controls.
Right.
So if you are a learner who needs to understand the blueprint for how businesses, guided by modern frameworks like COSO, decide what controls to document, what to test, and crucially, what they can safely and legally exclude, this deep dive is your complete guide.
And this is really the moment where theory meets reality, and the stakes are, well, they're immense. Management teams are making these high-stakes professional judgments based on risk.
And if they get the scoping wrong.
Exactly. If they get it wrong, if they exclude an area that later proves to be a critical failure point, the consequences aren't just minor accounting errors. We are talking about exposure to material misstatements, huge legal liabilities, regulatory fines, and potentially catastrophic organizational failures.
Wow.
Yeah, so getting the scope right is really the foundation of protecting investor confidence and the company's integrity.
So our mission today is to really dissect the mechanics of this high-stakes judgment call. We're centering the discussion around the modern foundational guidance.
Right, COSO.
That means we'll focus heavily on the COSO framework, especially that revolutionary idea that business objectives have to come before any risk assessment. And we'll explore the evolution of public company standards.
The big shift.
The big one. Specifically, that monumental shift from the really broad sort of box-checking approach of AS number 2 to the more refined risk-based approach of AS number 5.
Which was a huge relief for a lot of companies.
I bet. It means moving away from simply testing everything with a dollar sign to identifying and rigorously testing what matters most. And that's a process that, it demands expert judgment and absolutely zero shortcuts.
That's the only logical starting point. Without a clearly defined destination, you can't accurately measure the risk of straying from the path.
Exactly. The absolute starting point has to be a clear statement of business objectives. This is the core principle that COSO really introduced. Risks aren't some, abstract bogeyman.
No, they are defined in relation to the specific strategic, operational, reporting, and compliance objectives the organization is trying to achieve. If your objective is reliable financial reporting, the risk is the potential for a material misstatement. Simple as that.
And that clarity in objectives dictates the initial scoping approach.
It has to. The guidance insists that you must start by casting a really broad net across the entire entity. We're talking all assets, all revenues, all income streams, all significant processes.
Everything.
Everything. And only once you have gathered concrete, demonstrable evidence can you justify reducing that focus. You only exclude account or transaction streams when the evidence firmly concludes that the inherent risks associated with them are genuinely low.
It's a structured approach that prevents management from just, making premature assumptions about what's safe.
That's the key.
But right here, we hit the minimum standard challenge.
Yeah.
Even with this COSO guidance, the sources make it clear that there's no real consensus, no magical threshold.
No bright line minimum.
Exactly. No bright line minimum that tells you precisely where to draw the line. Yes, you can cut out trivial revenue streams or insignificant locations, but that judgment call is so subjective.
And it's easily challenged after the fact, which is the scary part.
Right.
And that subjectivity is why understanding the regulatory history is so important, particularly if you're dealing with public companies or maybe preparing for an IPO.
You mean AS Note 2?
The PCAOB's old standard, AS number 2, was famous, or maybe infamous, for its breadth. It effectively forced auditors to include just about everything.
To boil the ocean, essentially.
That's the perfect phrase for it. It led to these massive initial compliance costs and a total lack of focus. So the replacement, AS number 5, shifted to a more economically sensible, risk-based standard. It essentially said, focus on the controls that actually address material misstatement risk.
But the paradox is still there, isn't it? Even if you're operating under the more flexible AS number 5, the danger of an error in professional judgment is still potent.
It's always there. If you exclude a revenue stream or a process or a location that later proves to be the source of a material financial misstatement, well, legal and regulatory liabilities will follow swiftly. It's that classic case of efficiency versus security.
Absolutely. And this is why we must always define the core business, the main activities that are likely making up the bulk of revenues, expenses, and transactions. That's got to be the essential starting point for scoping.
The internal control effort has to concentrate there.
Right. It's the 80-20 rule applied to risk,
Yeah.
If the controls over your core business, say your main manufacturing processes or your primary revenue recognition activities, if they're not well designed and operating effectively,
then the entire system can't possibly be deemed effective. If the engine of the car is broken, the rest of the car's components, no matter how shiny, are irrelevant to its main objective of getting you somewhere.
And that idea also highlights that even if you have no known problems with a critical process, you can't just de-emphasize the controls because it hasn't failed yet.
Yeah. That's a huge trap. The fact that you haven't had a problem with revenue recognition doesn't mean you should ignore the controls, not if your business involves highly complex, multi-year sales agreements with, intricate period-end cut-off issues.
But on the flip side,
conversely, yeah, if your business is purely cash and carry retail with no lingering cut-off or complex contract issues, that might be a logical basis to reduce focus on those specific common control issues. It's all about context.
Speaking of areas that businesses often think are low risk but then turn out to be catastrophic, let's look at a historical failure point that changed risk assessment forever. The stock option scandal.
Oh, this is a perfect illustration.
And here's where it gets really interesting.
It's a perfect illustration of how risk can hide in plain sight. Leading up to, say, 2004, 2005, the stock option granting process was widely viewed as administrative and low risk.
Just paperwork, right?
Pretty much. It was governed by clear written policies, it involved a few key management sign-offs, and it just seemed utterly peripheral to the massive transactional volume of sales or accounts payable. So consequently, many companies and their auditors scoped it out entirely.
But then an outsider academic, Dr. Eric Lai, started analyzing the actual dates options were granted and discovered widespread fudging of the dating process.
And this wasn't an accounting error. This was systematic fraud.
Backdating.
Exactly. Backdating options to align with low stock prices, which maximize profits for executives and cost companies billions. This was a massive embarrassment because the controls they had scoped out as low risk turned out to be a massive failure point driven by management fraud.
That is incredible.
The profound takeaway here is that you absolutely cannot shortcut the process of gathering evidence to support a low-risk assessment. And you must periodically re-examine risk decisions, especially where management compensation and executive influence intersect with financial reporting.
You can't just assume.
If you start with the assumption that controls are fine because they are documented, you are already on thin ice. Yogi Berra's quote applies perfectly here. It's amazing what you see when you look.
Right. If you don't look, you don't see the risk, and you certainly don't see the fraud.
Precisely.
Which leads us directly to the long-term view. The first year of documentation and scoping under a framework like COSO is, it's universally intense. But we shouldn't stop there.
No, subsequent years must involve expanding that documentation into those less significant areas that were initially excluded, maybe testing them on a rotating basis.
And crucially, entities have to adopt an attitude of continuous improvement.
It's all about reducing compliance costs over time while attaining higher quality controls. And that means avoiding the notorious trap of SAILI.
Same as last year.
Same as last year. The business environment, the regulatory landscape, technology, it's all changing constantly. If the business changes, your old risk assessments become obsolete, and clinging to them creates this false and really dangerous sense of efficiency.
And this continuous improvement requires more than just good intentions. It needs structured training, right?
Absolutely. Because COSO is conceptual, it tells you what to achieve, not how to achieve it. Understanding the overall framework is essential. The guidance suggests a serious risk arises when management relies solely on on-the-job training.
Why is that?
Well, what happens is that procedures can subtly morph in meaning over time. It's like that parlor game where a message is whispered around the room and it changes completely by the end. You need conceptual consistency, reinforced by structured learning, to ensure effective, reliable implementation across the entire organization.
So we've nailed the foundational mindset. Objectives drive risk drives scope, and never assume low risk without evidence.
That's the core of it.
So now let's turn to the practical tools used for entity mapping. How do management teams actually, visualize and measure the scope of their organization?
Well, the practical technique involves profiling the entity, using the financial statements to establish that quantitative core. The suggestion is to create a multi-column spreadsheet. You can think of it as a heat map of your business.
Okay, so on the left column, you'd list your major balance sheet and income statement accounts. Revenues, accounts receivable, inventory, fixed assets, liabilities.
Right. And then across the top rows, you break the aggregate consolidated numbers out by meaningful operational segments, business units, divisions, locations, or even just types of revenue.
And this is essential because looking only at the consolidated numbers can be really misleading.
Completely misleading. Breaking out the aggregate numbers into individual segments visually helps management and the auditor define the central core. For example, if you have sales subsidiaries in 20 different countries and only 3 of them account for 90% of your sales revenue.
That analysis immediately focuses your control testing effort onto those 3 locations for the sales to cash process. We also need to remember the necessary complexity of modern reporting. Special consideration must be given to intersegment transactions, right?
Yes, transfers of costs and revenues between divisions. Even though these transactions are eliminated during consolidation for external financial reporting, they still represent significant activity, volume, and control points internally that need proper documentation and control.
Okay, let's look at a concrete example from the sources, the revenue test example, table 2.1. This really illustrates the pitfalls of relying purely on magnitude.
Imagine a municipal entity with, say, $10 million in revenue. Income tax makes up 50% and revenue sharing is 35%. Together, that's a massive 85% of the total revenue.
So if you focus purely on quantitative size, you just test controls over those two streams.
You'd think so. However, the deep dive into risk tells us that quantitative size is not the only factor, and sometimes it's not even the primary one. The remaining streams fees at 5% and fines at 4%, they're small, less than 10% combined.
Yet our sources insist these are inherently high-risk areas.
And why is that? Because fees and fines are typically characterized by volatility, they are harder to predict and verify than, say, stable income tax rates. They involve significantly more direct human interaction.
Increases the opportunity for error or collusion.
Right. And they carry a high fraud risk, like skimming. Now, contrast this with revenue sharing at 35%, which might be low risk because it's allocated in a scheduled, easily traceable way from a larger state or federal pool.
The conclusion, then, is crystal clear. The scope must include low-volume areas if they carry inherently high risk. The dollars don't dictate the risk.
The nature of the transaction dictates the risk. Management might need to place significantly more effort on the controls over that 9%, the fees and fines, than on the 85% from taxes and revenue sharing.
We see this principle reinforced in the financial statement segmentation example, table 2.2. Here we have two locations that really illustrate the complexity of a decentralized business.
So you have Connecticut, which is the primary sales location, 80% of revenues, but only 25% of assets. Then you have New York, which is the headquarters and manufacturing center, 74% of expenses, 75% of assets, and 100% of the liabilities, like long-term debt.
Wow. So if you were solely focused on revenue, you'd almost completely ignore New York.
And if you focused on fixed assets and liabilities, you'd almost ignore Connecticut. The lesson is that you need to include multiple locations and processes to cover the core business effectively.
You need controls over revenue recognition at the sales site in Connecticut.
And controls over asset security, inventory management, and debt administration at the corporate and manufacturing site in New York.
And that segmentation analysis also highlights why the income row is often not a meaningful basis for inclusion or exclusion decisions.
Not at all. In our example, consolidated income is small, just $50,000. But it's composed of a large positive income in Connecticut, $300,000, and a large loss in New York of negative $250,000. Income is just too reliant on management estimates, accruals, timing differences, and intercompany eliminations.
It's too volatile and prone to manipulation to reliably define the underlying control activity.
Exactly. We have to look at the raw activity, the revenues, the assets, the liabilities, to define the core.
This quantitative scoping analysis must also always be viewed through the lens of potential disaster, which brings up the historical failures again.
Yes. The implosion of Barings Bank in 1995. That involved unauthorized trading that led to over $1.3 billion in losses.
And that operation would have appeared as a tiny operation if you just measured it by its fixed assets or normal operating expenses.
It would have. Nick Leeson was dealing in complex derivatives, trading highly leveraged instruments that involve massive potential exposure for very little capital outlay up front.
The same core principle applied to Orange County, California, when it declared bankruptcy in 1994. The derivative trades made by the treasurer created these massive undisclosed risks.
And the profits from those interest rate derivative trades before the collapse, they were far more significant than any associated fixed assets or normal expenses the county reported.
Both examples prove conclusively that you can't rely solely on asset or expense metrics to define scope.
Not at all. A small operation, particularly one dealing with complex financial instruments, can generate huge, disastrous losses that far exceed its measured size. The amount you measure in a normal year is not the determinant of risk. The size of the potential disaster is.
It seems the central theme of this deep dive is skepticism. Every time management or auditors assume safety based on historical volume or perceived simplicity, they step right into the danger zone, where faulty risk judgments have truly catastrophic consequences.
And those consequences are non-negotiable. Income loss, severe reputation effects, and regulatory intervention. It's critical to remember that very few financial statement elements are inherently low risk in all circumstances. Generalizing from prior successful audits gives a dangerously distorted view of the risk that applies here and now.
Let's run through some of the specific failure anecdotes from the source material that prove this point. Auditors often considered cash accounts low risk because they are reconciled monthly, relying on the control. But then you look at Parmalat.
This failure is a textbook case of misplaced trust. The Italian dairy conglomerate financially collapsed because auditors relied on the reconciliation control without critically examining the underlying evidence or its operational design.
They were served a bogus bank confirmation for over $3 billion.
Which eventually revealed $13 billion in bogus assets. The reconciliation process was relied upon, but the key piece of evidence supporting it was completely fraudulent and was never properly verified.
Then we have fixed assets. These are traditionally viewed as a low inherent risk area. They're hard to steal, they're visible. But then there's WorldCom and waste management.
Right. WorldCom improperly reclassified billions of dollars of routine expenses as fixed assets or capitalized costs just to artificially inflate reported income. Waste management was fined for capitalizing garbage, literally assets that had zero future economic value.
So the risk isn't necessarily theft. It's manipulation for income smoothing or inflation.
Exactly.
And the ultimate poster child for high skepticism has to be ZZZ Best.
A startup that seemingly came out of nowhere. ZZZ Best created entire files of fraudulent documents, fake construction contracts, fake appraisals, completely misleading auditors into thinking it had interests in buildings and fixed assets that simply didn't exist.
These companies remind us that auditors and management have to approach scoping with a healthy dose of professional skepticism, regardless of the perceived stability of the account.
And the lesson applies equally to smaller companies who face similar pressures and, poor guesses regarding risk. They don't make the headlines, they just become empty storefronts or get acquired for pennies on the dollar after a control breakdown.
This is why we need to focus so keenly on the area of small operation, massive exposure. That concept that small transactional areas like high-volume trading or financial derivatives can explode and create catastrophic losses that overwhelm the entire entity, regardless of the size of their balance sheet account.
Absolutely.
Now, let's tackle what seems like the most insidious risk in control scoping. Overstatement versus understatement, the skimming risk. When we talk about public companies, auditors generally focus on the assertion of occurrence. Did this transaction actually happen? And that's to guard against overstatement or inflating income.
That's right. Overstatement of revenue or assets is often the focus in the public sector because management is incentivized to hit earnings targets. But especially in private entities, or when fraud is involved, owners might seek understatement to minimize tax liabilities.
This means the assertion of occurrence sometimes needs to take a backseat to the assertion of completeness. Did all transactions that should have been recorded actually get recorded?
And completeness is exponentially harder to audit. You are trying to find evidence of something that isn't there.
And here's the paradox of the skimming trap. If the revenue at a remote location, like a small branch office, is being systematically skimmed, means the cash is stolen before it ever enters the journal.
That location will appear less significant based on its reported revenues, expenses, or assets, which is precisely the opposite of what should happen. A low reported number, if it's caused by skimming, should be a red flag, not an exclusion criteria.
Wow. So skimming makes the risk assessment based on reported financial numbers completely unreliable.
Totally unreliable. It forces you to look at controls, non-financial metrics, or physical evidence instead.
The source provides a very relatable example. A church's loose plate collections.
Right. Is the amount recorded what was actually deposited, or is it what was collected? If money was never recorded because it was stolen right after collection, how do you detect that error in an amount that never entered the journals? You can't trace it. You have to rely on controls over the physical collection process itself.
This demonstrates the necessity of the inherent versus control risk distinction.
This is a classic point of confusion.
So management might conclude an area is low risk based on the assumed presence of effective controls. For example, assuming receivables are low risk because they are reviewed monthly by the credit manager.
But that relies on control risk being low. If the credit manager is colluding with the sales team or just isn't performing the review properly, the entire basis for the low-risk assessment is invalid.
So at the crucial scoping stage, the focus has to be on the inherent risk of the account or transaction stream.
Yes. its sensitivity to external factors, its complexity, its target profile for fraud, before you place any reliance on the effectiveness of existing controls. You only rely on control effectiveness later, once you've tested it and confirmed its operation.
And finally, to protect against sophisticated internal actors and clever fraudsters, we need risk rotation.
Absolutely. Predictability is the fraudster's best friend. Management and auditors have to vary the nature, timing, and extent of monitoring and testing procedures to create unpredictability.
So if fraudsters know exactly when and where people are looking, that the fixed assets are audited every 3 years in June, they know precisely when they have a window of opportunity.
Exactly. Varying the focus, looking at high-risk estimates one quarter and accounts payable transactions the next, helps ensure that temptation isn't met with an easy, predictable path.
So we've learned to be skeptical of reported numbers, to prioritize inherent risk, and to define the core business. But the modern entity is far more complicated than a single cash-based operation. They span continents, use complex technology, and rely heavily on outsourced services. How does this complexity affect our scoping judgment?
It creates enormous challenges. When dealing with multiple location management, the initial evaluation should still cover all locations or business units. However, management is permitted and expected to use risk-based judgments to tailor the scope and extent of testing. Our sources break down 3 common ways companies classify these risks when dealing with multiple locations.
The first type is centralized controls.
Yep.
This applies where a company runs multiple decentralized units, say numerous retail stores or shopping malls, but uses the same standard operating procedures, the same software, and centralized IT systems hosted at HQ.
In these cases, since the control activity is technologically unified, you can often reach a common conclusion about control effectiveness across all locations. But you still have to look out for localized issues, like differences in stacking quality, a location with high employee turnover, or a local ethical culture problem that might override the centralized process.
The second type is specific risks unique to one location. Maybe a newly acquired subsidiary hasn't been integrated into the central IT system yet, or one location has a unique operating environment, systems, or a complex currency trading desk that differs markedly from the norm.
And these unique risks demand targeted attention. You cannot rely on the common centralized controls to address the unique risk profile of that specific location.
And the third type, low-risk locations, are small in terms of assets or profit contribution and don't pose specific high-risk activities.
For these locations, management may decide that evidence from self-assessment and ongoing monitoring combined with the general centralized controls is sufficient. But we have to heed that crucial SEC warning from Release 3388 tone,
Which is,
management must consider the risk characteristics of controls for each financial reporting element, not just make a single blanket judgment for all controls at a location. You can't just slap a low-risk label on the entire location. You have to evaluate the specific accounts and processes within it.
that means even in seemingly insignificant locations, you should be prepared to examine the underlying processes and potentially test them periodically in the future. Now, let's jump to the major complexity challenge of the 21st century. The complexity of service organizations, SOs, and outsourcing.
Whether a company outsources payroll processing, IT network management, cloud storage, or even parts of its entire accounting system, using an SO does not relieve the client company of responsibility. The function must still be included in the control assessment if it is relevant to the client's financial reporting.
The core challenge is simple. The controls reside outside the entity, at the SO. So the company has to determine if its scope can be restricted only to the controls it administers over its inputs, or if the scope must extend to the SO's control environment.
And you have to consider the significance of the activity, the specific functions the SO performs, and critically, the degree of interaction between your company and the service provider.
Let's break down that interaction using high versus low interaction, the payroll example.
Okay. In high interaction scenarios, the user organization retains responsibility for authorizing transactions. For instance, you provide the inputs employee hours, pay changes, new hires, and you retain accountability for the data. The SO simply processes the data and prints the checks.
So because you control the inputs and check the outputs, the scope often focuses only on your controls, your authorization procedures, input verification, and testing of the final output reports.
But this leads to a cost dilemma. If the SO performs a complex function, like payroll tax computation and remittance, routine testing of inputs and outputs might require the user company to reperform the very complex calculation service they outsourced in the first place just to verify it.
Wait, If we're essentially having to reperform the payroll tax calculation to verify the SO's output, aren't we just paying twice for the same work? Where's the efficiency?
You are. And that's why the company has to decide if the inherent risk is low enough to simply test the outputs and trust the SO's expertise, or if the risk of failure is so high that they need higher assurance. That higher assurance comes when there is low interaction.
That occurs when the SO is authorized to initiate and execute transactions without the user company providing prior authorization for each one.
A classic example is a trust department or an investment manager. They might be authorized to invest assets based on a set strategy, initiating and executing trades daily. Since the user company can't independently generate a record of those underlying transactions, they only see the final result, the scope must necessarily extend to the SO's controls.
Because the user relies entirely on the SO's systems for accuracy and completeness.
Exactly. And to manage this massive logistical problem, since one SO might serve hundreds of clients, SOs hire their own auditors to produce standardized reports. This leads us to relying on SO reports, Type I versus Type 2.
So if the user company intends to rely on the SO's controls for high assurance, which is mandatory for public companies under SOX compliance, they must obtain what?
They have to get a Type 2 report, now commonly a SOC1 Type 2 report. This report addresses the control design and includes testing of the control's operating effectiveness over a period of time, usually 6 to 12 months.
And timeliness is critical, right? If the Type 2 report covers a period that ended 6 months ago, the user organization has to perform updating procedures, talking to the SO, checking for changes, to ensure those controls are still effective right up to the user company's year-end reporting date.
Absolutely. Conversely, a Type I report only addresses the control design. It reports on the auditor's opinion that, if implemented perfectly, the controls would achieve the objective. Crucially, it does not report on the testing of their operational effectiveness.
So Type I reports are not sufficient for high assurance reliance for public company compliance.
Not at all, though they might be adequate for a non-public entity placing very limited reliance on controls.
The source material mentions a couple of crucial practical issues that the learner needs to know. First, public companies are expected to execute right-to-audit clauses in outsourcing contracts.
That's right. If you outsource a key function relevant to financial reporting, the SEC expects you to maintain the contractual right to audit that function directly. Without this clause, you risk having a scope limitation imposed by your external auditor, which is a major, major problem.
And second, there's a global challenge. Outside the U.S., the concept of a standardized SO report isn't really established international auditing practice.
And that creates huge difficulties when you're outsourcing activities to remote global locations. If that location doesn't use the SOC framework, you might actually need to send your own auditors overseas to test controls that were outsourced to save money.
This deep dive has established a high bar for documentation and inclusion, which risks sounding incredibly inefficient. We have to be clear. The goal is risk-based efficiency, not testing every single transaction.
Which brings us to the core concept, the core principle. In scope does not imply extensive testing.
This is vital for maintaining economic operation. Effort is entirely scalable and must respond directly to the risk assessment. The all-or-nothing approach of the past, which led to massive burnout, is just inefficient. We use a sliding scale that matches testing intensity to inherent risk.
Okay, let's look at the spectrum of effort required. For low-risk areas, what's the minimum standard?
You must still document the existence and design of the controls. You should examine some evidence that they are in operation, perhaps management oversight reports or occasional sign-offs, but you don't perform extensive full-scale testing due to the limited risk profile. But the plan should include rotating periodic full testing in future periods to maintain the integrity of that low-risk assessment and ensure SAILI doesn't creep in.
Okay. For moderate risk areas,
you document the controls thoroughly and perform testing, but you might use a smaller sample size than you would for a core process. You're gaining confidence, but you aren't expending the full effort required for the most critical areas.
And for the core or high-risk areas,
this is where you document controls thoroughly, test them extensively, and often use larger sample sizes and rigorous methodologies. This high level of assurance is necessary to support the conclusion that the risk of failure is acceptably low, which is the ultimate mandate for public company reporting.
And for non-public entities, the depth of testing really just depends on the reliance the owners or potential future investors want to place on those controls.
Regardless of the risk level, PCAOB guidance, AS number 5, mandates focusing attention on the area of highest risk, the risk of fraud.
This is because the risk of failure to prevent or detect misstatement caused by fraud is usually higher than the risk of failure to prevent or detect simple unintentional error. Fraud involves intent, deceit, and usually override of existing controls.
Therefore, the auditor and management must focus more attention on these areas prone to fraud risk. You're thinking about cash disbursements, expense accounts where management might submit bogus receipts, or journal entries.
All areas that are easily manipulated by management, override, or collusion, and which may not be adequately addressed by standard transactional controls.
The desire for efficiency often tempts companies to rely on internal checks, which raises the question, can independent auditors rely on the quality of management assessments?
In short, yes, they can, but it requires demonstrated objectivity and competence from management. High-quality management assessment and testing procedures are highly desirable because they can contribute directly to a reduction in the external auditor's procedures, thus significantly lowering overall compliance costs. It's the ultimate payoff for good internal process.
However, the source material provides a truly startling research finding that puts the quality of management assessment into a harsh light.
It's sobering. A study of smaller accelerated filers companies operating under public reporting rules between 2004 and 2005 revealed that external auditors identified over 70% of the material control deficiencies.
Wait, say that again? 70%.
70. Put differently, management who had already completed their own internal assessment had underassessed the severity of their most serious deficiencies over 70% of the time.
That is a shocking failure rate for internal self-assessment. It indicates a fundamental gap in competence or objectivity.
It suggests that many companies were performing minimal, inadequate assessments, perhaps just ticking boxes to satisfy a procedural requirement rather than genuinely identifying risk. And this naturally breeds a complete lack of confidence in their external auditors.
So if the auditor doesn't trust management's work,
The auditor is forced to revert to more expensive, time-consuming substantive procedures, direct tests of the financial statement amounts, instead of relying on the efficiency of control effectiveness. This failure ultimately drives up the total compliance costs for the company, proving that cheap assessments are often the most expensive in the long run.
so high-quality assessment is essential, but we have to do it intelligently and efficiently. The first place to look for efficiency gains is within the organization itself.
Leveraging internal audit and other work is crucial to avoid costly duplication and reperformance. Management and external auditors should liaise closely with internal audit, or IA, because IA is already performing control testing and risk monitoring.
External auditors can rely on IA work, but they have to first perform an assessment of IA's competence, objectivity, scope, timing, and quality of documentation.
Right. For instance, the external auditor has to ask, did IA address all relevant financial statement assertions, like existence, valuation, and completeness for the account being tested? Did they truly test control effectiveness, or did they only test the substantive correctness of entries in their sample?
The independent auditor has to confirm that IA's audit programs are robust, that their working papers adequately support the conclusions, and that the timing of their work aligns with the external auditor's needs.
And if the IA work is high quality, it directly reduces the external auditor's effort and, consequently, the company's overall compliance bill.
Next, let's tackle complex transactions, business combinations, and investments. These always complicate the scope because control environments are merged or distinct. What about variable interest entities, VIEs?
Generally, VIEs, entities that must be consolidated because the client company holds the controlling financial interest, despite not owning a majority of the voting stock, they have to be included in the scope. They are part of the consolidated entity. Public companies have very narrow, specific criteria for exclusion. For example, if the VIE existed before 2004 and the company lacks the legal right or ability to assess its controls, but if a VIE is excluded, the company must provide specific disclosures in its 10K, stating that the conclusions regarding internal control over financial reporting do not extend to that entity. This exclusion carries a really high burden of proof.
And what about simpler relationships, like equity method investments?
Controls over the investee's underlying transactions, their sales, their personnel, their inventory management, are considered outside the investor company's scope. That's the investee's responsibility. However, the investor company must still have strong internal controls over the recording of the income, loss, and cash distributions in its own financial statements. They need controls to ensure they are properly calculating and reporting their share of the investee's results.
The rapid pace of corporate deals means business combinations, M&A, often occur mid-year. Are new acquisitions immediately in scope?
They can be temporarily excluded for up to 1 year from the consummation date of the deal. This is recognized because it's often practically impossible to integrate all systems and conduct a full control assessment between the acquisition date and the year-end reporting date.
But this exclusion requires full disclosure.
Absolutely. The company has to identify the acquired business, state its relative financial significance, often using total assets or revenues, and disclose any material change to internal control due to the acquisition. It's a significant, specific rule the learner has to understand, as it provides a practical grace period for integration.
Finally, to ensure nothing is missed in this incredibly complex process, the source provides a summary of comprehensive scoping inquiries, Appendix 2A. This is a structured approach to risk identification that ensures completeness before the detailed testing begins.
And these inquiries break down into 3 essential categories. First, industry characteristics. You have to understand the effect of economic conditions, highly specific regulations, and complex accounting issues relevant to your field like leasing standards or complex financial instruments to determine your significant business objectives and inherent risks.
You can't scope a bank the same way you scope a bakery.
Exactly. Then, the engagement scope. These questions are designed to confirm all financially and operationally significant activities, identify potential high-risk exposures, and confirm whether service organizations are involved, all the factors that determine the initial breadth of your documentation and testing plan.
And crucially, internal control considerations.
This involves a deep dive into management's current assessment processes, known weaknesses, and responses to reported deficiencies. They should review any prior restatements or material misstatements identified by the independent auditor to identify new significant deficiencies.
For instance, if a material misstatement was identified by the external auditor and not by the company's internal control, that immediately signals a failure in the existing system that has to be addressed in the current scope.
And of course, the fraud awareness questions have to be central here. Has the board been informed of any fraud of any magnitude on the part of senior management? Are significant deficiencies communicated to management remaining uncorrected? These questions are key alarm bells that will inevitably expand the necessary scope of the engagement because they raise the risk of management override to an intolerable level.
We've covered massive ground today, moving from the foundational objective-setting philosophy of COSO to the practical, sometimes painful, lessons of history regarding corporate failure.
We established that setting the scope begins with clearly defined business objectives, followed by defining the core using quantitative data, like asset and revenue segmentation.
But that quantitative data must always be overridden by a qualitative risk assessment. We saw that the danger zone lies not just in overstatement, but critically in understatement and completeness risk. That potential for revenue streams to be skimmed, stolen, and never recorded, making a high-risk location appear statistically insignificant.
And we detailed how to manage complex modern structures, evaluating the 3 types of location risks and navigating the outsourcing paradox by correctly differentiating between high and low interaction service organizations, securing the necessary Type 2 reports, and ensuring you maintain that contractual right to audit.
So if your initial list of in-scope processes is long, here's the consolation and the payoff.
The effort of detailed documentation is largely a one-time activity if performed competently. As evidence of control effectiveness is gathered over time, particularly for controls that perform well year after year, you can logically assess those areas as lower control risk.
And this lower risk assessment warrants reduced testing in future periods, less sampling, less time spent, which is how organizations achieve those critical long-term cost efficiencies.
Right. As number 5 specifically permits auditors to assess risk lower than in the initial year after they have obtained a solid basis for that low-risk assessment. The hard, high-quality work up front pays off exponentially later.
So let's end with a final provocative thought for you, the learner. We've established that relying solely on reported numbers, the general ledger, the P&L, can hide massive risks, especially the risk of skimming or failure to record all transactions.
So, given the inherent difficulty in assessing completeness risks, the threat that an entire stream of activity never even enters the accounting system, what new, innovative types of data beyond financial reports would you need to routinely monitor to ensure that nothing is slipping through the cracks undetected? How do you audit something that isn't there?
That's the challenge for every risk assessor today. You have to start looking beyond the ledger. Welcome to the Deep Dive. Today we're digging into a concept that's absolutely foundational to any reliable organization. But it's also, often the first place where these huge failures start. The idea is control is only as good as your understanding of what could actually go wrong.
Right. If you haven't defined the risks, how can you possibly control them? It's impossible.
Exactly.
So today we're really breaking down that central pillar of organizational reliability, risk assessment, or RA. This one component really sets the entire trajectory for corporate governance and, Sarbanes-Oxley compliance.
And our mission today is really to give you, the listener, a shortcut. A way to quickly get a handle on this risk assessment component from the COSO Internal Control Framework, which is, it's everywhere.
It really is.
This isn't just theory. This is crucial knowledge for anyone who needs to grasp how companies actually maintain their financial integrity.
And to sort of set the stage, we probably have to acknowledge let's call it a historical reality. When people first start talking about the COSO framework, they almost always start with the control environment, the CE.
And that makes sense, right? The control environment is that tone at the top.
Exactly.
It's all about ethics, the competency of your people, the whole organizational structure. If management lacks ethics, or if they can just override controls whenever they want, if that CE is broken,
then nothing else matters.
Right. The most detailed, bulletproof control you have just fails instantly.
Yeah.
It really does trump everything else.
That's absolutely correct in principle. But, and this is a big but, if you look at it from a project standpoint, from an implementation or testing perspective, risk assessment has to come first.
Why is that? Why prioritize RA over the tone at the top in terms of the actual process?
Because the risk assessment is the engine. It's what dictates where you spend your time, your money, your resources. If we don't first define the risks to achieving our objectives, we can't possibly scope the control activities or information and communication or monitoring.
So it acts as a filter.
A scope filter, precisely. It provides the critical justification for everything that comes after it.
It's the ultimate why. Why do we even have this incredibly complex payroll control? Well, because the risk assessment flagged a huge inherent risk of misstatement or fraud.
That's it. And that leads you right to the three core objectives of the RA process. First, you have to identify the risks to achieving your objectives, all of them, not just financial.
Okay.
Second, once you have the risks, you assess the design of the controls meant to mitigate them. And third, you finally assess whether those controls are actually working effectively.
So if you mess up, number one, if you don't properly identify the risks, then 2 and 3 are what, just a waste of time?
A waste of time, or worse, completely misdirected. You could be spending a fortune testing a control over a low-risk area while this massive financial exposure is just sitting there completely ignored.
Okay, that makes perfect sense. Let's unpack the foundation of this component then.
So when we dive into the COSO 2013 framework, the first thing you run into is this concept of principles.
Right.
This was, kind of formalized back in 2006, but now it's just the standard. These principles are basically the detailed prerequisites that you have to assess as being present and functioning.
And this is where it gets incredibly dense for people, isn't it? Because they didn't just start with the principles.
Oh, no, they absolutely did not. To help everyone understand what's actually inside each of the 17 principles, the framework lays out 88 points of focus, POF.
88. Wow. That just sounds, that sounds like compliance overkill. Is that level of detail really necessary?
That's a fair question, and it really speaks to how dense the guidance can feel. But the thing is, the points of focus are not meant to be some rigid checklist.
Okay.
Their purpose is really about context and standardization. It's to make sure that when two different companies say they're complying with, say, Principle 7, they're at least thinking about the same universe of attributes. A small company might only address a few of the POF. A huge multinational bank might address all of them.
So the non-negotiable part, the real bottom line, it revolves around the principles themselves, not those 88 points.
Exactly. And this is the most critical rule of all. If you identify a material weakness in just one of those principles, the entire system of internal control is deemed ineffective. Period.
Wow. So the principles are the load-bearing walls.
That's a great way to put it, yes.
Okay, so let's drill down into risk assessment specifically. It has 4 of those core principles. What are the 4 pillars holding up RA?
The 4 are, first, Principle 6. specifying clear, suitable financial reporting objectives. You can't assess risk if you don't know what you're trying to achieve.
Makes sense.
Second is Principle 7, the identification and analysis of risks to achieving those objectives. This is, the heavy lifting of the process. Third is Principle 8, the assessment of fraud risk. It's singled out because it's so specific and the impact can be so high.
And the last one.
And finally, Principle 9, identifying and assessing significant change, because risk is never static.
That's a really logical grouping. Objectives, threats, human failure, and environmental change. But even with that logic, companies struggle, and the cost of compliance gets out of control. Let's talk about that cost.
One of the biggest drivers of cost is just, frankly, unnecessary diversity in documentation.
How so?
Well, you'll see one client using these massive risk and control matrices, another one has pages of unstructured narratives, a third is using custom-built flowcharts. Sometimes they're using all three in the same company for different areas.
And the auditor's job just becomes this mapping nightmare.
A mapping nightmare is exactly right. It just takes so much time to reconcile what the company did to the auditor's standard approach. And all that time spent mapping.
Well, that's billable hours.
So the goal for any company trying to be efficient is alignment.
Absolutely. Now, regulators are clear that auditors can't dictate the company's approach. That's management's job. But the more your tools look like the auditor's tools, the faster the review.
It's just common sense. Right. If the auditor can spend 5 hours on a process instead of 15, that is a direct, significant cost savings for you.
That is a very practical piece of advice for any CFO listening. Align your documentation strategy up front. So what are the, say, top things entities should discuss with their auditors right at the beginning?
Okay, so having these conversations early saves so much money. First, documentation formats. Just agree on it. Matrices, narratives, a hybrid.
Get on the same page.
Second, segmentation views. How are we going to look at different business units or locations? Do we have to test every single office in Europe, or can we rely on some shared regional controls? That's a huge decision for a global company.
Okay.
Third, entity-level controls, or ELCs, which controls, like the Code of Conduct, apply to everyone. Agreeing on that limits a lot of detailed testing.
And then there are the more technical accounting-focused points.
Right. Fourth, define the assertions you're going to use. We'll get into these later, but this choice dictates the entire language of your RA. Are you using all 13 from the AICPA, the 5 from the PCAOB, or something else? Fifth, testing approaches. How much testing will the company do versus how much will the auditor have to do? And sixth, severity assessment methods. How are we defining a material weakness? Getting alignment on those criteria up front avoids so much friction at year end.
It sounds like getting those 6 points agreed upon is the best investment a controls team can make. One last thing on this section, the framework version. We've had 1992, 2006, 2013. Do companies really have to move to the newest one?
It's definitely the expectation now. Public companies have to disclose which version they're using, and the SEC was pretty clear that questions might be raised for anyone who didn't move to the 2013 framework after December 15, 2014.
So if you're still in the 92 version, you're basically signaling to regulators that you haven't formally addressed all the complexities around IT and fraud that were built into the later guidance.
That's a very good way to put it. The 2013 version is the benchmark, not because the old ideas are bad, but because the new principles force you to explicitly think about risks that were, maybe only implicitly covered before, and sometimes not covered well at all.
Okay, so since risk assessment is this critical filter for everything, we have to make sure we're all using the same definition of risk. What does it actually mean in the COSO context?
It's focused on the risk that your system of controls, or, the lack of controls, could allow a material misstatement in the financial statements.
And that's broad. It's not just an error in a number.
No, it's very broad. It includes failures in operations, in compliance, or even just failing to disclose something you were required to. Risk really just emanates from your objectives. Once you say, my objective is to present statements according to GAAP, then a risk is anything that could stop you from doing that.
Like relying on a complex estimate for the value of something.
Exactly. The reliability of that estimate or the lack of control over it, that's a primary risk.
Traditionally, when we measure risk, we think about that classic 2x2 matrix.
Which is defined by likelihood and magnitude. So likelihood is, a probability concept. How likely is this thing to happen? And that requires informed judgment, not just a gut feeling. And magnitude is about materiality. If it does happen, how big could the misstatement be?
And that word you just used, could, seems really important.
It's the most important word in the definition. We are assessing the potential that the risk could lead to a material misstatement.
So this is a key distinction. Let's say at the end of the year, no actual misstatement occurred. Does that mean the risk was low?
And that is the trap. The potential is the focus, not just what you found this year. There's actually research that shows a clear psychological bias here.
Oh, interesting.
Yeah, the existence of even a small error makes it way easier for an assessor to rate the underlying control problem as more severe, a significant deficiency or a material weakness.
So wait, let me get this straight. An auditor finds a $50,000 error. If they hadn't found that, they might have called the control weakness minor. But just because they found that $50,000 error, they now call it significant, even though the potential for a $5 million error was there the whole time.
You've got it. That's the bias. The severity should be based on the potential loss. Regardless of whether you just got lucky this year and it only resulted in a small error, you can't conclude that just because you didn't see a misstatement, the process is low risk.
That's a really deep point. So the 2013 guidance, it recognized the world is moving faster, and it introduced two new dimensions to risk.
Right, we moved beyond the classic two. They added velocity and persistence.
Okay, what do those mean?
Velocity is about the swiftness of the event. How fast does the impact hit you? Minutes. Days. Persistence is about how long the damage continues, which affects the total magnitude over time.
So it's like a formula. Total damage is likelihood times magnitude times how fast it happens and how long it lasts.
That's a great way to frame it. Your Hurricane Sandy analogy is perfect for this. It wasn't the strongest storm in terms of wind speed, but the persistence of the storm surge over multiple tides that caused massive, sustained damage.
Low velocity, high persistence, massive magnitude.
Exactly. And your CB radio example is the opposite, a perfect illustration of velocity.
Right, the FCC rule change in the 70s that instantly made all the 23-channel radios obsolete.
Instantly. The impact on the profitability of that entire product line was immediate, high velocity, catastrophic obsolescence. And you see that today with cyber attacks or, a new piece of legislation that gets passed overnight.
Your RA really has to account for how fast an external event can just destroy value.
Which brings us to probably the most common point of confusion in this entire component, the difference between inherent risk and control risk.
Ah, yes. This one trips up everybody. Let's make this really clear for the listener.
Okay. Inherent risk is the raw, unmitigated risk in an account before you consider the effect of any internal controls. Control risk is the risk that's left over after you consider how well your controls are designed and working.
And the big mistake is just lumping those two together. Why is that so dangerous?
It leads to totally incorrect scoping of your control efforts. The error is looking at both together and saying, this account is low risk. But in reality, the inherent risk might be incredibly high, and the only reason the residual risk is low is because you have excellent, probably expensive controls.
And if you don't separate those two concepts, you lose the justification for having those controls in the first place.
Precisely. Take payroll. Payroll is usually a huge expense, high volume, lots of ways to commit fraud. If you had no controls, if anyone could just add a new employee, the inherent risk would be through the roof.
Of course.
Now, most companies have fantastic payroll controls, which is why the residual risk is low. But if you only look at that low residual risk and you label payroll a low-risk process,
then a future management team looking to cut costs might say, why are we spending so much on this low-risk process?
And that's the danger. You have to formally document that the account starts as high risk, and the controls are what pull that risk down to an acceptable level. Your RA has to document both.
Okay, so we've defined risk, its dimensions, and how to think about it. Now we need a standard language to connect that risk to the actual controls. And that language is assertions.
Assertions are that common language. And it's amazing, even though they've been required by auditing standards for, over a decade, companies and auditors still struggle with this.
But why are they so important? Can't we just use control objectives?
You can, but control objectives tend to be really numerous and specific to one account. Like for inventory, a control objective might be all purchased inventory is inspected upon receipt.
Okay.
That's fine, but it really only addresses one aspect, the existence of the inventory. Assertions are a limited set of categories, 13 or fewer, that apply across almost all your accounts.
So they create scale and consistency. You simplify the whole process, even if satisfying one assertion, like, say, completeness, might need a few different control procedures.
That's it. For any organization looking to improve their COSO documentation, moving to an assertions-based approach is a critical upgrade. It saves so much time and audit fees.
Let's break down the full list of 13, starting with the 5 that relate to the income statement and current period transactions.
Okay, these are all about what happened during the year. First, occurrence. Did the transaction actually happen and does it relate to our company?
Got it.
Second, completeness. Is everything that should have been recorded? This is a big risk for expenses. Third, accuracy. Are the dollar amounts and other data correct? Fourth, cutoff. Was the transaction recorded in the right period? And fifth, classification. Is it in the right general ledger account?
Let's pause on cutoff for a second. That seems like a place with a huge temptation for manipulation.
Oh, is the essence of it. Auditors call it the 35th of December problem, holding the books open to pull next year's sales into this year.
And what drives that?
High incentive risks. Maximizing income to hit a bonus target, minimizing taxes, avoiding budget overruns. Controls over shipping and receiving documents are absolutely critical here.
Okay, moving on. What about the 4 assertions for the balance sheet accounts at the end of the period?
These are about the balances at a specific point in time. So number 6 is existence. Do the assets and liabilities actually exist? This is why we count inventory. 7 is rights and obligations. Do we really own the assets? Are these liabilities actually ours? 8 is completeness. Again, are all the assets and liabilities that should be there? And 9 is valuation and allocation.
Valuation and allocation. That seems like where the risk just explodes in the modern world because of all the subjectivity.
It's exponentially higher risk. It's not just checking if cash exists. Valuation covers all the complex judgments, the allowance for bad debt, warranty costs, pension liabilities, and especially fair value estimates for complex investments. If your RA team doesn't dig into the assumptions behind those estimates, you've missed a huge potential for material misstatement.
And finally, the last 4 assertions, which are about presentation and disclosure, basically the footnotes.
Right, and they're often overlooked, but they're part of the financial statements. So 10 is occurrence and rights obligations. Do the things we disclose actually pertain to the company? 11, completeness. Did we make all the required disclosures? 12 is classification and understandability. Is the information clear and useful? And 13, accuracy and valuation. Are the amounts disclosed in the footnotes correct?
So that's the full, comprehensive list of 13. But you mentioned that a lot of firms simplify this.
Yeah, the PCAOB, for example, boils it down to 5. Existence, occurrence, completeness, valuation allocation, rights obligations, and presentation disclosure. Some places use even fewer.
But the big warning there is, if you simplify the structure, you have to be extra careful that you're still mapping every type of risk. You can't simplify yourself out of a risk.
That is the critical caveat. Simplicity in the structure should never, ever mean a compromise in the thoroughness of the actual assessment.
Okay, now let's shift from those account-specific risks to the risks that they cut across the entire company. And we have to start with technology. #TechCheckA. The pervasiveness of information technology. IT risk.
IT risk is absolutely foundational. And while IT general controls, or ITGCs, are technically Principle 11 under control activities, you have to assess the risks related to IT very early, back in Principle 7 of risk assessment.
Why so early?
Because IT deficiencies are pervasive. I mean, if the system that generates your financial statements is compromised, it affects every single number. If the data is unreliable, every control you have that checks that data is basically useless.
And companies are so much more dependent on IT than they realize. Even, a small manufacturing company.
Absolutely. They rely on networks, software, customer lists, IP. The security of those systems is a material risk. A failure there can hit your financial reporting, your operations, your legal compliance all at once.
What are the typical components of IT general controls that we should be assessing?
We usually break them into 4 or 5 key areas. The main 4 are access and security, who can get in and what can they do? System changes. How do you handle patches and updates? New systems development. Are controls built in from the start? And operations, which includes critical things like backup and disaster recovery.
And the risk here isn't just about internal errors anymore. There's a huge legal exposure.
A massive one. Your RA process has to integrate legal exposure from privacy laws, like EPITE. The fines for exposing personal data are severe. Think about the Target data breach back in 2013 that completely changed how retail companies had to think about the velocity and magnitude of cyber risk.
And you've got smaller businesses being pushed to digitize, like medical offices. They might have all this sensitive patient data, but none of the security of a big bank.
And they are prime targets. Thieves know that. The explosion of identity theft means assessing controls around personal data is now a mandatory part of risk identification.
Let's go back to the early days of Sarbanes-Oxley for a lesson here. What happened when companies reviewed their IT controls too late in the year?
It was expensive chaos. If you found a major IT deficiency in, say, November, you often didn't have time to fix it and retest it before year-end. So management had to issue adverse opinions on their internal controls.
And what was the practical result of that adverse opinion?
The external auditors could not rely on any of the automated systems. If your access controls were broken, the auditor had to assume the system's output was unreliable all year.
So they had to go back to manual testing.
Exactly. Costly, labor-intensive manual procedures that automation was supposed to eliminate. The lesson is stark. Assess your IT risk early and continuously, or you will pay for it in audit fees. Fraud risk is so critical and was historically so undermanaged that COSO gave it its own principle, Principle 8. The motivation was just decades of data showing that weak internal control is what facilitates most major frauds.
And to be clear, this is management's responsibility, not the auditors.
100%. Management owns the assessment of fraud risk and the controls to mitigate it.
So when we assess this risk, we use the classic fraud triangle. How does that triangle inform this principle?
It's the core of the assessment. The 3 points are 1, incentives and pressures, what drives someone to commit fraud, personal debt, aggressive sales targets, things like that. 2 is opportunities. This is the internal control part. Can someone steal assets or cook the books? And 3 is attitudes and rationalizations. This is the psychological part. How do people justify? They owe me this or I'll pay it back.
The stats from the Association of Certified Fraud Examiners, the ACFE, are just staggering. They should be required reading for every risk assessment team. What's the top line number?
The ACFE consistently finds that organizations lose about 5% of their annual revenues to fraud.
5%. That is a mind-blowing number.
It's a huge amount of value just walking out the door.
And when you break it down by type?
So asset theft is the most common, about 85% of cases. Think skimming cash. The median loss there is around $130,000. But financial statement fraud, manipulating the books, is far less common, less than 9% of cases. But it has the highest median impact, $1 million.
$1 million. So the biggest risks in your RA need to focus there, even if the likelihood seems lower.
Exactly. And then you have corruption, bribes, and so on, with a median loss of about $200,000. But here are the stats that should really wake management up.
Okay.
80% of the people who commit fraud have no prior record.
Wow. So much for relying on background checks. These are trusted, long-term employees.
It forces you to realize that anyone is a potential risk if the triangle aligns. And what's more, in 58% of cases, there is no recovery. The money is just gone.
Which brings us to the auditor. We assume they are our primary defense, but you mentioned a really shocking figure about how often they find fraud.
It's disturbingly low. Only 3% of reported frauds are detected by the external auditor's procedures.
Only 3%?
Yeah.
Why? Isn't their job to find fraud?
Their job is to get reasonable assurance the financials are free of material misstatement. Their testing just isn't designed to catch collusion or every instance of theft.
So who does find it?
Most of it, 42%, is found through tips. From employees, suppliers, customers. Management and internal audit find about 14 to 16% each. The takeaway is just undeniable. Management has to take the lead.
Okay, so let's end this on a positive note. What actually works? What are the controls that the data shows really reduce fraud losses?
The data is very clear. Entities with these controls saw significantly less loss. At the top of the list, data monitoring, which cut losses by 60%. Employee support programs, 55% less. Management review, 52% less. And things like surprise audits and a fraud hotline cut losses by over 40%.
So the most successful things are the active internal continuous controls.
The last of the 4 RA principles, Principle 9, is all about assessing significant change. This was a specific addition in 2013 because, frankly, too many companies weren't doing it.
This principle exists to fight that auditor trap, SALE, same as last year.
Exactly. Business today is just too dynamic for that. Your internal strategy changes, you get a new IT system, the external environment shifts new regulations, a pandemic. Your risk assessment can't be a dusty binder on a shelf. It has to be a living document.
So how do you fight that staleness?
You need to build in techniques to challenge your own assumptions. Bring in a specialist for a brainstorming session, a fraud examiner, an IT security expert, or even just a senior person from another part of the business who can ask skeptical questions.
And there's also a risk in the documentation itself if it's too vague, right? Especially when people leave the company.
Oh, this is a massive systemic risk. Let's use your interest rate risk example. If the original RA document just says interest rate risk is low, What does that even mean to a new person reviewing it 2 years later?
They have no idea what the basis for that judgment was.
Was it low because assets and liabilities were perfectly matched? That's a solid reason. Or was it low because the CFO read an article where the Treasury Secretary said rates wouldn't change? If the basis is vague, you can't measure the impact of any future changes.
So the unclear documentation plus turnover, it becomes a source of risk all by itself.
It does. The assessment has to be supported by the evidence that was considered. Otherwise, it's just an opinion, and opinions are not a control.
Okay, let's circle back to the very beginning of the process. Principles 6 and 7. Specifying objectives and identifying risks. They're totally intertwined.
Absolutely. If you don't clearly state your objectives, you are guaranteeing that you will miss risks.
So what are the high-level goals for financial reporting objectives? Principle 6.
Broadly, it's things like fair presentation, following gap, timeliness, and from FASB we get concepts like faithful representation and verifiability.
And verifiability seems like it's gotten so much harder now.
It's a core tension point.
Yeah.
In the old historical cost world, verifying a number was easy. What did we pay for it? But now, with fair value accounting, we're using subjective models. Fair value might be more relevant to an investor, but the higher subjectivity definitely increases the inherent risk.
And it seems like generic objectives like just adhere to GAAP aren't very helpful.
They're not. They lead to generic risk assessments. You need specificity. So instead of just complete financial reporting, a better objective might be to ensure all required non-financial SEC disclosures are made while structuring them to avoid revealing proprietary competitive information.
Okay. That immediately creates a whole new risk to consider, the risk of over-disclosing.
Exactly. Or for a nonprofit, an objective might be to reflect our stewardship of funds to attract new donors. That connects operations directly to financial reporting and fundraising.
And Principle 6 has 15 points of focus. We don't need all 15, but how does COTESO categorize them?
They're grouped into 5 big buckets. There's management's choices and tolerances, then compliance with standards of materiality.
So management's attitude and then the rules.
Right. Then there's external non-financial reporting, things like sustainability reports, internal reporting for management's own decisions, and finally, compliance objectives for all the non-financial laws and regulations.
So CSO really wants the RA to see how all these things can eventually create financial statement risk.
Mm-hmm. If you have a high-risk tolerance in operations, that might lead to more product failures, which hits your warranty reserve, which is a financial statement estimate. It's all connected.
And once you have the objectives, you move to Principle 7, identifying risks. Where does that start?
It has to involve all levels of the company. Entity-wide, subsidiary, functional. You need formalized brainstorming sessions with the right people in the room. You can't just delegate this to the corporate accounting team.
And what are the internal things that should immediately scream higher inherent risk?
You should always flag a large number of financial statement estimates, any significant use of fair value, and any material-related party transactions.
And from the outside, what do regulators like the PCAOB tell us to look for?
They have a list. The size of the account, its susceptibility to fraud, the volume and complexity of transactions, the complexity of the accounting rules, and exposure to contingent liabilities. This is a very holistic view. #B, compliance risks, external factors.
Let's focus on one of the most volatile external risks, compliance. The speed of new regulations just seems to be accelerating.
It's an urgent environment. The penalties for violations are significant. If you fail to identify these compliance risks, you can quickly end up with a material liability that needs to be disclosed.
Can you give us some real-world examples of how complex this got for companies?
Yeah, if you look back at 2013, 2014, companies were trying to track things like the Nuclear Iran Prevention Act, the Syria Transition Support Act, and then a whole bunch of sanctions related to Russia and Ukraine.
That is incredibly specific and fast-moving legislation. A company needs constant legal advice just to know if a shipment is suddenly illegal.
Absolutely. And that highlights the need for ongoing monitoring, not just an annual assessment. And then, of course, there's the ever-present risk of the Foreign Corrupt Practices Act, the FCPA.
Investigations there seem to be on the rise.
They are. Your RA has to pay very close attention to differing ethical environments around the globe, and you have to understand the local terminology.
Right, the code words that are used to obscure bribes.
Exactly. In China, it might be a red card. In India, a request for tea and water. In Brazil, it could be chocolate or flowers. Your RA has to identify the high-risk countries and transactions where this stuff is common.
And how could a global company benchmark that kind of risk?
A really valuable tool is the Corruption Transparency Index from Transparency International. It ranks countries by perceived corruption.
So if you operate heavily in countries at the bottom of that list, like Afghanistan or Somalia, your inherent risk for fraud and compliance has to be assessed as critically high.
Without question. And if you're only in places like Denmark or New Zealand at the top of the list, your risk might be lower. It gives you concrete data to support your risk assessment. Hashtag 2IC, gathering and corroborating evidence.
So we've stressed this isn't a paper exercise. Let's talk about actually gathering the evidence to make the RA defensible.
Right, you have to move beyond checklists. COSO asks, how does the entity achieve this principle? And the answer requires documented, evidence-based judgment.
What are some of the internal and external factors that should be discussed and documented every time?
Internally, you should be talking about personnel changes, management's philosophy, changes to IT, any recent business process issues, and any problems you had in prior reports.
And externally?
Competitive issues, the regulatory environment, economic trends, new technology, social trends, political developments, all of it can have financial reporting implications.
And the most important step after talking about it is corroboration. Auditors can't just take management's word for it anymore.
And management shouldn't either. If the CFO says mortgage repayment rates are stable, that needs to be backed up. Did you look at industry stats, market data, competitor filings? The documentation has to note the evidence you looked at.
Okay, last point here. Documentation format. We said matrices are good, but how do we keep them from being too ambiguous?
The key is defining your terms. If you use high, medium, low, you have to define what that means. Is high likelihood over 70% probability? Is high magnitude anything over $10 million? Without definitions, high risk to one person can mean something totally different to another.
But if you do it right, the benefits of a well-documented RA are huge.
They're critical. It provides support for auditor reliance, which means fewer procedures. It helps new people understand why decisions were made. And most importantly, it flags the key issues that management and the board need to be focused on right now. Hashtag tag outro ability.
This has been a really extensive deep dive. If we boil it all down, the core idea is that effective risk assessment is the foundational filter. Everything else, every control, every report, is scoped and justified by this initial assessment.
And the evolution of the framework to specifically call out velocity, persistence, fraud, and change, that just reflects the reality of the modern business world. You just can't afford to run a same as last year process anymore.
And for companies still trying to move from the older frameworks, it seems like the big challenge is just mapping what they already have to these new principles.
It is. The 2013 principles were really designed to find the gaps. Your first step has to be a gap analysis. You'll quickly find holes, especially around technology and change assessment, that you have to actively go and fill.
A daunting but necessary first step. So as we wrap up, let's leave our listener with one final thought to consider.
We noted that material weaknesses often show up as failures in control activities, so it can be hard to pin one on the RA component itself. But think about this.
Okay.
If an entity's risk assessment process fails entirely to even consider a known, quantifiable risk like the median $1 million loss from financial statement fraud or the catastrophic risk of a cyber attack, does that foundational failure indicate a lack of stewardship by management, or is it just a gap in their documentation?
A difference between competence and compliance.
I think so. You need to ensure your RA is not just a checklist, but a living, thoughtful assessment that shows active, informed stewardship. Because failing to identify a risk is the only way to guarantee that you will never have a control for it.
An exceptionally important point to end on. Thank you for guiding us through this with so much detail and clarity.
My pleasure.
That's it for this deep dive. We'll catch you next time.
Okay, let's unpack this. Welcome back to the deep dive.
Today, we are really pulling back the curtain on something that is, well, it's one of the most critical elements of corporate governance and financial stability.
We're talking about the design and, maybe more importantly, the execution of anti-fraud programs and internal controls.
Exactly. This is, it's the absolute bedrock of corporate trust.
That's so true. And I think we as, observers and professionals, we often have this assumption that the big, sophisticated organizations, the ones with huge budgets and global reach, are somehow impenetrable.
Like they're fortresses of financial integrity.
Right. We just assume their checks and balances are perfect. But the reality, and we see it in the headlines all the time, is that they are constantly and often surprisingly vulnerable.
And we're not just talking about one kind of risk here. It's a huge spectrum.
A massive spectrum. It can be anything from minor employee theft, asset misappropriation that just slowly erodes profits over time, all the way up to, well, all the way up to the kind of material manipulation of financial reporting that can literally implode a company overnight.
And that vulnerability is precisely why this coalition of leading professional organizations came together. We're talking about the AICPA, the Association of Certified Fraud Examiners, the ACFE Financial Executives International, and the Institute of Internal Auditors.
So all the heavy hitters.
All of them. They came together to formalize guidance on this. And this guidance, which was developed right alongside standards like SASTO 99, isn't just theory. It's a detailed operational roadmap for management.
So it's the how-to.
It's the how-to. It outlines exactly what organizations need to do to establish a climate that actively deters, prevents, and if necessary, detects fraud at every single level.
And our mission today is to cut through what can be some pretty dense consensus guidance and deliver the key takeaways directly to you. If you want a shortcut to understanding what the gold standard looks like for preventing financial malfeasance, well, this is your deep dive.
We're going beyond just the checklist.
Yeah.
We're looking at the architecture of integrity itself.
And to really understand that architecture, I think we have to start with where fraud risk even sits within the bigger picture, the global standard for internal controls.
Right. We're talking about the COSO framework, the Committee of Sponsoring Organizations of the Treadway Commission.
Which is pretty much the gold standard for internal control, generally speaking.
It is. And what's so fascinating here is how fundamentally fraud risk is woven into that framework. The COSO structure defines 5 interconnected components of internal control.
Okay, so that's the control environment, risk assessment, control activities.
Information and communication and monitoring activities, all 5.
And I think a lot of people, when they hear fraud, they immediately think it only applies to that third component, control activities. Things like, did we segregate duties properly?
That's a common mistake. But COSO is really explicit about this. It includes fraud risk as a dedicated principle within its second component, risk assessment.
So it's baked in right from the beginning.
It has to be. That linkage means you literally cannot perform a proper risk assessment, which is a fundamental requirement of modern controls, without explicitly evaluating your vulnerability to fraud.
And because those 5 components are all interconnected.
Fraud doesn't just sit in that one silo. The control environment, which is really the ethical culture, that's the foundation for everything. And monitoring activities are essential for catching controls that have been overridden by management. It touches everything.
So we're not just talking about putting a simple lock on the cash register. It's more like a comprehensive security architecture that spans the entire building, structurally and, I think most importantly, culturally.
That's a perfect analogy.
Sure.
And the foundational guidance we're reviewing today structures this whole anti-fraud effort around 3 fundamental interconnected elements. If an organization can get these 3 things right, they've significantly minimized their exposure.
And those 3 elements, which will really define our discussion today, are the pillars of this anti-fraud architecture.
First, creating a culture of honesty and high ethics. That is your essential preventative layer.
Okay, prevention first.
So that evaluating the risks and then implementing the controls to deal with them. That's your detective and mitigation layer.
And third?
Third is developing an appropriate oversight process. That's your accountability layer, the part that ensures the first 2 are actually working as intended.
Okay, so let's unpack this a bit. Before we jump into the details of that culture piece, let's just tackle a really pragmatic question. Fraud, by its very nature, it involves concealment, right? And often collusion.
Which makes it incredibly difficult to detect once it's already happening.
Exactly. It's difficult and it's expensive. So why is prevention and deterrence the primary focus of all this guidance? Shouldn't we just be investing more heavily in, sophisticated detection technology?
It's a great question, and the answer is purely pragmatic, even though the results are deeply ethical. Prevention and deterrence measures are just. They are vastly less costly than the time, the expense, and the pure chaos that's required for fraud detection.
And that's before you even get to the investigation.
Oh, absolutely. Think about the whole life cycle cost. You've got the detection, the investigation, then potential litigation, recovery efforts, remediation of the controls. It's a massive drain.
Not to mention the reputational hit.
That's the killer. If you can stop the fraud from ever happening, you avoid not just the dollar loss, but also the inevitable reputational damage, the disruption to your operations, and the complete collapse of employee morale. It is an investment in organizational health that pays for itself many, many times over. The guidance is crystal clear on this. Stopping it before it starts is always the superior strategy.
That makes perfect sense. Stop it at the source. Which brings us right to our essential first line of defense. Section 1, creating a culture of honesty and high ethics. This is that preventative layer.
And the source material here starts with a really strong philosophical foundation. It says the most effective way to reduce wrongdoing is by basing all your measures on a core set of values that are embraced by the entire entity.
So it's not about rules first, it's about values first.
That's the critical insight. Knowledge is most valuable when it's understood and actually applied. These core values, things like integrity, transparency, accountability, they serve as the overarching philosophical message that guides every single employee's actions, especially when they're facing decisions that aren't explicitly covered by a policy manual.
I see. So a detailed code of conduct can only be truly effective if it's standing firmly on this foundation of shared integrity?
Exactly. Without that foundation, rules just become obstacles to be navigated or, loopholes to be found.
And this naturally brings us to what is probably the most discussed, and you could argue, the most important concept in this whole anti-fraud architecture.
Setting the tone at the top.
Setting the tone at the top.
Absolutely. The behavior of directors and officers is what sets that ethical tone. Honesty, all the research suggests, is best reinforced when a proper, visible example is set. It's simply not enough for management to say they support integrity.
They have to live it.
They have to live it. In large organizations, where most employees will never interact directly with the CEO or the board, management has to not only behave ethically, but they have to openly and repeatedly communicate those expectations through their words, their actions, and maybe most importantly, through their consistent decision-making.
So this means demonstrating explicitly and visibly that dishonest or unethical behavior will not be tolerated.
Even if that behavior might have benefited the entity in the short term. That's the key.
Right. It's about conveying a true zero-tolerance policy for unethical conduct, regardless of who the employee is or how much revenue they brought in last quarter.
And here is where it gets really, really interesting. Because the guidance highlights a crucial and very subtle pitfall that trips up so many ambitious companies.
Okay.
Management must actively avoid setting unachievable goals.
Ah, the classic fail or cheat dilemma. We see this play out in almost every single major financial scandal. There are always aggressive growth targets meeting aggressive deadlines.
Precisely. When senior management pushes for targets, whether it's quarterly sales figures, earnings per share goals, or production quotas that are just impossible to meet through legitimate means, they unintentionally create this environment of intense pressure.
And that pressure leaves employees with those two very unattractive choices you mentioned.
Fail to meet the target and face the consequences. Job loss, denied bonuses, public shaming, or cheat the system to meet the target. This psychological pressure is the perceived motive that combines with the perceived opportunity in the classic fraud triangle model.
So if a sales VP realizes they need to hit, say, 120% growth this quarter, but they know deep down the product pipeline only supports 105%, the pressure to do something like channel stuff.
Pushing inventory to distributors with overly generous return policies just to book the revenue early.
That pressure becomes enormous.
That's a perfect illustration. So the correct message from the top has to be meticulously crafted. It has to say something like, we are aggressive in pursuing our targets while requiring truthful financial reporting at all times.
That second clause is the non-negotiable part.
It has to be. Integrity is the boundary condition for ambition.
So moving from these abstract values, how do organizations translate that ethical posture into something usable, something concrete? That's where the code of conduct comes in.
The code of conduct is the essential tool for that. It reflects the core value system, and it provides specific guidance for daily decision-making. But, and this is a big but, it needs to be more than just a legalistic document that sits on a shelf.
Right. It can't just be something HR makes you sign on day one and you never see it again.
Exactly. It must be communicated in an understandable way, using clear language and realistic scenarios. And crucially, the guidance suggests it should be developed in a participatory, positive manner.
To get buy-in.
To get real ownership from both management and employees. If people feel like they contributed to the principles, they're much more likely to actively defend them.
And what's the required scope for a good code? Does it really just focus on finance and accounting?
Not at all. The scope has to be comprehensive because fraud takes so many different forms. A robust code covers general ethics, confidentiality clauses. It gets deep into conflicts of interest, especially around related party transactions, intellectual property protection, harassment policies, and of course, explicit detail on fraud, corruption, bribery, and other illegal acts.
I found the part in the source material about the elevated role of senior financial officers to be particularly significant. Why do they hold such a unique ethical weight in all this?
Their role is unique because they sit right at the intersection of operational ambition and financial truth.
That's a great way to put it.
They're part of the management team, so they're tasked with achieving corporate goals. But they are also uniquely empowered to balance, protect, and preserve the interests of all stakeholders, not just the internal goals set by the CEO. We're talking shareholders, creditors, employees, the public.
So they have a higher duty, in a sense.
They do. That position demands an even higher degree of professional skepticism and, frankly, ethical courage. They are the primary gatekeepers of financial integrity.
Beyond the codes and the tone, the physical and emotional environment itself acts as this massive deterrent. Or, on the flip side, a massive opportunity for fraud. The guidance really emphasizes creating a positive workplace environment.
And this isn't just a soft factor. Research consistently shows that wrongdoing occurs significantly less frequently when employees feel positive, valued, and respected. Morale is a powerful anti-fraud control.
Because if an employee feels wronged or ignored or just disposable,
The rationalization part of the fraud triangle, the company owes me this thought process, becomes so much easier to justify.
So let's break down the tangible factors that actively detract from a positive environment and therefore increase fraud risk. What are the red flags management should be looking for in their own operations?
You're looking for signs of systemic distress and unfairness. Top management that fails to visibly care about or recognize appropriate behavior is a massive one.
A lack of
The
recognition.
consistent lack of recognition, perceived inequities in how policies are applied, especially discipline or promotions, autocratic command and control decision-making, or, and this is perhaps the most dangerous in a reporting context,
Yeah.
a fear of delivering bad news up the chain of command.
Oh, that's a big one.
It's huge. If your employees hide mistakes because they fear reprisal, you can be certain they will hide fraud for the exact same reason. Low organizational loyalty, unreasonable budget expectations, poor top-down communication, they all feed into this perception of vulnerability.
And on the other side, what are the mitigating factors? What concrete steps can management take to build that trust and loyalty?
It really involves creating systems that are transparent and fair.
Yeah.
Your recognition and reward systems have to align clearly with goals and results, not just favoritism.
Objective, not subjective.
Right. Equal opportunity and professionally administered compensation and training programs are essential. But fundamentally, it comes down to trust. Moving toward team-oriented, collaborative decision-making, where employees feel like they have input and are actually empowered.
And speaking of empowerment, that brings us to the communication channels. How do employees report concerns? They need ways to get advice internally on legal or ethical decisions, but they also have to be actively encouraged to communicate concerns about potential violations, especially fraud.
And this reporting mechanism, it absolutely must be confidential and anonymous if the employee chooses that. The guidance specifically mentions using confidential telephone hotlines or similar secure electronic mechanism.
And the design of that system is critical.
It is. It has to be monitored by a trusted, empowered individual, maybe an ethics officer, the general counsel, or the internal audit director. Someone who has the authority and the independence to investigate and report incidents without fear of being sidelined or shut down.
Because the fear of retribution, especially if the suspected fraud involves high-level management, that has to be the #1 reason these systems fail.
Precisely. If an employee sees a colleague use the hotline, and then a month later that colleague gets demoted or fired for some trumped-up reason, the entire system is neutralized as a deterrent. It's worse than having no system at all.
So management has to continually demonstrate and communicate that there is zero tolerance for retaliation against whistleblowers.
They have to reinforce that reporting concerns is an act of organizational loyalty, not disloyalty.
Here's where we move from the high-level philosophy into, really, the actionable implementation. We've established the high-level values and that crucial tone at the top. Now, how does the entity move from that abstract commitment into practical day-to-day procedures that actively minimize the opportunity for fraud?
And that's what Section 2 is all about. Practical policies hiring, training, confirmation, and discipline. It starts with the very first gatekeeping function, hiring and promoting appropriate employees.
This is critical because, as we know, the individual threshold for dishonest behavior varies so widely from person to person.
It does. So your policies have to be rigorously effective at minimizing the chance of bringing individuals with low levels of honesty into positions of significant trust in the first place.
So we need proactive procedures that go way beyond just the standard HR paperwork.
Indeed. This requires rigorous, well-documented background investigations. We're talking about thoroughly checking education, verifying every single job in their employment history, and actually contacting personal and professional references.
Not just collecting the names.
Actually calling them and asking probing questions. It's about building a comprehensive understanding of the character and prior conduct of the person you're about to place in a position where they'll handle sensitive assets or financial data. A gap in their employment history or an inability to verify a degree should be a major red flag that triggers much deeper scrutiny.
And the guidance suggests a really powerful and I think somewhat surprising step for ongoing diligence. It's not just about when you hire them.
That's right. For employees who remain in the most sensitive positions of trust, think about treasury functions, high-level accounting, senior procurement officers, some organizations consider periodic follow-up background investigations.
So rechecking them every few years.
Maybe every 3 to 5 years. And the question is why? Well, an individual's circumstances and their financial pressures can change dramatically over time. Someone who was financially secure 5 years ago might now be experiencing significant personal debt from, say, a divorce or a gambling problem, creating a motive for fraud that didn't exist before. A regular review just acknowledges that risk and helps maintain the integrity of that role over the long term.
Okay, so once that person is hired, they need comprehensive training and awareness. And I'm guessing this isn't just a compliance module they click through once and forget about.
Not at all. New employees must be robustly trained on the entity's values and its code of conduct. And the training has to be very explicit. It needs to cover 3 specific areas identified in the guidance.
Okay, what are they?
First, the employee's fundamental duty to communicate certain matters. You have to make it clear this is a mandatory responsibility of their job.
It's not optional.
It is not optional. Second, a clear, illustrated list of the types of matters that need to be communicated. This should include actual or suspected fraud, with specific, relatable examples of what that looks like in practice in their department. And third, detailed information on how to communicate those matters. The hotline, the ethics officer, internal audit. They need to know the specific channels.
That clarity is just so key. If the training is too vague, employees just won't know where the line is or what to do when they see someone cross it.
And the tone of the training is equally vital. It should be positive, focusing on building awareness and integrity. But it still has to clearly stress the massive costs and detriments of fraud, not just to the company's bottom line, but to the employees who lose their jobs and to the community the company serves.
And this needs to be continuous, not a one-and-done event at orientation.
Absolutely. Periodic refresher training is required. And it has to be tailored by level, by location, and by responsibility. The training a senior manager gets on complex revenue recognition needs to be very different from the training a purchasing agent gets on kickbacks and conflicts of interest.
The risks are different, so the awareness has to be targeted.
Exactly.
Okay, the next key mechanism is confirmation and accountability. This feels like where the cultural commitment moves into a binding annual requirement.
This is where management really articulates accountability in a formal, almost legalistic way. Senior management, the entire finance function, and any employees in high-risk areas, procurement, sales, marketing, should be required to sign a code of conduct statement annually, at a minimum.
Now, I can hear a skeptical listener thinking, doesn't requiring an annual confirmation just create more paperwork? How does signing a piece of paper actually deter someone who is already committed to committing fraud?
That's a highly fair challenge. And the power of this confirmation lies in its specific detail. It goes way beyond just signing a paper saying you read the rules.
How so?
This confirmation often requires the individual to state, in writing, 3 things. That they understand the entity's expectations, that they have personally complied with the code during the year, and this is the most important part, that they are not aware of any violations other than those they specifically list in their response.
That distinction changes everything. It's not just a passive compliance statement, it's an active disclosure requirement.
Exactly. Now, an individual with deeply low integrity might sign a false confirmation regardless. But the vast majority of people, even those with minor ethical lapses, are extremely hesitant to make a demonstrably false statement in writing that could be used against them later in an investigation.
And for the honest employees.
For them, this confirmation process provides a structured, safe way to disclose known exceptions. Maybe it's a potential conflict of interest. Their spouse just started working for a major supplier that they weren't sure how to handle. Or a minor policy deviation they want to bring to light. It brings issues out into the open that would otherwise fester in the dark.
And I imagine the follow-up process on those disclosures is just as critical as the signing itself.
Oh, absolutely. Internal audit or the ethics committee has to thoroughly follow up on any exceptions listed. And even more telling, a thorough follow-up on the non-replies. The employees who just refuse or forget to return the confirmation, that can often uncover significant underlying issues. It makes this a powerful, proactive detection tool, as well as a deterrent.
And finally, we get to the entity's response. Discipline as deterrence. The reaction to an alleged or suspected fraud sends the loudest possible message about what the true tone at the top really is.
Consistency here is absolutely vital. When an alleged incident occurs, management cannot waver. A few actions are required immediately. First, a thorough, professional investigation has to be conducted.
And that often requires specialists.
In larger organizations, yes. You bring in certified fraud examiners or CFEs to ensure objectivity and follow proper legal and procedural steps. Second, appropriate and crucially consistent disciplinary actions must be taken against the violators, regardless of their position or seniority.
So you can't fire the mailroom clerk for stealing postage stamps, but just give the VP a slap on the wrist for manipulating sales numbers.
Precisely. That kind of inconsistency destroys the integrity of the entire anti-fraud program. And third, you have to assess and improve the relevant controls to close whatever loophole allowed the fraud to happen. And fourth, you have to actively reinforce the entity's values and expectations through communication and refresher training.
The real power of discipline, then, comes from communicating the consequences. It increases the perceived likelihood of getting caught.
Exactly. The guidance understands this psychological element perfectly.
But how do you communicate those consequences without creating a toxic or overly accusatory work environment?
The guidance suggests a very specific, very clever communication strategy to maximize deterrence. It can be extremely helpful to communicate that an employee was disciplined for wrongdoing, but to do so on a no-name basis.
So you don't single anyone out publicly.
Right. You put it in a regular employee newsletter or an internal communication bulletin. The message is simple and clear. Misconduct was identified, an investigation occurred, and consistent disciplinary action was taken.
That allows the organization to reinforce the zero-tolerance message without violating privacy or starting a witch hunt. It just increases the perception that the entity is actively catching and punishing misconduct.
Correct. Seeing that others have faced real consequences, even anonymously, reinforces the message that the controls are effective, the vigilance is real, and the ethical standard is absolutely non-negotiable. That reinforces the deterrence message far more effectively than any abstract policy statement ever could. If we connect this now to the bigger picture, we transition from culture and policy into the operational mechanisms. This is Section 3. Evaluating anti-fraud processes and controls, what we're calling the detective layer.
Right. As we established, fraud requires a perceived opportunity, so management has to be proactive in reducing that opportunity.
By formally assessing risks, mitigating them, and rigorously monitoring the controls they put in place.
And management has the primary, non-delegable responsibility for this risk assessment. When they look at fraud risk, what factors must they be considering to make that assessment truly comprehensive?
They need to consider the entity's vulnerability across all three major categories of fraudulent activity. Fraudulent financial reporting, which is falsifying statements, misappropriation of assets, which is just theft, and corruption, bribery, kickbacks, things like that.
So the assessment can't be narrow. It has to be holistic.
It has to be. It has to take into account organizational characteristics like complex structures or rapid growth industry norms, and even country-specific characteristics that influence the risk environment. For example, high levels of perceived public sector corruption in certain regions you operate in.
And this process can't be static, right? It's not something you do once a year.
Absolutely not. It requires a heightened ongoing fraud awareness for management and a structured dynamic risk management program. The program needs formal oversight from the board or the audit committee, but the detail of the assessment should be commensurate with the entity's size and complexity.
What about for smaller entities where things are less formal?
Even in smaller entities where formal procedures might be less codified, management has to consistently reinforce the awareness that fraud can happen. They have to be aware that almost any employee could commit fraud given the right combination of motive, opportunity, and rationalization.
So once those risks are identified, say cash handling risks in certain retail locations or maybe aggressive revenue reporting targets, the entity then moves to mitigating fraud risks.
And sometimes the best control isn't some complex procedure, but simply eliminating the opportunity entirely through a structural change.
That's the ultimate goal of mitigation, isn't it? Removing the weak link.
It is. If a certain business segment or a geographic location presents an unacceptable level of risk, maybe due to persistently high levels of internal control weaknesses or endemic corruption in the local market management, might choose the nuclear option.
Which would be?
Sell that segment, cease operations in that location, or fundamentally reorganize the business process to remove that specific risk exposure altogether.
Can you give us some specific structural examples of that kind of mitigation, something our learners can immediately relate to?
Certainly. Let's consider misappropriation risk, specifically cash theft. If an entity operates hundreds of retail branches, and each branch receives cash and checks that employees handle before they get deposited, the risk of localized cash skimming is really high.
Makes sense. Many hands, many opportunities.
Right, so to mitigate this, the entity might implement a central lockbox at a bank. Instead of having cash and checks received and processed by various employees at various locations, all payments are directed immediately and directly to a secure, centralized bank facility.
And that action just eliminates the opportunity for localized cash custody theft.
Because the employees never even touch the cash flow, the opportunity is gone.
Okay, that's a really clear reduction of opportunity in the assets realm. What about mitigating financial statement fraud risk? That's often more systemic.
That's often robustly addressed through the implementation of what are called shared services centers, or SSCs.
Okay, break that down for us.
Imagine a large corporation with multiple operating segments, segment A, segment B, segment C. Traditionally, each segment might have its own dedicated accounting staff who report locally to that segment's VP of operations or sales.
Which creates a massive conflict of interest because the accountant is reliant on the local VP for their performance review, their bonus, their promotion.
Exactly. If the local VP of sales for segment A is under pressure to hit quota, they can easily pressure their dependent accountant to, say, aggressively recognize revenue or inflate inventory values.
Yeah.
But if you implement a shared services center,
You centralize the accounting functions for all segments.
right, and now the accountants report instead to a central corporate chief accounting officer or controller.
So the physical and organizational insulation is vital. The pressure point is eliminated because the local operations manager has no direct authority over the accounting staff who are recording the results.
The independence is paramount. And furthermore, a centralized team is often in a much better position to implement extensive, consistent fraud detection measures and technological controls cost-effectively, reducing the vulnerability of the entire reporting process to influence or manipulation by local management.
So once those risks are mitigated structurally, we get to the real nuts and bolts of implementing and monitoring internal controls.
And an effective system here has to include a robust control environment, secure information systems, which includes both automated and manual controls over all data entry and computer-generated information, and appropriate control and monitoring activities.
And the controls have to be targeted, not generic.
Crucially, they must be targeted at areas you've already identified as higher risk, and they must cover the entire financial reporting process, including interim financial reporting. Fraudulent activities often begin with manipulating quarterly or monthly results to smooth things out.
Now, we absolutely have to talk about the systemic vulnerability in any control architecture, and that is the management override problem.
This is the critical fundamental weakness in any system. Upper-level management, the CEO, the CFO, the COO, they possess the unique ability to deliberately override established controls, or to influence, coerce, or collude with others to perpetrate or conceal fraud.
And this is why that strong value system, the zero-tolerance culture we talked about in Section 1, becomes so paramount.
It has to act as a fail-safe mechanism, right? Because that culture is what empowers lower-level employees to say no.
Exactly. That culture encourages employees to decline involvement in wrongdoing and to use those established anonymous communication channels to report high-level requests for or instances of wrongdoing. No matter how many policies you write, If the CEO tells the controller to violate GAAP, the only thing stopping it is the controller's personal integrity, which has to be backed by the company's visible commitment to protecting those who speak up.
And beyond that cultural defense, how do standard controls help detect fraud that's happening a little lower down the chain? Say, a division head or a mid-level manager manipulating their local numbers.
That lower-level management fraud is often detected through robust monitoring controls. This involved higher-level managers conducting periodic, independent reviews and evaluations of the financial results of individual units or subsidiaries.
And they should be looking for unusual or unexpected fluctuations in the reported results.
Right. If a unit suddenly shows massive unexpected revenue growth without a clear operational reason to back it up, that's a huge red flag.
But you mentioned earlier, and this is such a key point, the lack of expected fluctuations can be an even bigger red flag.
It's a more sophisticated sign of potential manipulation. If a subsidiary's reported earnings are suspiciously smooth, quarter after quarter, in an industry you know is volatile.
That might indicate deliberate smoothing or manipulation by departmental staff who are trying desperately to meet their targets and avoid the kind of volatility that would attract scrutiny from corporate.
So effective monitoring requires real skepticism and a deep understanding of the business context. It's not just about checking boxes.
Not at all.
We've moved from culture to controls, and now we arrive at our final pillar, section 4, developing an appropriate oversight process. This is all about accountability, and the watchdogs who are responsible for ensuring the entire system, from the culture to the controls, is actually effective.
And this oversight is comprehensive. It involves many internal and external parties, all operating under the ultimate supervision of the audit committee, or, if there isn't one, the full board of directors.
So let's start at the top layer of internal oversight, the audit committee and the board of directors.
Their responsibility here is just enormous. They have to evaluate management's entire anti-fraud program, the risk identification process, the implementation of specific anti-fraud measures, and the constant reinforcement of that zero-tolerance tone throughout the organization.
They're positioned as the ultimate internal deterrent to high-level fraud.
They are. And the guidance specifically focuses on their most critical responsibility, overseeing senior management itself, considering that ever-present risk of management override or collusion.
So how do they actually execute that oversight of the very people they supervise? It seems like a difficult position to be in.
Well, to fulfill this, they must receive periodic, detailed reports. And these reports have to cover the nature, the status, and the eventual disposition of all allegations of fraud or unethical conduct, regardless of the level of personnel involved.
So nothing gets swept under the rug.
Nothing. This demonstrates that the oversight process is continuously active and engaged. If they only receive reports on resolved issues, well, then they're being passively managed by the people they're supposed to be overseeing.
And what does this all mean for catching that really high-level fraud where maybe the CEO is involved? The guidance suggests a very deliberate, specific communication mechanism for the committee to bypass the CEO if they have to.
That's probably the most critical structural recommendation for oversight integrity. The audit committee has to establish an open line of communication with members of management who are 1 or 2 levels below senior management.
So people like the controller, the general counsel, or senior regional VPs, why that specific layer?
Because that mid-management layer is the most likely to be aware of high-level wrongdoing that's being perpetrated by the CEO, the CFO, or other top executives. They possess the knowledge, but they lack the direct reporting independence to challenge them. The committee must actively foster relationships with this layer to ensure a reliable, confidential channel exists when the top is compromised.
And to perform this function correctly, the committee members themselves have to be highly qualified, which brings us to the financial expert requirement.
Yes, not only must all members be financially literate, but at least one member must possess specific, deep expertise. This is a highly detailed requirement, and it's intended to ensure the committee has the technical horsepower to really scrutinize complex transactions and challenge management's estimates.
And the financial expert has to possess 3 specific areas of understanding and experience. Let's really detail those.
Okay, first, they must have a deep technical understanding of generally accepted accounting principles, GAAP, and the rigorous standards for audits of financial statements prepared under those principles. This is the foundational knowledge of financial architecture.
Okay, that's essential table stakes. What's the second area of required experience?
Second, and this is very specific, they must have experience in the preparation and the auditing of financial statements of an entity of similar size, scope, and complexity to the company they are overseeing.
Now, why the emphasis on similar size and complexity? Why isn't being the CFO of a small private company enough experience for the board of a massive multinational?
Because that specific experience, which is typically gained as a CFO, a corporate controller, or an external audit partner for a similar firm, provides them with the necessary contextual understanding of the transactional and operational environment that actually produces the financial statements. They understand the difference between a simple accrual and a complex multi-jurisdictional tax provision.
So they understand the context behind the numbers.
Exactly. The context behind critical accounting estimates, reserve provisions, and most importantly, what it realistically takes to maintain a complex internal control environment day to day. They can spot manipulation or weakness not just based on accounting theory, but based on their deep operational knowledge.
And the third requirement focuses on the act of oversight itself.
Correct. Third, they must have experience in the internal governance and procedures of audit committees. They get this either by having served as an audit committee member before, by having been a senior corporate manager who answered directly to the committee, or by serving as an external auditor, reporting the results of annual audits. This just ensures they know how the oversight machinery is supposed to function.
Okay, moving down the organizational chart, management's role in oversight isn't just about internal monitoring. It also involves critical external communication about control.
Precisely. Public companies have to formalize this acknowledgement. They include a statement in their annual report, often called a management report or management certificate.
And what does that say?
In that statement, management formally acknowledges their specific responsibility, not only for preparing the financials, but also for establishing and maintaining an effective system of internal control over financial reporting. This public acknowledgement increases their accountability and clarifies the respective roles of management and the independent auditor for the public.
Next up, we have the internal auditors. They serve a very specific dual role here in both detection and deterrence.
They are absolutely critical for evaluating control adequacy across the entire entity. The Institute of Internal Auditors, the IIA, has standards that state clearly that internal auditors must have sufficient knowledge to identify indicators of fraud, the symptoms, the red flags, but they are not expected to possess the highly specialized forensic expertise of a certified fraud examiner whose primary job is criminal investigation.
So they're like the general practitioners of control health, looking for systemic flaws.
That's a great way to think about it. And their audit plans are risk-driven. The IIA standards mandate that their annual risk assessment must serve as the foundation for their audit plans, which then have to be formally approved by the audit committee.
And their specific activities.
They're assessing whether the environment fosters control consciousness, whether management's goals are realistic, if clear written policies describing prohibited activities actually exist, and whether those internal communication channels, the hotlines, are reliable and trusted.
And critically, their structural independence has to be guaranteed by their reporting line.
Absolutely essential. Internal auditors must have an independent, direct reporting line to the audit committee. This structural separation is the only way to ensure they can report any serious control concerns or suspicions involving senior management without fear of retribution, obstruction, or interference from the very management team they are auditing.
And finally, we bring in the external parties, the independent auditors, the external accounting firm, and the certified fraud examiners, or CFEs. How do the independent auditors contribute to this oversight process when it comes to fraud?
Independent auditors assist primarily by providing an objective assessment of the entity's process for identifying, assessing, and responding to fraud risks. Under professional standards like SAS number 99, they are required to maintain an attitude of professional skepticism and engage in open, candid dialogue with the audit committee about management's fraud risk assessment process and the overall susceptibility of the entity to fraud.
So they're not conducting a forensic fraud investigation.
No, but they are required to look critically at the machinery of the anti-fraud program itself.
And what about the specialized expertise of the certified fraud examiners?
CFEs provide that deep, objective expertise that is often not available internally. They're brought in for very specialized roles. They can offer critical, objective input into risk evaluation, especially concerning management fraud, and help develop sophisticated controls that are less vulnerable to management override. And most notably, they are the professionals who conduct the actual forensic examinations to resolve allegations.
And who do they report to?
It depends on the level of personnel involved. They might report to senior management, or if high-level executives are suspected, they report directly to the audit committee or the board of directors.
This has been an incredibly deep dive into really the architecture of corporate trust. We've meticulously explored the three pillars of a robust anti-fraud program.
Starting with that essential culture and the ethical tone at the top.
Then moving through concrete policies and controls, detailing the strategic benefit of systems like a central lockbox or shared services centers to eliminate opportunities.
And finally, detailing the necessary oversight structure provided by qualified audit committees, internal auditors, and those specialized external experts.
We've really seen that the critical role of the tone at the top just cannot be overstated. When management sets those unachievable targets, it forces that impossible fail or cheat decision on employees.
But conversely, when management communicates that discipline for wrongdoing is consistent and visible, even when it's done anonymously, it radically increases the perceived certainty and likelihood of punishment. And that's the cornerstone of effective deterrence.
Now, our source material, the definitive guidance endorsed by all these major professional bodies, it highlights one crucial concluding thought for any conscientious professional in this field.
It says that management is responsible for implementing these prevention and detection systems, but, and this is the important part, because of the inherent characteristics of fraud, namely concealment, collusion, and the unique ability of high-level management to override controls, a material misstatement may occur, notwithstanding the presence of even the most robust programs.
This raises a really important question for you, the learner, to carry forward and mull over.
If even the most robust systems, built on global best practices and reinforced by structural controls, are inherently vulnerable to concealment and management override, how does a conscientious professional move beyond simple compliance checklists to truly foster a workplace where the ethical cost of committing fraud just completely outweighs any perceived benefit?
It demands building integrity so deeply into the organization's DNA that the emotional, reputational, and professional price of misconduct simply becomes too high to pay, regardless of the potential financial gain.
Something profound to explore on your own.
If you want to review the full details of this essential guidance, we really encourage you to look at the materials published by the organizations that issued it jointly: the AICPA, the ACFE, the FEI, and the IIA.
Until next time, stay curious and stay informed.
We'll see you on the next deep dive. Welcome back to the deep dive. Today we are taking a fascinating and, frankly, often brutal shortcut through the world of organizational integrity.
We really are. We're synthesizing a whole stack of sources, these,
Yeah.
high-minded rule books that companies hand out to every new employee.
And we're crashing them directly into the grimy reality of the specific financial schemes, the failures that actually happen and undermine those very rules.
It's such a necessary deep dive because the contrast between those two worlds is, it's just shocking.
Wow.
When you look at the source material we have today, and it spans everything from these detailed corporate codes of conduct to the precise frameworks that auditors use for fraud risk assessment, you are literally looking at the organizational ideal versus the human tendency toward, well, catastrophic failure.
Exactly. Our mission today is to give you the knowledge to move beyond that general sort of vague awareness. We want you to understand not just that fraud happens, but how it happens.
And maybe more importantly, why the formal controls so often fail.
Yes. We're going to unpack three core areas: the rule book, which is the code of conduct, then the elevated standard for senior management, the FEI ethics guidelines, and finally, the actual anatomy of failure you find in these fraud risk assessment frameworks.
And you have to remember the context for these sources is critical. This isn't just, abstract ethical theory.
Not at all.
This material is drawn directly from the governance and compliance standards that are meant to govern multi-billion-dollar organizations. By dissecting them, we can see the incredibly high bar that's set for professional conduct.
A bar that is constantly being challenged.
Constantly. Challenged by employees using very specific and often audacious schemes to just bypass it. Our goal is to connect the smallest, most seemingly innocuous workplace behaviors, the ones the code prohibits, to these massive multi-million-dollar failures that the fraud triangle predicts.
That sounds like the journey from the perfect document to the perfect crime. So let's start with that ideal. Let's unpack the first pillar, the organizational code of conduct. What's the fundamental non-negotiable standard that the ideal organization demands?
Well, it all starts with the absolute legal foundation: compliance. Every single employee, regardless of their rank or department, must comply with all applicable laws and regulations.
Okay, so that's the baseline, the entry ticket to employment.
It is. If you're operating a machine, driving a company car, or filing a tax return, you have to adhere to the law, period.
But what stands out immediately in these codes is that they raise the bar right away. It's not just about legality.
No, and that's where it gets really interesting. The organization states clearly that business conduct must be well above the minimum standards required by law.
So it's creating an ethical compass, not just a legal dictionary.
That's the perfect way to put it. This is the difference between operating within the letter of the law and operating within the spirit of integrity. They're setting a moral standard, not just a legal floor.
Because they know that if you're constantly looking for a loophole, you're already in a dangerous place.
You're already on the wrong path. And they make it crystal clear what they mean by prohibited results.
What kind of things are they calling out specifically?
The prohibition is broad and it's absolute. The organization will not condone results achieved through violation of law or unethical dealings. They specifically forbid illegal acts, indirect contributions, rebates, and crucially, bribery.
And the standard for all actions, this is the part that I think is so powerful, is that they have to be able to stand the closest possible public scrutiny.
That is the ultimate ethical litmus test, isn't it? If you wouldn't want your action plastered on the front page of the Wall Street Journal with your name attached.
Then you shouldn't be doing it.
Exactly. But what happens if an employee genuinely hits a gray area? The code seems to build in a safety valve, so ignorance can't be an excuse.
Right, there's a process.
A mandatory escalation process. If an employee is uncertain about the application or interpretation of any legal requirement, even a minor one, they must refer the matter to their superior.
And if the superior doesn't know,
then it gets escalated further, up to the legal department. It's a deliberate process designed to prevent anyone from making a mistake and then claiming, oh, I just didn't know the rule. It pushes the responsibility for getting clarity right up the chain.
okay, so moving from that external legal world to the internal culture, these codes are surprisingly detailed about general employee conduct and the workplace environment.
They are. They expect employees to conduct themselves in a business-like manner.
Yeah.
And a lot of people might see that as just corporate fluff.
But it connects directly to the overall control environment, doesn't it?
It absolutely does. The sources get very granular about what's unacceptable, precisely because those behaviors erode the professional culture and, they signal a lack of internal control.
Like what, specifically?
They strictly prohibit drinking, gambling, fighting, swearing, and similar unprofessional activities while on the job.
Why, though? What's the real risk of someone swearing in the break room?
Because these behaviors introduce chaos and distraction. If management tolerates employees, say, gambling in the break room, they are implicitly signaling that minor rules don't matter. And that signal, well, it very quickly translates into opportunities for major breaches.
It's the broken window theory of fraud risk. You let the small things slide, the big things are sure to follow. And speaking of strict prohibitions, the section on sexual harassment seems to be the most absolute in all these codes.
It has to be. And the rule isn't just a prohibition against overt harassment. It's against any conduct that could be construed as such.
That's a very powerful and, I'd say, protective definition.
It is. It includes using inappropriate language, keeping or posting inappropriate materials in your work area, or even accessing inappropriate materials on the company computer.
So it puts the responsibility on the employee to make sure their conduct is perceived as professional by everyone.
Exactly. By all colleagues, not just based on their own interpretation. It means you have to self-police everything from your desktop background to the jokes you share over email.
This high standard of conduct brings us right into what you could call the conflict zone. This is where an individual's financial interests might collide with their duty to the organization. What's the core duty here?
The core duty is to perform all your functions conscientiously, honestly, and in the fundamental best interests of the organization. That phrase sets the stage for the entire conflict rule.
Which is?
Employees must not use their position or any privileged knowledge they gain from that position for any private or personal advantage.
And the burden for reporting a conflict seems incredibly broad. It's not just about existing conflicts.
That's right. The rule is proactive, not reactive. If an employee simply senses any potential conflict of interest, something they've pursued or pursuing, or are even just thinking about pursuing,
They have to report it.
they have to immediately communicate all facts to their superior. You don't get to wait until it's a full-blown problem. You have to self-report the possibility of a problem, which is a very high bar for personal integrity.
That must apply significantly to outside activities. I mean, organizations encourage civic involvement, right? for PR reasons.
They do. They encourage civic, charitable, religious, educational activities. But they put two very strict and almost contradictory constraints on those activities.
What's the first one?
The first is pragmatic. It's about time and effort. Employees have to avoid activities that create an excessive demand on their time and attention because that deprives the organization of their best efforts on the job.
Your commitment to the company comes first.
It's paramount. You can't be, volunteering until 2 in the morning and then show up exhausted and ineffective.
And the second constraint is the conflict itself, which seems much harder to police.
It is. Employees have to avoid any obligation, interest, or distraction that might interfere with their independent exercise of judgment on behalf of the organization.
Can you give an example of that?
Sure. Let's say you're on the board of a charity that heavily uses your company's product.
Yeah.
You might feel obligated to steer company donations or resources their way, which interferes with your independent judgment about where that money should best go for the company's interests.
And this concern gets even more intense when we're talking about client and supplier relationships?
Oh, absolutely crucial. Employees are strictly warned against acquiring a financial interest in any business that has a contractual relationship with or provides goods or services to the organization.
And the standard isn't just about avoiding a real, tangible influence.
No. It's about avoiding an interest that could influence or create the impression of influencing their duties. The appearance of impropriety is, for all intents and purposes, treated as impropriety itself.
Why is that so important?
Because it undermines stakeholder trust. If it looks bad, it is bad for the business.
That concept, the impression of influence, is the perfect bridge to discussing undue influence, gifts, and the absolute prohibition on kickbacks. Because if a supplier gives you an expensive gift, they've successfully created the appearance of an obligation.
It's a huge vulnerability. It creates a debt, even if it's an unintentional one. Employees must not accept anything, entertainment, gifts, personal favors, that could, or even just appear to, influence their business decisions in favor of a dealing party.
So a standard business lunch is probably fine.
Right. But a luxury watch or a free family vacation to the Caribbean, that crosses the line immediately. You've accepted preferential treatment, and you've effectively placed yourself under an obligation.
But when we move from, let's say, lavish gifts to outright kickbacks and secret commissions, the rules become terrifyingly clear.
This is zero tolerance, non-negotiable. The organization strictly prohibits accepting kickbacks or secret commissions from any supplier, client, or external party.
And the code is explicit about where your compensation can come from.
Yes. The only compensation an employee can legally and ethically receive is what is authorized under the organization's official remuneration policies. And this is where the stakes just couldn't be clearer.
What's the consequence?
Any breach of this rule results in immediate termination and prosecution to the fullest extent of the law.
Immediate termination and criminal prosecution. No warnings, no second chances. It really underscores the severity of direct financial deceit.
It does.
Okay, let's shift focus slightly to the integrity of assets and records. This is the bedrock of control that auditors spend so much time scrutinizing.
This is really the domain of process. Employees who handle the organization's funds must follow very specific, detailed, prescribed procedures for recording, handling, and protecting that money.
And these are all written down somewhere.
Oh yeah. They're often codified in detailed internal instructional manuals. The goal is simple. Strict adherence to the process prevents the opportunity for fraud.
And what if an employee sees something suspicious? A cash shortage, a weird journal entry?
They have a direct, non-negotiable duty to report it. They must immediately advise their superior or the law department so that the organization can promptly investigate.
So silence is a breach of the code.
Failure to report evidence of fraud or dishonesty is itself a breach of the code, yes.
We also noted earlier that the codes specifically call out the personal use of company assets, which ties back to those initial rules about professional conduct.
It does. All assets, the physical plant, company vehicles, and yes, computers, are for organization purposes only. They are not to be used for personal benefit.
This seems small, but I guess it's a critical control.
It is. If you're using your company computer to run a side business or access inappropriate materials, you're not just breaking the conduct rules, you're diverting organizational assets. And that opens the door to more significant fraud later on.
And finally, let's talk about the integrity of the records themselves. Why is this so critical to the outside world?
Accurate and reliable records are necessary not just for internal management, but crucially, to meet legal and financial obligations to external stakeholders, investors, banks, regulators. The organization's books and records must reflect all business transactions accurately and in a timely manner.
And the accounting staff has a special responsibility here.
They absolutely do. They must fully disclose and record all assets and liabilities and exercise extreme diligence in enforcing these requirements.
This leads right to the prohibition on false communications, which is really about external trust, isn't it?
Correct. The code prohibits making or engaging in any false record, communication, or statement, whether it's internal or external.
And the list is pretty extensive.
It is. False expense reports, attendance records, production statistics, financial reports. But it also explicitly covers external actions like false advertising, deceptive marketing practices, or other misleading representations. The integrity that's demanded internally has to radiate outwards to the marketplace.
That gives us an incredibly dense picture of the code of conduct. It demands, really, near perfection in legal compliance, personal behavior, handling conflicts, and record keeping. But for senior financial officers, the C-suite, the bar, is actually elevated even further.
It is.
So let's turn to the Financial Executives International, or FEI, Code of Ethics.
Right. When we talk about senior financial officers, your CFOs, controllers, treasurers, we are talking about individuals who hold an important and, yes, elevated role in corporate governance. They are the guardians of the numbers.
They're uniquely empowered.
Uniquely empowered to ensure that all stakeholders' interests, investors, creditors, employees, the public, are appropriately balanced, protected, and preserved. Their actions determine whether that high-minded code of conduct we just discussed actually trickles down and functions in reality.
So their first principle mirrors the general code, but it carries immense weight. Act with honesty and integrity.
Yes, and that honesty must include proactively avoiding both actual and apparent conflicts of interest in all personal and professional relationships.
And a conflict for a CFO is a much bigger deal.
Exponentially more damaging.
Yeah.
Given their influence over vendor selection, banking relationships, investment decisions, a potential conflict for them can be catastrophic in a way it isn't for a general employee.
The second principle is maybe the most critical one for financial statement integrity. It sets a very high standard for the information they provide.
It really does. It demands they provide constituents with information that meets 6 distinct criteria. It has to be accurate, complete, objective, relevant, timely, and understandable.
Understandable is the key word there.
It is. Think about that. It's not enough to simply follow GAAP generally accepted accounting principles. The information has to be presented in a way that is clear and easy for a sophisticated yet external user to comprehend.
So a confusing but technically correct financial statement would be a violation.
A complex financial statement that technically follows the rules but is designed to obfuscate or mislead is a direct violation of this FEI principle. Absolutely.
Okay, they also have to comply with all rules. Federal, state, local, private regulators. But principle number 4 addresses the quality of their professional judgment, which is where ethics really come under pressure.
Right. They must act in good faith, responsibly, with due care, competence, and diligence. But the core ethical pillar here is the requirement that they must not misrepresent material facts or allow their independent judgment to be subordinated.
What does subordinated mean in this context?
This is the protection against pressure from the CEO or the board to make the numbers look good. Their duty is to the integrity of the information itself, even if that conflicts with what management wants right now.
And their knowledge is privileged, which leads to some enhanced responsibilities around confidentiality.
Absolutely. They have to respect the confidentiality of proprietary information unless they're legally obligated to disclose it, like in a regulatory filing or a court case.
But the rule is also explicit about personal gain.
Very explicit. It strongly states that confidential information acquired in the course of work must not be used for personal advantage. This is the direct ethical mandate against insider trading, using non-public information about the company's performance or future plans to profit personally in the stock market.
Finally, their role seems to go beyond just following the rules. They have to be culture drivers.
They do. They're required to proactively promote ethical behavior as responsible partners among their peers throughout the work environment and even in the community. They are, in a sense, ethical evangelists. They have to set the tone from the top.
Because if the CFO is cutting corners,
everyone below them gets that signal loud and clear, regardless of what the written code of conduct says. And of course, they have to maintain responsible use of and control over all assets and resources entrusted to them, which reinforces the control environment for the whole company.
So we have established these exhaustive rule books, the highest ideals, the elevated standard for leadership, and yet we know that fraud is not rare.
Not at all.
So we have to move now from that theoretical ideal into the grim reality of failure. The frameworks used to assess why these controls break.
It's a crucial shift because, a lot of people operate under the mistaken belief that fraud is some highly sophisticated one-in-a-million event.
And the source material says the opposite.
The complete opposite. Almost every long-lived organization has a tale of woe based on a past incident, and the stakes are incredibly high.
Yeah.
The lucky organization survived, but many businesses no longer exist simply because they were drained dry by fraudsters.
The failure to control this was so severe in the early 2000s, I mean, you think of Enron, WorldCom, that it led directly to the most significant piece of financial regulation in decades.
Yes, the massive frauds and the corresponding rise in financial restatements, where companies had to publicly admit their past reports were wrong, that highlighted a fundamental systemic weakness in internal control.
And this is what led to Sarbanes-Oxley.
It's the direct lineage. Sarbanes-Oxley, or SOX, mandates that public companies must publicly report on the effectiveness of their internal controls over financial reporting. The law essentially forced companies to stop ignoring fraud risk and formally sharpen their control mechanisms.
So if we have the rules, the ethical standards, and a massive federal law all dedicated to controls, why does fraud still persist? The answer, I guess, lies in human psychology, which auditors use to model risk.
That's it. You're talking about the fraud triangle.
The fraud triangle.
It was formalized in auditing standards like SAS 99 that's been updated since. But the concept is still central in AUC 240, and it posits that three common characteristics must align for typical scheme to occur: motivation, opportunity, and rationalization.
And if you can eliminate one of those, the fraud can't happen.
If you can eliminate or drastically reduce any one of those legs, the whole thing falls apart. The fraud cannot stand.
Okay, let's start with motivation. Money is the easy answer, but what else pushes people to financial ruin and criminal action?
Money is often the immediate, surface-level answer. Usually it's debt or just material desire. But other motivations are frequently of equal or even greater force, and these are often overlooked by general management.
Such as?
The sources emphasize things like the need for power, the desire to feed one's ego, or, perhaps most darkly, revenge against a perceived slight by the company. If the financial gain seems disproportionately small compared to the risk of the crime, auditors are trained to look for these non-monetary drivers: a power struggle, a desire to prove competence, or just a deep resentment.
That makes the crime deeply personal, doesn't it? Next up is opportunity, which seems to be the one leg that the organization has the most direct control over.
Absolutely. Opportunity is the critical contributor that controls are designed to eliminate. In an environment with well-designed, strictly enforced controls, adequate management oversight, and strong ethical standards, opportunities are drastically reduced.
The goal of the controls is to make it hard.
The explicit goal of control design is to make the fraudster work at it. If a fraud requires collusion between three different people and complex manual journal entries, most people just won't attempt it.
But if the controls are weak?
If the controls are weak, if one person controls cash receipts, banking, and reconciliation, you're basically inviting the crime. The source material notes that weak controls leave you vulnerable to the simple, stupid schemes that will make you ashamed you did not detect them in the first place.
Wow.
You want to be defrauded with pride by a clever criminal, not shamed by your own inept controls.
That's a powerful way to put it. Finally, we arrive at rationalization. This is the internal justification, the story the fraudster tells themselves so they can still look themselves in the mirror.
Rationalization is the most fascinating and, I think, tragic psychological component. The justifications are just time-worn and often interchangeable.
What's the most common one?
The most common is denial. I always intended it to be a loan. They don't see themselves as a thief, but as a temporary borrower. Or you get the classic gambler's promise: as soon as I hit the lottery or this investment pays off, I was going to repay all the money. It's an unsustainable delusion.
And there's also a distinct element of entitlement, which often seems to stem from a perceived injustice at work.
Precisely. They might rationalize it by saying, I am underpaid, and this just balances things out. They often believe the company has plenty of money, or that nobody seemed to care or notice, so I thought it was okay.
It's a profound shift of blame.
It is. They make the organization responsible for its own loss due to negligence or unfair compensation.
But the source material also connects rationalization back to personal pressure, the immense weight of trying to maintain a certain social status.
This is where the human tragedy is deepest. Rationalization is often tied to family pressure, pride, and shame. The money might be needed for the boat, house, fur coat, or facelift. The worldly goods necessary to maintain a certain image.
They're afraid of social failure.
An incredibly powerful motivator. They fear that a family relation might leave or shame them if they couldn't afford a specific item or lifestyle.
So motivation and rationalization are often deeply tied together by these very personal issues: debt, illness, pride. And the framework suggests this is a point where the organization, through, say, compassionate management or HR, might actually be able to intervene before the triangle is complete.
That's the most hopeful synthesis point in all of this. Personal issues like crushing medical bills, marital problems, substance abuse can be devastating and highly motivating factors for fraud. Pride and shame often prevent people from seeking the help that's available through EAPs or HR services.
So creating a safe space to ask for help is a form of fraud prevention.
It's maybe the best form. If management creates a culture where employees can openly seek legal or financial help for personal issues without fear of judgment, it could potentially address the motivation leg of the triangle, preventing these devastating outcomes like incarceration and criminal records, which only compound the initial problem.
The best fraud prevention is often compassionate management.
I really believe that.
That gives us the psychological underpinning for failure. Now let's move into the schemes themselves, the practical ways that motivation and rationalization meet opportunity. We'll begin on the revenue side with sales and cash receipts, what the source material calls the revenue hole.
Right. These schemes are all centered on diverting cash before it ever gets recorded,
Right.
or skimming it mid-transaction. The most fundamental scheme is skimming.
Okay, what is skimming?
The sale is simply never recorded on the books, and the cash is funneled directly out. This is so hard to catch because there's no audit trail. The company doesn't even know the transaction happened.
Is there a warning sign for that?
One warning sign can be persistently declining profit margins that don't seem to correlate with your sales volume.
And how is that different from something like underringing?
Underringing is slightly different. In that case, the sale is recorded, but the cashier or fraudster siphons off only a part of the sale money, say. They record a $50 sale as a $40 sale and pocket the $10 difference. It still creates a shortage, but the transaction flow is at least partially in the system.
We also see diversion mechanisms related to the sales staff themselves, leveraging external suppliers.
Yes, a salesperson might divert a significant potential sale to an external third-party supplier. In exchange, they receive a hefty kickback for the referral that's substantially higher than their normal commission from their employer would have been.
The company loses the sale, the salesperson profits personally.
Exactly. A related scheme is underpricing sales to receive a kickback from the client authorizing the order. You intentionally give a favored client a massive discount, costing your company money, and they secretly pay you the difference.
Now, let's look at the classic, complicated revenue scheme that requires constant juggling to maintain: lapping. Walk us through the mechanics of that one.
Lapping of receipts is a continuous step scheme involving customer payments. Here is how it works. The fraudster takes the cash from customer A's payment and steals it immediately.
Okay, so now customer A's account is past due.
Correct. So to cover that stolen money, the fraudster waits until customer B pays their bill. The fraudster then credits customer B's payment to customer A's account, making customer A look current.
But now customer B is short.
Exactly. They must then take customer C's payment to cover customer B, and on it goes.
It's the perpetual shell game where the fraudster is always one step behind, just delaying the recognition of the theft.
It requires continuous effort and constant manipulation of the books. It's often detected because the timing and amounts of payments and crediting are constantly mismatched.
How so?
Well, auditors look for over or underpayments that don't reconcile precisely to the invoices due. The thief has to cover a $1,000 theft with whatever payment comes in next, whether it's $800 or $1,200, which creates a visible lag or mismatch in the accounting records.
And internal paperwork can also be weaponized, like using bogus memos or fake refunds.
Yes, this is about creating fake transactional evidence to justify diverting funds. For example, issuing fake credit memos, returns, or allowances, and diverting the cash or check for personal gain.
There's a pretty telling anecdote in the source material about this.
The one about the rental furniture. An employee diverted the cash deposits and never deposited them. Later, when a customer requested a refund, the employee didn't pay the refund from their stolen cash. Instead, they initiated a company check for the refund upon presentation of the original deposit receipt.
So the organization lost money twice.
Exactly. Once when the cash was skimmed, and again when its own funds were expended for a refund that shouldn't have been necessary if the original cash had been properly deposited.
Okay, moving to the opposite side of the balance sheet, we go from the revenue hole to the expense drain. Purchasing and cash disbursements. The sources call purchasing departments notorious breeding grounds.
They're known as Kickback Central for a reason. Purchasing power provides immense opportunity. Suppliers will reward faithful purchasers of their product, often through direct cash payments or personal favors. It's like having an external secret payroll.
And inflated service contracts seem particularly dangerous because they hide the kickback inside a legitimate budgeted expense.
They are highly insidious. The entity contracts for routine services, landscaping, painting, janitorial, at significantly inflated, non-competitive rates. The excess money above the market rate is then diverted back to the inside person who arranged the contract.
And sometimes the work isn't even done.
Sometimes the billed for work is not performed at all. You're paying for phantom services. The source material notes that overpriced janitorial supplies are practically legendary in fraud annals. It's a small, recurring expense, but the margins for theft are huge and easy to hide. We also saw the example of the fraudulent electrical inspector who was paid for work that was never done.
But the kickback isn't always about money. Sometimes it involves substituting lower quality goods, which can be devastating for a company's safety and liability.
This is where financial fraud becomes a physical threat. Fraudsters substitute under-spec goods for ordered, high-quality items. The company pays for the expensive high-spec item, but receives a cheap, defective alternative.
And the difference is pocketed via a kickback.
Right. And the terrifying example the source gives is the liability risk from defective airplane engine bolts. If the person authorizing the purchase of critical components takes a kickback and accepts inferior goods, that fraud doesn't just cost the company money, it endangers the lives of its customers and exposes the company to massive life-altering lawsuits.
A direct violation of that FEI duty of due care.
Absolutely.
Beyond kickbacks, we have straightforward personal diversion of company purchases, a clear violation of the asset protection rule in the Code of Conduct.
Right. Merchandise ordered through the entity office supplies, equipment, raw materials is diverted or delivered for an employee's personal use. We also see this in expense and rebate fraud.
Like padding your expense report.
That, or a particularly cynical scheme, diverting legitimate business purchase rebates, which should come back to the company, into the employee's personal name or bank account.
And let's not ignore petty cash. The sources make a strong point about this, even though it's a small amount of money.
Well, petty cash has fallen off the radar of many modern financial audits because, in large organizations, the total amount is deemed non-material to the financial statements.
But the source material warns us about that.
It does. It is still a significant source of theft. It might be petty to the billion-dollar corporation, but it's not petty to the person stealing it. The anecdote about the cash advance teller for a large CPA firm who was fired after 20 years for consistent small-scale theft really underscores this. Even if the auditor's concern was limited by materiality, there were still thousands of dollars behind that window that were vulnerable. Anytime cash is involved, the control risk remains high.
Now let's discuss payroll schemes, which seem to rely on the complexity and volume of employees in larger entities.
That complexity is fertile ground for fraud. The most common scheme is the payroll ghost paying a bogus employee. In a small business, a new name on the payroll often raises eyebrows immediately.
But in a big company?
In a large organization with high employee turnover, the sheer volume makes it much harder to detect, especially if the ghost uses a post office box or direct deposit without any physical interaction.
And then there's the scheme that is specifically timed to evade detection by the very people paid to find errors.
The cynical audit timing trick. A payroll clerk who has internal knowledge of when the auditors typically test the records will give themselves a raise for a period, say, for 6 months, and pocket the difference.
And then what?
Then, right before the auditors arrive to test the latest payroll, they simply revert their pay to the correct authorized amount. If the auditors only sample the most recent payroll runs, which is common practice, the historical theft goes completely undetected.
And one particularly audacious scheme involves using the tax system to generate a personal payoff.
This one is so clever because the check comes from the federal government, making it less likely to be scrutinized internally. The payroll clerk manipulates the withholding system.
How do they do that?
They arrange for other, often unwitting employees to pay part of the clerk's payroll taxes for them, often through complicated deductions or allowances. The clerk then files their own tax forms, taking full credit for those payments. The result is an inflated tax refund check that effectively serves as a payoff from the government, a large, undeserved refund.
Moving to physical assets, the loss of computers and office equipment is common, but the risk has evolved far beyond just the cost of the hardware itself.
The theft of computers and office equipment is chronic. It occurs most often at night or over the weekend, but sometimes brazenly during office hours. And crucially, this often requires insider involvement.
Someone on the inside has to help.
Someone has to leave the back door open, tape the lock mechanism so it won't latch, or utilize a complicit cleaning or security staff member to facilitate the removal of the equipment. This ties right back to the general conduct rules. If you have staff engaging in unprofessional or secretive activities, the theft risk just skyrockets.
And the risk now is far greater than just the replacement cost because of data liability.
Significantly greater. The risk is personal data exposure. Even if a computer is password protected, a skilled hacker can often bypass the operating system and access the hard drive data directly.
So if there's unencrypted personal data on there.
If unencrypted personal data is exposed, social security numbers, driver's license information, financial account access info, the entity is held responsible under specific state laws.
This is where we have to connect the theft back to strict regulatory compliance, like those acts in California and New York.
Exactly. We are talking about severe, non-negotiable legal liability. Laws like the California Civil Code require any business that owns or licenses computerized data and does business in California to disclose any breach of security to the data owner. The New York State Information Security Breach and Notification Act has similar provisions.
So losing unencrypted personal data can lead to massive fines.
Massive fines, regulatory action, and liability lawsuits. The warning is stark. The time to think about encrypting personal data or tracking your asset locations is not the day after the equipment takes a walk out the door.
Finally, we arrive at inventory mischief, where the schemes often involve massive physical deception, sometimes bordering on the unbelievable.
This category really highlights the failure of basic physical controls and verification. The most legendary historical example is the Great Salad Oil Swindle. This is a massive fraud where storage tanks supposedly holding valuable cooking oil were actually mostly filled with inexpensive water.
How did they manage to trick the auditors who came to verify the physical inventory? That seems impossible.
They employed multiple layers of physical deception. First, they would pour a small skim of oil on top of the water in the massive storage tanks, just enough to coat the measuring rods that the inspectors used. When the rods came out, they showed oil.
And that's not all they did.
No. While the auditors were working their way through this maze of seemingly similar tanks, workers were often busy renumbering them so that the same tank, the one showing the oil skim, could be tested multiple times. It confused the entire physical count and verification process. It was a logistical shell game.
And a more common, less complex tactic is simply moving goods around to cover shortages.
That's physical relocation, the inventory shell game. Inventory is deliberately moved to the location where the counts were announced to be held.
So the count in that location looks perfect.
Exactly. It agrees with the accounting records, thereby hiding shortages that exist in other uncounted locations. This is frequently seen in high-volume, multi-location businesses like retail or trailer leasing companies. Announcing your inventory count location and time well in advance is effectively handing the fraudster the playbook for how to hide the losses.
But the sources also provide a sort of comforting mathematical truth about inventory fraud, suggesting that these schemes are ultimately doomed to fail.
They are. Most inventory frauds fall over their own weight eventually. The fraud involves the intentional overstatement of ending inventory in year one. Because of the way the cost of goods sold calculation works, overstating inventory year one artificially raises the reported profit for that year.
So the company looks better than it is for a year, but what happens next?
In year two, that inflated inventory amount automatically becomes the starting amount, becomes additional costs of sales. This massive hidden cost then dramatically depresses profits in year two by the exact same amount that was fraudulently gained in year one.
So double entry bookkeeping is the fraudster's eventual demise.
It is. The books will balance, but that massive sudden profit decline in year two often triggers deeper scrutiny and the whole thing collapses. To keep the scheme alive, the fraudster has to steal or overstate an even larger amount in year two, making the scheme financially unsustainable until it simply grows too large to hide.
We've seen the rules, the motives, and the specific schemes of failure. Now we have to address the reality of detection. The source material notes that it is, and I'm quoting here, embarrassing, how few frauds are actually detected during independent financial audits. Why is that?
Well, it reflects a fundamental tension and, I think, a misunderstanding between management and the auditor's role. Management often stares dumbfounded at a large fraud and asks, "That's what I hired you for."
But they misunderstand the auditor's mandate.
They do. Financial audits are designed to find material misstatement of the financial statements, whether that misstatement comes from error or from fraud. They are not designed to find every single instance of lapping or a single payroll ghost.
So the typical annual audit is not the same thing as a forensic investigation.
Absolutely not. A true forensic audit, one designed specifically to uncover deep-seated schemes, is incredibly expensive and time-consuming. Management is often unwilling, or maybe unable, to pay for that level of scrutiny every single year.
And sophisticated frauds are hard to find.
They're clever enough to escape detection until they're quite large, and once they reach that scale, they often stand out like a sore thumb, regardless of the audit process.
So if it's not the multi-million-dollar audit process, how is fraud actually found in the real world?
This is the most telling statistic in this entire deep dive. The single most common method of detection is a tip.
Someone just says something.
Someone says something, often anonymously. The majority of all frauds today are detected either by tips or by pure, unadulterated accident.
Accident? You mean like someone just stumbling upon a loose piece of paper or a spreadsheet mistake?
Exactly. It might be a clerk looking at a file they weren't supposed to, or a new manager questioning an expense account that their predecessor approved blindly for years. The source notes that in small businesses, accidental discovery actually exceeds tips slightly as the source of detection.
That statistic should be terrifying for any organization that relies solely on sophisticated accounting controls.
It should be. The real defense is employee awareness and a cultural permission to speak up.
So if the sophisticated systems and the detailed codes are all secondary to an employee just saying something, what does that imply about the culture and the significance of those seemingly small rules?
It implies that the human element is the ultimate control. Improving detection relies on better internal controls, yes, and increased auditor attention to controls design, but fundamentally it requires increased fraud awareness and a culture where people feel safe and empowered to provide a tip, no matter how small or insignificant the behavior seems. We have to change these statistics, and that means empowering the staff on the front lines.
And here is where it gets really interesting and where we connect everything we've talked about today. We've spent this time moving from the high ideals of organizational codes and executive responsibilities, the promise of integrity, to the ugly, specific realities of fraud driven by motivation, opportunity, and rationalization.
Right.
Understanding the controls and, more importantly, understanding their failure points is essential knowledge for anyone trying to navigate the business world quickly and thoroughly.
The systems are necessary, but they are not sufficient. The human eye, informed by a strong ethical culture, that remains the most powerful defense.
Which brings us to our final thought for you, Chuan. Remember back to the very first standards we discussed in the Code of Conduct. They prohibit even unprofessional behavior like swearing, gambling, or using organizational assets for personal use.
Right, those rules that often feel like just generic corporate HR fluff designed to promote a sterile environment. They seem miles away from the FEI ethics or the complexity of a lapping scheme.
Exactly. But if we know that most major frauds are found by accident or by tip, then perhaps the biggest early warning system an organization has isn't its sophisticated accounting software, but whether its employees feel empowered enough to raise a simple tip when they see those small, unprofessional behaviors starting to take root. If you see someone doing the little wrong things that the code prohibits, drinking at lunch, gambling in the office, brazenly misusing a company computer for personal gain, you are likely looking at an environment where the motivation and rationalization legs of the fraud triangle are already well established. The lax control over a personal computer or a few swear words might just signal the lax control over millions of dollars. An organization that ignores the small signs of cultural decay is creating the perfect opportunity for the sophisticated schemes to flourish undetected. Something to think about the next time you hear a joke that's too far or see someone abusing the coffee machine. When most people in business hear the phrase internal controls, I think their eyes just glaze over.
Oh, absolutely.
You immediately picture, these tedious forms, stacks of paperwork, endless compliance checkboxes, or maybe the dreaded annual audit
Yeah.
It just sounds so stiff, so bureaucratic, and, let's be honest, pretty boring.
It does. And that perception is, unfortunately, the complete opposite of what's really going on. Internal controls are not just some compliance activity.
Right.
They are the fundamental, critical, and often unseen structure that determines whether a business operates effectively, honestly, and maybe most importantly, whether it can actually survive a major crisis.
A crisis, yeah, whether it's ethical or financial.
Exactly. They're the scaffolding.
Yeah.
The scaffolding that ensures reliability in, well, in everything from financial reporting all the way to operational efficiency.
Absolutely. And, if you're looking for a shortcut to really understanding corporate integrity, you have to start at the bottom, the foundation.
That's the only place to start.
And that's exactly why today we're doing a deep dive into the COSO framework, but we're focusing exclusively on its foundational component, the control environment.
Mm-hmm.
We're going to skip all the transaction-level controls for now. Things like specific authorization limits or physical security, because, frankly, who cares about those if the entire foundation's just crumbling?
They're irrelevant at that point.
Yeah.
That's our mission for today, to really dig in and understand the 5 core principles that define this control environment. These principles, they set the entire tone of the company.
Overall tone.
The overall tone. They're what influence what auditors and compliance pros call the control consciousness of every single person inside that organization. If that control environment is weak, the whole system is just precarious. It's easily exploited, and it's destined to fail.
The power of this one component seems immense. I've heard it described as holding the trump card in the overall assessment of internal controls. That's a powerful, almost alarming term.
It is.
Why does the control environment hold that much weight?
It holds that weight because the structure of the COSO framework itself is hierarchical. So if you determine that the control environment is fundamentally defective, you actually cannot conclude that the entity's control system as a whole is effective. It's impossible.
It's a non-starter.
It's an absolute non-starter. It is the base layer. Think of it like this, right? You can invest millions in the best surveillance systems, the most advanced accounting software, layers of physical security.
All the specific controls.
All those specific controls. But if the culture of the organization is rotten, if that ethical slab at the bottom is cracked and shifting, nothing else matters. The control environment determines the fundamental willingness, the ability, and the ethical permission for people to even execute those controls correctly in the first place.
So a defective foundation makes an effective system totally impossible. But if this foundation is supposed to protect the company, what's the ultimate threat? What is it that the control environment is specifically trying to neutralize?
The ultimate threat, and it's the common denominator in almost every single major high-profile corporate fraud of the last few decades, is management override.
Wow. That just makes my hair stand up. It's not some external hacker or an entry-level clerk stealing petty cash. It's the people at the very top.
Precisely. Management override is the willful action of executives or senior leaders just defeating the established controls over financial transactions and policies.
And they know how to do it.
They're the very people who often designed the controls in the first place, or they hired the people who did. So they know exactly where the pressure points are, where to apply force, or, when to simply look the other way.
And they have the authority.
They have the access and the authority to authorize fraudulent entries, fraudulent transactions, and then they can use that exact same authority to suppress any challenges from their subordinates.
That feels like a catch-22, a real paradox at the heart of corporate governance. If the person at the top wants to commit fraud, or even just manipulate the results a little, how can any system possibly stop them?
It is extremely difficult, which is exactly why the control environment is so critical. It's designed specifically to counteract that dynamic of authority and trust. To combat this kind of willful override, companies have to implement tools that provide an independent path for information.
Bypassing the normal chain of command.
Completely. We're talking primarily about sophisticated anti-fraud controls, like anonymous hotline reporting. Also, the implementation of strong whistleblowing laws, the kind that are now recognized globally, are designed to protect employees who report issues. That's paramount.
So those tools allow the information about potential wrongdoing to skip over the management levels that might be involved.
Yes, and go directly to independent governance structures, like the audit committee of the board.
That's the key then. Creating an avenue for bad news to reach people who can actually act on it, even if the source of that bad news is the CEO. Now, you mentioned a limitation earlier. Even if we have a superior control environment, I mean, a gold standard culture of integrity, you said it can't carry the weight of the entire assessment alone. What does that mean in practice?
It's a really critical reminder that all the controls have to work together in an integrated way. You need that strong culture and ethical foundation defined by the control environment. Those are principles 1 through 5. But you also absolutely need specific control activities like authorization and performance reviews. Those are principles 10 through 12.
So you could have a really ethical CEO.
You could have the most ethical CEO in the world. That's principle 1. But if you have zero segregation of duties, which is principle 10, failure is still just around the corner.
And there's a nuance within the control environment itself, right? Because
Yeah.
we're talking about assessing culture and attitude, so the precision must be lower than, say, counting inventory.
Exactly. The 5 principles we're about to discuss, integrity, governance, structure, competence, and accountability, they all rely heavily on qualitative, subjective judgments.
We're assessing attitudes.
We're assessing attitudes, intentions, culture. We're looking for the tone at the top. You can't put a neat numerical score on that. And this subjective nature, it reduces the, let's say, the statistical precision of the final assessment. It reminds us that we have to be cautious. A strong culture might look strong on paper, but could easily fail under real stress.
That makes perfect sense.
I know.
It's a qualitative assessment that informs the quantitative one. It's the framework of human behavior that all the accounting rules get laid on top of.
Well said.
So, with that foundation laid, let's jump into the first, and I would argue the most powerful principle, integrity and ethical values.
This really is the ceiling, metaphorically speaking. The effectiveness of internal control, truly, cannot rise above the integrity and ethical values demonstrated by senior management.
So it's the absolute limit.
It is. And the expectations they set for the rest of the company, those values affect the design, the administration, and the continuous monitoring of every single other control component throughout the entire entity.
So, if the CEO is willing to cut corners on safety or, manipulate earnings projections just to hit a bonus target, it doesn't matter how robust the anti-theft controls are on the warehouse floor.
Not at all.
The whole company is inherently operating in a risky zone. The risk is coming from the top down.
It's risk by example. And the CSO framework is crystal clear on this distinction. Management can tell you a great deal about their integrity. They might commit all these flowery words to a written code of conduct.
Sure, they all have one.
But the effectiveness of Principle 1 depends primarily on management's actions. What do they actually do? And how are those actions perceived and acted upon by everyone else on a day-to-day basis? Written policies are, and always will be, secondary to demonstrated behavior.
We're talking about leading by example, but let's drill down on those codes of conduct for a minute. Is a highly detailed code better? Or is it better to have a broad, principle-based one?
Well, the research on this highlights a really fine distinction. In general, the more specific the code or the guideline is in defining what's ethical or unethical, the more helpful it is in guiding employees' day-to-day actions.
Okay, that makes sense.
However, we found a crucial danger zone that is so often overlooked.
And what's that?
If the policy or the code is too narrowly worded, it can actually encourage abuses.
Wait, how does being too narrow encourage abuse? That seems completely counterintuitive.
It creates what we call the loophole mentality. So instead of adhering to the underlying ethical concept, things like honesty or fairness, individuals just focus on the literal technical words of the policy.
So they feel justified doing something awful as long as they didn't technically violate the letter of the law.
Precisely. They can argue, well, I didn't technically violate the precise wording of the code. It becomes a game.
That's a fascinating insight. The irony is, by trying to be too specific, a code of conduct can accidentally become a blueprint for how to skirt the rules rather than a moral compass.
It shifts compliance from being an internal moral obligation to just an external legalistic hurdle that you have to jump over.
So, to assess this principle in practice, how do you do it? What do you look for?
We look at 4 key points of focus to gather the evidence. First, and most important, is the tone at the top. That's the crucial signal. Second is the existence of formal standards of conduct.
The paper part.
The paper part, yes. Third, the rigor with which management actually evaluates adherence to those standards. And fourth, whether they address deviations in a timely and consistent manner.
Let's focus on that demonstration of ethics. How does a CEO or a senior leadership team actually demonstrate these values in a tangible way, beyond just, emailing out a PDF policy document?
It really starts at the core. It starts with ensuring that management adheres to the very same principles they expect from their subordinates.
Of course.
If the CEO expenses a lavish family vacation as business development, while at the same time banning all overtime for middle management, well, the message sent about corporate integrity is deafening. It doesn't matter what the written policy says about responsible spending.
That immediately destroys any trust. It signals that the rules are for the little people, not for the executive suite.
Exactly. But it's also about how management deals with real problems, professionally and seriously. We can look at, say, a situation involving environmental contamination as an example.
Okay.
If senior management becomes aware of possible contamination, what do? Do they immediately try to hide it, deny it exists, or act evasively to save face and money?
Versus?
Or do they actively seek professional advice on how to best handle it, fully identifying the extent of the problem, even if the cost of that identification and resolution is extremely high? The second path demonstrates ethical values in action. The first is a blatant violation of Principle 1.
And this leads us right to the idea of removing or reducing what are called unproductive incentives and temptations. This is where management can accidentally encourage unethical acts, sometimes without even realizing they're doing it.
This is so critical to the control environment. Individuals might engage in dishonest acts simply because the owner or the manager gives them incentives or creates temptations that are so strong they just warp behavior.
They can't resist.
Right. So removing or drastically reducing these toxic drivers is a cornerstone of diminishing undesirable behavior, because we have to recognize that humans are often driven by these extrinsic rewards.
Let's talk about that specific anecdote we found in the research, the one about the aggressive tax shelter commissions. That example is so telling about how an incentive designed to drive sales can just destroy integrity.
It's a textbook case of a perverse incentive design. So this entity provided an extremely generous commission structure for sales of a highly aggressive and, frankly, questionable tax shelter product. The commissions paid were so substantial that the employee was actually able to retire shortly after receiving the payment.
Wow. Now, a lucrative commission might seem like a good way to motivate your top performers, but if the payment encourages someone to immediately disconnect from the consequences of the product they just sold, it fundamentally questions the ethical design of that whole program.
It does. It encourages a smash-and-grab mentality.
Right.
It does more than that, though. It suggests the entity prioritize short-term sales volume and financial reporting results over everything else: long-term stability, ethical execution, reputation.
So if the incentive is strong enough to let an employee retire instantly, it raises serious questions about the level of scrutiny management applied to those underlying transactions.
It does. In essence, you have to ask, was the entity effectively telling its employees to aggressively push ethical and legal boundaries, knowing they'd be long gone before the fallout ever materialized? That is management creating the ethical risk right there.
That's a perfect encapsulation of a perverse incentive. It drove extreme results, but they were completely unethical results. Let's formalize the distinction between incentives and temptations that drive these fraudulent practices. This seems like essential knowledge for anyone assessing risk.
Absolutely. So, incentives are pressures or rewards that are intended to motivate performance, but they become toxic when they are overemphasized, especially on short-term results.
Like what?
This includes the internal pressure to meet unrealistic short-term targets, meeting quarterly earnings projections at all costs. It includes intimidation or threats of job loss if targets aren't met. It includes overly generous rewards tied only to hitting specific performance numbers, or the use of upper and lower cutoffs on bonus plans.
Oh, those cutoffs are particularly insidious. If you know you're just under the threshold for a major bonus, you're highly motivated to manipulate the timing of transactions.
Of course.
You push sales into the current period, delay expenses just enough to slip into that payout tier.
It becomes all about meeting that arbitrary threshold, not about the honest, accurate reflection of the business. Now, on the other hand, temptations arise from inherent systemic weaknesses in the control system itself that just make improper practices easy and low risk.
Like having non-existent controls, for example. Poor segregation of duties, where one person can approve, execute, and record a transaction. That makes theft or concealment simple.
Yes. Or issuing company credit cards with really vague guidelines for use and poor, inconsistent policy enforcement. That is a direct temptation.
I see that all the time.
Another huge temptation is senior management that is visibly unconcerned with the operational details of the business.
I often see this dynamic in organizations that are led by technical subject experts, doctors, scientists, specialized engineers, even clergy. They have these mission-specific interests, but they just lack the business acumen or, frankly, the interest in the nuts and bolts of finance and compliance.
So they delegate everything.
They delegate everything, ignore the details, and rely entirely on subordinates, which creates these huge control gaps.
And that neglect is quickly interpreted by their subordinates as tacit permission to operate outside of standard procedure or even to abuse their roles because they know nobody's checking. Furthermore, if the penalties for improper behavior are insignificant or they're unpublicized or just inconsistently applied, they lose all their value as deterrents, and the temptation to violate controls goes way up.
Let's go back to management intervention for a second. We said management override is the ultimate threat, but intervention is sometimes necessary for legitimate business reasons, right?
Absolutely. Intervention is appropriate for legitimate purposes, usually to deal with non-recurring or time-sensitive transactions that the standard accounting system just might not be designed to handle efficiently or on time.
But there's a catch.
There is. COSO guidance stresses that management must provide robust documentation and discussion about the specific situations and the frequency of that intervention. Every single occurrence has to be documented, explained, and justified.
And if they don't document it, or if it happens too frequently without a good explanation?
Those are what we call silent overrides, and they connote a fundamentally different and dangerous control environment. The environment should favor documented post-review and approval by a level higher than the authorizing person. That facilitates business goals while retaining full accountability and transparency. Silent overrides demonstrate a culture of secrecy and exception, which just destroys Principle 1.
Okay, moving on to judgment calls. What are some warning signs that an auditor or a reviewer can use to spot potential deep-seated problems in management's philosophy and operating style?
There are some clear organizational signs that signal trouble. Frequent, unexplained turnover in key accounting or finance positions is a major red flag.
Right, because those are roles where you expect stability. Institutional knowledge is critical.
Exactly. Likewise, long vacant key finance roles, which suggests the company isn't prioritizing the integrity of its financial function at all.
And what about the general workforce attitude? Can you read anything from that?
Oh, for sure. Poor overall personal attitudes or work ethic among the rank-and-file personnel often reflects low morale. And that's a direct result of a toxic environment created at the top. And, maybe most overtly, frequent, serious, persistent complaints about the actions or abusive nature of senior executives. All of these signal a potentially compromised environment where the official written standards are basically meaningless.
So how does evidence gathering actually work for something as subjective as tone at the top?
It requires a strategic mix. You need objective testing and subjective observation. You have to be generally observant. How do people talk about the CEO? Is there visible fear or cynicism? But you also need proactive measures. To assess the tone, you can conduct anonymous surveys or targeted interviews of a wide variety of personnel, from senior managers all the way down to the newest hires.
So just reading the code of conduct is only the very first step. You have to test if the policies are actually understood and, more importantly, if they're enforced.
That's where the objective evidence comes in. In larger organizations, you look for the annual signed employee statement where they agreed to the policies. You sample those records, make sure you have 100% compliance with that. For smaller entities, you look at meeting minutes where ethical policies were discussed and ratified.
But the enforcement piece is the real litmus test.
It is. Is there a comprehensive, accurate, and up-to-date record of ethical and HR complaints involving both management and employees? You test those records for completeness, for accuracy, and most importantly, for the timeliness and consistency of how they were resolved.
And that leads us right back to the fired controller anecdote, which perfectly illustrates how management's actions can just negate any stated ethical words. This is a classic example of a cascading control failure.
It is a textbook case of a Principle 1 failure leading straight to catastrophe. So a corporate entity fired its controller for expense fraud. That's an appropriate disciplinary action. Fraud by senior personnel is a huge material weakness indicator.
Okay, so far so good.
Right. However, here's where the integrity failure begins. The entity then hired that same controller back as a highly paid consultant to support the accounting function.
You're kidding.
And at the same time, they promoted a lesser qualified, less experienced employee into the now vacant controller role.
What signal did the company send to its remaining staff by rehiring the fraudulent executive, even just as a consultant?
It sent a corrosive signal. It said that misconduct, even significant financial fraud, is survivable and maybe even forgivable as long as you retain institutional knowledge. Management effectively prioritized operational convenience over their own ethical standards.
Which immediately undermined the severity of the initial discipline and just eroded the integrity standards of Principle 1.
And the failure didn't stop there.
Because the promotion of the marginally qualified employee created a severe weakness in competence.
Precisely. It directly violated Principle 4, commitment to competence. The consequence was predictable and it was severe. Errors in judgment resulting from the new controller's competence deficiencies led to massive misstated financial statements and contributed directly to the entity's eventual bankruptcy.
So the initial failure of Integrity Principle 1 created a cascade failure right into the principle of commitment to competence Principle 4.
Exactly. Proving that these principles are not just isolated checklist items. They are entirely interdependent pillars of the exact same foundation.
That's a powerful conclusion for Principle 1. Integrity is the source code for the entire operation. Let's smoothly transition now to the next critical component of that foundation, the one that defines the structure for that integrity. Principle 2, governance, oversight, and independence.
Right. This principle addresses the critical importance of leadership beyond just a single owner or a chief executive. The COSO guidance is often written from the perspective of a large, publicly traded corporation with a formal board of directors and an audit committee. But the concept really applies to everyone.
The term governance is used in auditing standards specifically to cover all these diverse structures, right? Because finding the board equivalent in a church or a municipal township or a family-owned business can be a real challenge.
It can be. You have to identify who holds that ultimate oversight responsibility. And that identification is key. The points of focus for governance are clear, no matter what the entity type is. They have to establish oversight responsibilities, they have to apply relevant expertise to the issues at hand, they must operate independently from management's day-to-day operations, and they have to provide critical oversight for the entire system of internal control.
I see an immediate challenge there, especially in the smallest entities. In a sole proprietorship, for instance, how can governance possibly be independent from management when the owner is both the manager and, the ultimate authority?
In those simpler owner-managed businesses, true structural separation is often difficult or functionally impossible. The research notes that this structural reality might, in fact, indicate a material weakness that is inherent in the business structure itself.
One that you can't really fix.
It's hard to correct without imposing some external formal structure. However, even a sole proprietor has to consider mitigation mechanisms, trusted legal or tax advisors, or maybe a non-executive paid advisory board. They can provide some independent oversight, even if it's purely advisory.
Okay, let's look at the corporate side. Historically, corporate boards haven't always been the impartial arbiters they're supposed to be. Sometimes they were actually part of the problem.
That's absolutely true. Historically, boards were often accused of being puppets of powerful management teams, especially the CEO. They were selected based on loyalty, social ties, past political support, rather than any kind of financial or business acumen.
So CEOs just appointed their friends and supporters.
And they were quick to discharge anyone who questioned their authority or their decisions, which made the concept of board independence an absolute joke in many large companies. And this allowed systemic fraud to just fester for years.
But regulators have stepped in to address this issue, creating a massive shift toward mandatory independence and expertise, especially after those high-profile corporate failures in the early 2000s.
The trend is undeniable. It's driven by global best practices, SEC rules, stock exchange listings, state laws. There's a clear mandate now for more independent directors, and crucially, directors who possess financial accounting expertise, particularly on the audit committee. Entities are expected to model their governance after these stringent requirements to ensure there's true oversight.
I want to focus on the specifics of independence for our listeners because these definitions from the Blue Ribbon Commission, the BRC, they basically became the gold standard for defining Principle 2. The core idea is that no director should have a relationship that interferes with their objectivity.
Right. The BRC defined independence for audit committee members as having no relationship to the corporation that may interfere with the exercise of their independence from management and the corporation. And they provided very specific guardrails examples of relationships that automatically impair independence.
So this is where the compliance checklist becomes a critical tool for ethical governance.
It does.
Give us a few of the most impactful examples that create an immediate conflict.
Okay. 1, being employed by the corporation or any of its affiliates in the current year or any of the past 5 years. That's a cooling off period to prevent former executives from dictating policy. 2, accepting any compensation from the corporation other than standard compensation for board service or benefits under a qualified retirement plan.
So if the director is also doing side consulting work for the company, their independence is immediately compromised. No special side contracts, no special deals. It demands a clean financial break.
Right. 3, having an immediate family member who is or has been in the past 5 years employed by the corporation as an executive officer. 4, being a partner, controlling shareholder, or executive of a business that has a significant relationship with the corporation. This means significant payments made or received that are relevant to either party in the past 5 years. If your primary supplier CEO is on your board, that creates a conflict.
And the fifth example is pretty clever. It tackles those cross relationships in the C-suite between two different companies.
Right. It's the circular board problem.
Hmm.
A director is considered compromised if they are employed as an executive of another company where any of your corporation's executives serves on their company's compensation committee.
So it prevents that I'll scratch your back, you scratch mine dynamic, where executives just ensure each other get generous compensation packages, independent of performance.
Exactly. And the regulatory consequence was massive. The BRC recommended that listed companies above a certain size must have an audit committee comprised only of independent directors. That's the regulatory muscle that ensures Principle 2 is enforced.
Now, a crucial clarification is needed here. When the external auditor evaluates the audit committee, they are not performing a standalone evaluation of all aspects of its effectiveness, right? They aren't checking if the board is good at strategy or HR.
That's a key point. The auditor's evaluation is solely in the context of understanding the control environment and the effectiveness of governance over financial reporting. Management retains the ultimate responsibility for the company's internal controls.
That's a key legal distinction. Governance is about oversight and challenging assumptions, not the day-to-day execution. Speaking of structure, Principle 2 also requires the governance structure to be appropriate for the entity's size and complexity.
Absolutely. We call this right-sizing governance.
Yeah.
A Fortune 500 company managing global supply chains and billions in transactions can't rely on a single CEO for effective governance. That would not instill any stakeholder trust.
But on the flip side,
conversely, establishing a complex, multi-layered structure with 7 separate committees is just overkill for a simple small business. The structure needs to be functional and effective for the inherent complexity of that specific entity.
you mentioned an interesting resistance to controls specifically found in nonprofit and religious entities. What drives that?
It's often rooted in a belief that because they are pursuing a good cause, the need for strong internal controls is somehow negated or less important than in a purely profit-driven environment.
They think the ethical tone is set by the mission itself.
They do. But the control environment has to care about cash protection, operational procedures, and financial reporting accuracy just as much as a multinational corporation. Unfortunately, the number and size of frauds exposed in these sectors, embezzlement, misuse of donor funds, they serve as a painful testament to the folly of relying only on good intentions.
Good intentions don't make up for bad controls. Let's look at how one entity mitigated a severe structural weakness, going back to that small public investment company.
This was a small public investment company that was an accelerated filer, which means they had complex, stringent reporting requirements, but they only had 3 full-time employees.
Wow.
So their structure created an inherent massive weakness because they lacked the staff and the separation of duties that's required for that level of financial reporting complexity.
So how did they assert control effectiveness to the SEC and their shareholders with such a tiny staff?
They took drastic, dedicated action. They utilized technology heavily, they implemented computer and manual control processes, and they brought in expert outside assistance. And crucially, it was not their external auditor, which preserved independence.
Smart.
They resolved the toughest problem preparing complex financial statements and footnotes by hiring a retired CPA specifically for that function. This individual was only a contractor preserving their small internal team structure, but they filled that huge knowledge and labor gap.
So they recognized that the inherent weakness in Principle 2, the structure and independence, required them to dedicate external resources to mitigate the risk. That's a great example of management showing their commitment through spending and action.
Exactly. It shows that while inherent weaknesses exist in small structures, mitigation can be achieved through dedicated external resources and specific technological controls, allowing the company to ultimately meet its Principle 2 oversight requirements.
That's a perfect pivot point into Principle 3, organizational structure, reporting lines, and authority. If Principle 2 defines who is watching, Principle 3 defines how the workers are organized to actually execute the plans.
That's right. The organizational structure is the framework for planning, execution, control, and monitoring activities that are aimed at achieving objectives. If you have a poor or an ill-fitting structure, you breed opportunity for fraud and error to affect financial health and reporting quality.
So we come back to right-sizing again. A simple structure works for a two-person welding shop, but a highly formalized matrix structure with dedicated internal reporting lines is necessary for a global technology firm.
The key issue is finding the precise fit for the complexity. But here's the warning sign that should put any risk professional on high alert. Unnecessary structural complexity.
Unnecessary complexity.
When organizations have multiple non-operating subsidiaries, numerous confusing related party linkages, and loose management oversight, the environment is inherently ripe for fraud, inappropriate management override, and concealment.
Let's pull the anecdote about the large corporate bankruptcy and the mysterious subsidiaries into this discussion. How did complexity become an enabler of fraud in that case?
This was a colossal failure, where, prior to a major corporate bankruptcy, the SEC specifically inquired about numerous subsidiaries that seemed to serve no apparent business purpose. They were just shell corporations, often layered into complex legal structures both domestically and internationally.
And that question, that warning sign about the complexity, it was ignored. What did they find after the company failed?
It was discovered that the true purpose of these shells was to facilitate related party transactions that were being improperly accounted for. These transactions provided false comfort to financial report users about the business's apparent viability and profitability.
So the structure, Principle 3, directly facilitated the failure of integrity, Principle 1, and created this ideal environment for override.
Exactly. The subsidiaries acted like camouflage, hiding the company's true financial distress from regulators and investors.
Beyond the organizational chart itself, Principle 3 also deals with assigning authority and accountability across that structure. What are the specifics involved in that?
It's detailed work. It involves establishing clear reporting relationships and authorization procedures, defining strict limits of authority, who can sign contracts up to what dollar amount, who can authorize payments. It means maintaining clear, updated job descriptions, including for outsourced personnel, and ensuring that authority and accountability are perfectly aligned. You want to encourage individual initiative, but strictly within limits that are defined by policy.
Delegation is necessary because the people closest to the transactions, the regional manager, the line supervisor, they're the ones making the operational decisions. But that delegation must require increased monitoring.
Absolutely. The wider the authority is dispersed, the more critical the central oversight and monitoring have to be. And this creates a direct, seamless link to Principle 5, accountability. The control environment is deeply influenced by the extent to which every single individual, from the CEO down to the janitorial staff, recognizes they will be held accountable for achieving objectives and following the rules.
Moving directly to Principle 4, commitment to competence. If structure is the map, I guess competence is the driver ensuring the vehicle gets to the destination safely.
Competence is defined as the knowledge and skills necessary to accomplish assigned tasks, and it is entirely context-specific. As we noted in the controller anecdote, a controller who excels at managing the simple accounting needs of a small, stable nonprofit is often wholly unprepared to meet the complex, high-pressure SEC reporting demands of a large public business that deals in derivatives. The commitment must be relative to the risk.
So the commitment here isn't just about hiring smart people in general, but about establishing robust policies to ensure competence remains high and specific to the role across the entire organization.
Right. The key points of focus for management's commitment are proactive, establishing competence policies and practices, actively evaluating competence and addressing deficiencies quickly, attracting, developing, and retaining competent employees, which includes making sure contract workers meet the same standards, and crucially, planning for succession. If a key financial person leaves, does the entity have a plan to replace that knowledge?
In the context of a senior finance role, what are the visible signs that competence is critically lacking, beyond just, they look confused?
Several objective issues stand out immediately. Frequent or significant corrections in accounting and reporting matters, especially after the books are supposedly closed. Auditors discovering significant, necessary adjustments to accounting records year after year.
That's a bad sign.
A huge one. A failure by specialized staff to maintain their professional licenses and meet continuing professional education, or CPE, requirements. And maybe the most telling, frequent reliance on expensive external consultants or auditors for issues that should be routine accounting matters handled internally.
That last point is really revealing. If a company has to hire an expensive consultant every time they face a standard regulatory filing or a complex transaction, it signals they haven't really hired a controller. They've hired a very expensive facilitator for consultants.
And this brings us back to that public company that had the initially underqualified controller. Instead of ignoring the severe deficiency in SEC expertise, they showed a true commitment to Principle 4 by mitigating the weakness.
They recognized that firing the new controller would cause immediate disruption, but keeping him as he was posed an existential threat.
Exactly. So they brought on additional temporary resources to handle the immediate SEC reporting gaps, and they implemented an intensive outsourced training program, sending the controller to external seminars and specific technical training to bring him up to speed on reporting requirements and SEC literature.
So that's the important takeaway here. An initial severe deficiency was mitigated by dedicated resources and proactive training investment.
Right. Management recognized the gap in Principle 4, and they addressed it with specific, costly action, which demonstrates their overall commitment to competence. And that is much stronger evidence than just having a written policy.
How important are human resources policies in ensuring Principle 4 is met?
They are the backbone of competence. Policies on hiring, background checks, structured training, fair evaluation, compensation structures, and disciplinary action all directly affect an entity's ability to secure and retain competent personnel.
Right.
And the 2013 COSO revisions made a significant clarification to address post-Sarbanes-Oxley concerns, noting that thorough documentation of competencies is now explicitly expected, especially when controls assessments are provided to third parties or external auditors.
Which makes sense. If you're going to assert that your controls are effective, you need documented proof that the people running those controls, your key personnel, are actually qualified to do so.
And finally, we have to return to the ethical link between competence and integrity, Principle 1. We have to ask, why would management tolerate incompetence?
Good question.
Deliberately seeking lesser levels of competence than required. For example, hiring someone underqualified for a lower salary, or promoting someone they know they can control. That may be a way for senior management to establish a culture of compliance, where no one is qualified or confident enough to challenge their decisions or question questionable transactions.
So incompetence, whether it's deliberate or just neglected, circles right back to a fundamental failure of Principle 1, integrity and ethics. These principles are truly intertwined at a psychological level.
The failure in one area quickly becomes symptomatic of a larger control environment decay, which brings us to the final critical enforcement mechanism.
Let's wrap up the 5 core principles with Principle 5, accountability. This seems to be the one that enforces all the structural and ethical commitments we've just discussed.
It is the ultimate enforcement mechanism. It stresses that every individual has a defined role in internal control, no matter how small. It is not just the controller's problem or the CEO's problem.
It's everyone's job.
It is. Effectiveness relies on every key person having controls awareness, accepting responsibility for their segment of the operation, and understanding that there are real consequences for failure.
The points of focus here seem specifically designed to prevent that paper tiger problem, a company with great-sounding rules that no one actually follows. What are those focus points?
Management and governance must actively enforce accountability through the structure, that's Principle 3, establish meaningful performance benchmarks and rewards that are aligned with ethical conduct, actively and regularly reconsider the performance and rewards structure.
Always looking for those excessive pressures that might encourage fraud, linking back to Principle 1.
Always. And then consistently and appropriately apply rewards or disciplines based on performance and adherence to standards.
The danger is profound when management or governance fails to follow through, when controls fail or performance is poor.
That is the definition of the paper tiger mentality. If management sets great, rigorous policies but consistently fails to enforce consequences, or even worse, tolerates poor behavior, the policies are neutered. The stated rules become jokes. Subordinates and peers become cynical, demoralized, and complacent, leading to a broader, unspoken breakdown of the entire control environment.
Let's examine the disruptive case of the failing IT specialist because that demonstrates how an isolated competence failure, when it's combined with a severe lack of accountability, can just spread corruption and demoralization throughout the organization like a virus.
So this organization hired an IT specialist into a key leadership role, despite internal concerns about her lacking recent relevant experience for the specific complex systems they were using.
Okay, so a bad hire from the start.
A questionable one, at least. After the initial honeymoon period, she began failing to deliver on project output, became visibly absent from work, submitted questionable expense reports, and grew abusive and defensive when she was questioned by her subordinates or peers about her poor work habits.
Why did management tolerate this problem for so long? Why did it persist?
The persistence was a failure of accountability rooted in technical illiteracy.
Oh.
IT is often a difficult, specialized area for general, non-technical management to assess. They just lack the expertise to challenge a defensive specialist effectively.
So that lack of oversight led directly to the failure of accountability, Principle 5.
It did. And because the specialist's poor performance and unethical behavior were tolerated, she drove capable subordinates and peers to become demoralized, angry, and eventually to seek jobs elsewhere.
So the management's failure to enforce accountability against one person led directly to the turnover of capable, competent subordinates, which weakened the entire department and compromised operations. It's a systemic failure.
A hugely disruptive and costly consequence. The entity eventually had to fire her, but by that point, the entire IT department required a complete, expensive overhaul to rebuild the necessary skill sets and restore morale. Better oversight and early identification of the competence issues, linking Principle 4 to Principle 5 through immediate disciplinary action, would have prevented a highly disruptive and expensive organizational breakdown. This is why accountability is the necessary closure for all the other principles.
What evidence should we look for to assess whether an entity is truly accountable?
We look for the paper trail of consequences. This includes management disciplinary files and records, issues reported via the hotline and how they were resolved, patterns of excessive turnover in specific functions. Is the turnover concentrated in one abusive department? And findings from interviews with personnel. We are looking for proof that actions, and not just written policies, are behind the entity's stated procedures. We need to see that management is willing to take the hard steps when necessary.
This brings us to the final section. Interrelationships and defined roles. We've established that these 5 principles are constantly bleeding into one another. So if a control deficiency is identified, how do auditors properly analyze it to find the true structural root cause?
You have to identify the root cause, and this is a highly judgmental task. It often requires significant experience. When a control fails, you can't just slap a label on it. You must trace the symptom back to the foundational principle that failed.
Give us the illustrative example of the alleged ethical breach and how that root cause analysis works across the principles.
Okay, let's imagine management was slow, say 6 months slow in resolving an alleged ethical breach, like an employee taking kickbacks. Immediately, Principle 1, ethical considerations, is affected by the substance of the breach itself, and Principle 5, accountability, is affected by the delay in resolution, creating that paper tiger mentality.
But the root cause might lie further afield in a system component we haven't even discussed today.
Precisely. If the slow resolution occurred because the employee who saw the misconduct didn't know the proper guidelines for reporting it, then maybe the root cause is a Principle 14, internal communication, failure. The policies were just poorly disseminated. Or if the hotline system itself failed to deliver timely information about the breach to the correct level of management, the root cause might involve the anti-fraud controls within Principle 8, fraud risk assessment, which isn't even in the control environment component.
So documenting a deficiency properly requires cross-referencing and relating principles, not just to satisfy compliance forms, but to ensure management actually fixes the structural problem, not just the easily seen symptom.
It is absolutely essential for effective remediation. If they only fix the hotline, which is Principle 8, when the real problem is that the CEO ignores all hotline reports, that's a P5 and P1 issue, the system will just fail again. Now, to cap off our deep dive into the control environment, let's quickly detail the specific responsibilities for internal control across the various organizational roles, as laid out in the COSO guidance.
Let's start at the absolute top. The CEO. What is their unique role in the control environment?
The CEO sets the overall tone, establishes the management philosophy and operating style, and provides leadership direction. Crucially, they serve as the role model for ethics, the highest ethical compass. They share fundamental responsibility with governance, for ensuring all control components and monitoring are established and functioning. They are the visible standard.
What about mid-level management who are responsible for the daily grind?
Management establishes more specific, day-to-day internal control procedures. They monitor and report on their effectiveness, and they identify operational changes and emerging risks. They, too, must serve as ethical role models, enforcing the standards set by the CEO within their own divisions and being accountable for the control design in their areas.
The finance officers, the CFO, the controller, they have a particularly heavy burden, don't they? They're often the ones required to sign off on compliance assertions.
They do. They have the primary responsibility for the design, implementation, and monitoring of the entire financial reporting system. They have to provide key input to entity-wide objectives and risk assessment and oversee complex liquidity and financing disclosures. They are the frontline defenders of accurate reporting, and they must serve as strong, independent ethical role models against internal pressure.
Moving to the oversight function, the board of directors, or the governance equivalent.
The board exercises oversight of top management, watches over stakeholder interests, provides guidance, and helps define ethical expectations. They perform high-level strategic planning and risk identification, and must, per Principle 2, exhibit genuine independence from management. Their job is to ask the uncomfortable questions and investigate high-level finance-related issues.
And the dedicated watchdog within the board, the audit committee, has a highly specific control mission.
The audit committee's duties are specific and critical to the integrity of the control environment. They are primarily responsible for selecting and retaining the independent auditors and holding principal interactions with them. They oversee management's financial reporting responsibilities, require and track corrective action for deficiencies, investigate allegations of management misconduct, and, most importantly, identify and act when top management attempts to override controls.
That last point is profound. The audit committee is specifically tasked with neutralizing the ultimate threat of management override that we started our entire discussion with.
That is their most important control function. They are the emergency brake. Finally, we have the internal auditors and other entity personnel.
Internal auditors, who are independent of day-to-day operations, they may document and test controls for management assertions and examine design flaws. They perform year-round monitoring and identify deficiencies, communicating them directly to the audit committee and to external auditors in public companies.
And every other entity personnel, every single employee, must know and follow the codes of conduct, perform control-related activities with due care and diligence, suggest control improvements when they see operational friction, and communicate problems or non-compliance to higher organizational levels. That closes the loop on Principle 5. Accountability is universal.
This has been a tremendously detailed look at what many people initially dismiss as just a soft, subjective area of compliance culture.
The control environment, defined by these 5 interconnected principles, integrity, governance, structure, competence, and accountability, is anything but soft. Integrity is the starting point, and accountability is the enforcement mechanism. When these are strong, the business is resilient, and its reputation is protected.
So what does this all mean for the organizations you lead or observe? The focus on the control environment is about far more than simply generating accurate financial reports. These 5 principles fundamentally determine an organization's operational resilience and its reputation. A culture of integrity and accountability is what protects the business from internal failure and external collapse, especially when market pressures are high.
A failure in Principle 1, integrity, makes all financial controls suspect. A failure in Principle 5, accountability, ensures that competence problems or structural flaws will persist and fester, ultimately jeopardizing the company's survival and reputation far beyond the consequences of mere compliance fines. Get the foundation right, and the rest of the controls at least stand a chance.
As you reflect on this deep dive, consider the structures in your own professional life or the organizations you observe from the outside. Which of these 5 principles, integrity, governance, structure, competence, or accountability, is currently the weakest link? Is it a leadership issue, a training issue, or a structure issue? That vulnerability is the greatest threat the COSO framework is designed to expose and fix.
Welcome back to the Deep Dive. You are tuning in to the ultimate shortcut to being thoroughly informed, and today we are going deep. We're getting into the mechanism that underpins all financial reporting integrity: control activities. This is really the engine room of the COSO framework. I mean, if you have any background in accounting or auditing, this is the turf you feel most comfortable on.
Oh, absolutely.
The specific controls over transactions, processes, accounts. the things we test year after year. But here's the thing. The updated COSO framework, it demands we look at control activities in a far more integrated way.
Yes, it connects them directly to risks, technology, and governance. It's not just about checking boxes anymore.
Not at all.
That is absolutely right. For this deep dive, our mission is to move beyond that traditional view of controls and really examine how the framework assigns structure to this vital component.
Okay, so what's the plan?
We're focusing on 3 associated principles that dictate how controls must be designed and executed. First, we're going to dissect Principle 10. This is the fundamental rule. It requires controls to be specifically selected and, developed to mitigate risks identified earlier.
Right, the risk assessment phase.
Then second, we tackle Principle 11, which elevates the critical, non-negotiable role of Information Technology General Controls, or ITGCs.
A huge topic.
Huge. And finally, we look at Principle 12, which governs that critical step of deployment, making sure these theoretical controls actually become executable policies and procedures on the ground.
I think it's worth pausing on Principle 12 for a moment, because while it deals with transaction controls and the financial statement close process, the sheer volume of work in that close, the numerous assessments, all the subjective estimates, the complex valuations, it just vastly outweighs the simplicity of being assigned to one single principle. That phase is truly the heavy lift.
It is the ultimate pressure test, isn't it? The control activities component is where management's directives become daily actions. And these 3 principles, P10, P11, and P12, they provide the structure to ensure that the entire process, from risk ID to daily processing, is monitored, secured, and, crucially, documented.
Okay, let's jump into Principle 10 then. We've already spent time defining the importance of risk assessment. So if that was the process of identifying threats, Principle 10 is where you actually build the defensive.
That's a perfect way to put it.
The rule is simple. Controls must be selected and developed to mitigate the risks identified and to achieve objectives.
And we simply cannot overstate this. Risk assessment is the engine that drives control design. It has to be. Whether the risks are routine, like simple transactional errors, or periodic, like complex fair value estimations.
Or even something totally unique.
Exactly, like a major divestiture or an acquisition. The risks you identify define the entire population of controls you need to develop. This connects P10 directly back to the control environment, things like competence and structure.
So how does P10 ensure that connection stays direct?
Well, the points of focus for Principle 10 demand it. Controls can't be an afterthought. They have to integrate immediately with the risk assessment output. This is why management must consider entity-specific facts.
Right.
I mean, a generic, off-the-shelf control checklist is often useless, just completely useless, because no 2 entities, even in the same industry, have the same policies or geographical complexity or financing structures. Control design has to be highly customized.
So if a multinational corporation relies heavily on, say, complex financial instruments to hedge currency risk, their controls around valuation are going to be fundamentally different from a small regional manufacturer who only deals in a single currency.
Precisely. The control design is driven by the complexity of the business and its inherent risk. So you have to first determine the relevant business processes, which is where financial statement assertions come in, something we'll get to in a bit. And then you evaluate the necessary mix of control activity types, preventative versus detective. And finally, you assess the appropriate application level and ensure you have adequate segregation of duties, which is itself this kind of pervasive control that needs to be considered everywhere.
So if risk is the driver, what kind of documentation is necessary to prove that link is solid? I mean, especially for stakeholders or auditors or assessors.
The documentation is essentially a formal roadmap. It's often a documentation matrix or a schedule that details this critical linkage.
And what does that look like?
It starts with the enumeration of the risk and its source. Then it moves to the identification of what could go wrong if that control failed. After that, it specifies the relevant financial statement assertions the control supports.
All right.
And then it provides a thorough control description, including the frequency and the magnitude of the transactions involved.
You have to classify the control too, right?
Crucially, yes. The documentation has to classify it. Is it manual or automated, preventive or detective? This level of clarity allows everyone to quickly identify what we call the gap scenario.
The gap scenario.
Yes. If you've identified a significant financial reporting risk and you can't point to a corresponding control designed to mitigate that risk, you have a gap.
And a gap is effectively a deficiency unless it's immediately remediated.
Exactly. That gap must be filled, or management has to recognize it and rate it as a control deficiency. Let's take an example. Say an entity realizes its internal tax expertise is too weak to handle complex deferred tax calculations. That's a clear source of risk.
Right, so they hire a consultant.
They hire an outside tax consultant, which seems like gap filling. But simply hiring the consultant is not enough to satisfy the control requirement.
I see where this is going.
The entity has to implement an oversight and monitoring control. They have to ensure the consultant's work is competent, that it's appropriate for financial reporting, and that it's reviewed by internal finance leadership. If that oversight control is missing, the entity has a competence deficiency. You can delegate the task, but never the risk or the accountability.
That is the core principle right there. Outsourcing a task does not outsource accountability. So what about the more elusive high-level risks? Things like management override or low governance expertise. These are notoriously difficult to tie to a specific account assertion because they're risks of intent, not just simple error.
That is where you have to shift your defense. You move from specific automated transaction controls, which a determined manager can simply override, to broader judgment-based detective and monitoring procedures.
How does that work in practice?
There was a vivid example in the research we looked at. It involved an engagement team that suspected management fraud. The company had weak financial results, and a critical debt covenant renewal was coming up, making the current ratio highly sensitive.
So the pressure was on.
Immense pressure. The team couldn't point to any specific faulty transaction in AP or sales yet, but the overall risk was just palpable, high.
So how did they adapt their P10 strategy without a clear account to focus on?
They moved into a posture of heightened vigilance, just more professional skepticism across the board. They increased general alertness among all personnel. They focused intense scrutiny on the accounts that comprised the current ratio, especially estimations and fair valuations.
Because those are subjective.
Exactly. Inherently subjective and easier to manipulate. They assign only their most senior, most experienced people to review these judgmental areas. And maybe most importantly, they significantly increase their inquiries of lower-level employees about any unusual or out-of-policy requests made by management.
So it became more about human intelligence than system checks.
Precisely. It shows that when the risk is override, the P10 control response is less about system checks and more about senior judgment, skepticism, and human-level detection.
That's a critical insight. Now let's talk about relying on external parties, specifically service organizations. If a company uses a vendor for, say, payroll or custody of assets, they need controls over that relationship.
Absolutely. If you outsource, you must monitor. When reliance on a service organization's internal controls is necessary for financial reporting, especially for a public company, a Type 2 SSAE 16, now it's called a SOC1 report, is required.
But isn't a Type 1 report enough if management just needs to confirm the vendor has appropriate controls designed? Why do auditors always insist on Type 2?
That is a really common misconception. A Type 1 report, it only covers the design of controls at a specific point in time. It's a snapshot.
Just one day.
Just one day. To actually rely on the controls to reduce your own testing, you need assurance that the controls were operating effectively over a period of time, usually a year. That's what the Type 2 report confirms. Without it, you just have insufficient evidence.
And there's more to it than just getting the report.
Oh, much more. Management has to read the entire thing, analyze any identified findings or exceptions, and ensure the report's period of coverage is appropriate. And this is so important, we have to emphasize that the handoffs of data are the client's sole responsibility.
What do you mean by that?
The service auditor's report covers the vendor's internal processes, but the activities leading up to the data handoff from the entity and the activities following the data handback to the entity like data validation procedures, those are entirely outside the scope of the service auditor's review.
So, garbage in, garbage out.
Exactly. If the client sends bad data, the vendor will process bad data. And that seems like a prime area for a control gap.
It really is. This is why the SEC has, for a decade now, advised public companies to include a right to audit clause in these contracts. In theory, this lets the client send their own auditors in.
In theory. In practice, vendors often resist this fiercely. They cite proprietary systems, security concerns. But if the SOC report is poor, or if a right to audit clause is refused, the difficulty is not an excuse. You simply cannot rely on the controls, and you must increase your own substantive testing.
Okay, finally within P10, let's look at the structure of controls. Preventive versus detective. What are the key trade-offs management has to consider?
Well, preventive controls are the gold standard. They stop errors before they contaminate the accounting records. Think about the department store security tag. It prevents the inventory shrinkage from happening.
Effective, but probably expensive.
Highly effective, but very costly to design and implement for every single step in a complex process. Detective controls, on the other hand, like a physical inventory count compared to the perpetual records, they identify errors or irregularities after the fact.
So they're cheaper, but there's a delay.
Exactly. They might be cheaper, but they introduce a time lag. If a material error occurred 3 months ago, discovering it now still means those 3 months of financial reports were based on faulty data. The correction process takes time.
So for either type to be effective, there's a dual requirement.
Yes. For any control, whether it's preventative or detective, to be effective, it has to have two components: an error detection mechanism and an error correction mechanism. A control that identifies a variance, but then fails to ensure that variance is investigated, resolved, and corrected in the records is only half a control, and therefore potentially ineffective.
I remember the material we reviewed pointed to a historical problem with auditors over-relying on monitoring activities to dismiss deficiencies in transaction controls.
That trend was unfortunate. Before the 2009 COSO guidance on monitoring, it was pretty common for assessments to dismiss transaction-level deficiencies by just citing monitoring controls. The argument was, well, management reviews the weekly sales reports, so they'll catch the error.
Right, which sounds plausible on the surface.
It does, but COSO clarified that this practice was undesirable. While strong monitoring is vital, it should be an activity above the transactional level. It's a check to ensure the underlying controls are operating. It shouldn't function as the primary, detailed transaction control itself.
This moves us seamlessly into the language used to articulate and document these controls: financial statement assertions. While we've talked about Principle 10 being about selecting controls, assertions are the specific criteria that provide the framework for that selection.
Assertions are not just academic, they are the foundational language of audit assurance. They ensure that when you assess controls around cash or accounts receivable or revenue, you cover every possible risk angle. They're a complete inventory.
What makes them so valuable, especially when you compare them to the older approach?
They ensure breadth and consistency. They're incredibly useful when you encounter unique or highly specialized activities where predefined, customized control objectives might not exist. Think of a company dealing in complex derivatives or securitizing assets.
Right.
The assertions are consistently applied across balances, income items, and disclosures, and perhaps most practically, they easily align with the independent auditor's approach. If you invent your own terminology, the auditor has to map it, which translates directly to extra hours and higher fees.
Let's detail the assertion schemas then. The source material broke down the AICPA's 13 assertions and the PCAOB's simplified 5.
The AICPA framework gives you the most granular view. They break them down by what they apply to. So for the income statement and transactions, you have 5. Occurrence?
Did it actually happen?
Right. Then completeness was everything that should have been recorded.
Yeah.
Then you have accuracy, cutoff,
Proper period.
and classification, so the right account.
Okay, that's 5. What about the balance sheet?
For balance sheet accounts, there are 4. Existence, rights and obligations, completeness, and valuation and allocation. That last one covers all the subjective estimates, reserves, cost allocations, and so on.
And for disclosures?
And for presentation and disclosure, you have 4 more that focus on transparency: occurrence and rights and obligations, completeness, classification and understandability, and accuracy and valuation.
That is a lot to remember. The PCAOB approach tries to simplify that down to 5.
Correct. The PCAOB collapses those 13 down to 5 core ideas: existence or occurrence, completeness, valuation or allocation, rights and obligations, and presentation and disclosure. Some firms even go down to 4, assuming the other concepts are inherently covered.
Which is helpful, but you could miss something.
You could miss a nuanced risk, like whether the disclosures are truly understandable by the average investor.
Give us an example of how the application of an assertion depends entirely on the context.
Let's stick with the valuation assertion. If you're assessing a small business, all cash held in U.S. bank accounts, denominated in USD. The valuation assertion over that cash account is generally irrelevant.
You're zero risk.
Right, you can scope it out. Now, contrast that with a multinational company holding cash in dozens of currencies, subject to daily fluctuating exchange rates, requiring currency translation for consolidation.
Suddenly valuation is a huge risk.
It immediately becomes a material, high-risk area requiring significant controls. The assertion is the same, but its relevance and complexity swing dramatically based on the entity's facts. It all goes back to Principle 10.
I always find that the risk around cutoff is fascinating because it's
Yeah.
so often tied to human motivation, especially with revenue.
Cutoff is a behavioral risk. It's about whether sales and costs are recorded in the proper period. The classic example is the 35th of December, meaning management leaves the books open past year-end to include transactions that belong in the next period.
And why do they do this?
Almost always to meet specific targets. Maximizing reported income for debt covenants, shifting expenses, hitting sales commission thresholds, management bonuses,
The usual suspect.
the usual suspects. And when you document the controls, you have to be clear on which assertion is violated. If you're prematurely recording sales, that's an occurrence problem. The sale didn't occur in the period. If you're neglecting to record accrued liabilities, that's a completeness problem. It's a critical distinction.
Let's tackle the core distinction now. Control objectives versus assertions. I know a lot of internal audit teams grew up on the 1992 COSO framework and still prefer the objectives approach.
The 1992 framework popularized control objectives. And it was an advance because it forced the assessor to think about the process of how an objective was achieved.
So asking how?
Right. For example, the objective might be, how does the company ensure that all cash disbursements are approved and accurately made out to the correct vendor? This forces teams to detail the procedures. The inherent weakness, though, was that there was no complete, recognized inventory of objectives. You were kind of inventing them as you went.
Which could lead to gaps.
Inconsistencies and potential gaps. And the 2013 framework solved that by adopting assertions.
So the shift to assertions is simpler, universally accepted, and provides a complete, finite list of risk areas.
Exactly. You check your controls against the assertions, and you know you've covered the waterfront. But here is the trade-off, and this is important for documentation. While assertions simplify the criteria you apply, a single assertion, say, completeness for the inventory cycle, might be associated with multiple control procedures along the entire transaction path.
So while the list of assertions is shorter, the documentation under each one can be much heavier because it pulls in controls from everywhere in the flow.
Precisely. To ensure the completeness of a single sales transaction, you might document controls around order entry, the warehouse pick list, shipping, invoicing, GL posting, and they all map back to that single completeness assertion. It increases the documentation burden under that umbrella.
Okay, finally, let's talk about organizing the assessment. Accounts versus transaction cycles.
The classic auditing approach often uses the account approach: cash, AR, inventory. But for internal control assessment, the transaction cycle approach like purchase to pay or sales to cash collections is often superior.
Why is that?
Because it reflects how companies actually organize their business and their people. You have a VP of sales, a VP of purchasing. You don't have a VP of fixed assets.
Right.
The cycle approach gives you a more integrated understanding of processes and controls around related accounts. The sales cycle naturally connects controls over revenue and accounts receivable. This minimizes the risk that key control aspects fall between the chairs.
Yeah, I imagine it makes the walkthroughs much cleaner.
Far cleaner. You can follow a transaction from inception, a purchase order, through all its steps to final recording without jumping between disparate departments. It just aligns the whole assessment with how the business actually works.
This shift to transaction cycles immediately leads us to Principle 11, technology. The influence of IT isn't ancillary anymore. The source material made it clear that technology is now linked to 14 of the 17 COSO principles. It's the inescapable scaffolding for modern financial integrity.
Technology is the foundation. If the foundation is weak, you can put the most beautifully designed transaction controls on top of it and they will still fail. To understand Principle 11, we have to clearly distinguish between application controls and general controls, or ITGCs.
Okay, what's the difference?
Application controls are specific to a software program's processing. These are things like input validation checks, sequential numbering on invoices, or the automated reconciliation of a batch file. They directly ensure completeness and accuracy of transactions.
So we test those with the transaction controls in P10.
Correct. General controls, ITGCs on the other hand, operate at the system level, above specific applications. Their purpose is to ensure the integrity of the overall technical environment. If ITGCs fail, say if security is compromised or change management is lax, it severely undermines your ability to rely on those specific application controls.
It's the barn door analogy. If the system security is poor, the fact that your automated inventory control works perfectly is kind of moot, because someone unauthorized could just log in and manually change the count.
Exactly. The ITGC failure doesn't cause the accounting error directly, but it creates the environment where errors or unauthorized changes can happen undetected. It compromises the reliability of the system itself.
So how does management initially determine the scope? Which systems and applications fall under this intense scrutiny?
They have to map the dependency. This requires clear flowcharts and diagrams showing how accounting functions interface with all computer programs, networks, and, critically, standing data files like customer pricing masters or vendor lists, which can dramatically impact financial statements.
And it's not just the core accounting system.
Not at all. Management has to consider peripheral production systems that might feed financial information. For example, a quality control system that generates data used to calculate the warranty accrual liability needs to be scoped into the assessment.
And then there's the elephant in the server room, the ubiquitous spreadsheet.
The spreadsheet problem. We cannot forget these. Spreadsheets are often treated as simple data tools, but when they're integral to financial reporting used for complex valuation models, tax provisions, impairment calculations, they are functioning as custom software.
With none of the controls of custom software.
Pretty much. Organizations like the European Spreadsheet Risks Interest Group have documented the shockingly high failure rate of these critical spreadsheets. The inherent risks, accidental formula deletion, input errors, version control issues, they must be mitigated with controls, otherwise they're a huge gap in P11.
So they need documentation, testing, access controls. The works.
Just like any other piece of software.
Let's drill down into the 4 essential components, the pillars of ITGCs. Let's start with security and access, which seems to cause the most headaches.
Security and access is almost always the most critical area and the one most likely to reveal deficiencies. It boils down to restricting system access to the minimum necessary for a person to perform their job, what we call least privilege. Allowing unauthorized or excessive access just drastically increases the risk of fraud and increasingly exposes the entity to regulatory fines related to PII or other sensitive data.
So why do the simple fixes in this area seem to be perpetually ignored?
It's a paradox, isn't it? Convenience versus security. The simple, low-hanging fruit effective password policies, physical security for servers, strict control over shared accounts are continually neglected. We've all heard the stories of default admin passwords sitting unused for years, or passwords on sticky notes taped to monitors.
It doesn't take a genius to fix that.
It requires disciplined policy deployment, which ties directly back to Principle 12, yet these basic deficiencies remain high on the list of identified weaknesses every single year.
Okay, moving to the second pillar.
Yeah.
Change controls. When should management focus on these?
Change controls are essential anytime systems are custom-built, modified, or upgraded. They establish the necessary workflow for change: initiation, approval, programming, rigorous testing, and authorized acceptance before the change goes live.
And if they fail?
If they fail, unauthorized or untested code can be introduced, potentially causing data corruption, financial misstatement, or system instability.
I remember that fascinating case study about the decades-old statistical sampling program.
Oh, right. The company had failed to maintain or upgrade it. Eventually, new, faster hardware was introduced, and the legacy software, unable to handle the increased processor speed, literally broke. It couldn't find the external data files it needed anymore.
That sounds like a failure of both Principle 11 and Principle 10, since the control for the audit was now non-operational.
It was, and the absurd temporary fix was to physically retard the speed of the processor whenever that specific program needed to run, just to make the legacy software function until a replacement could be built. It's a powerful lesson in the risk of waiting too long to upgrade.
The third pillar is new systems development, which is about safety during major overhauls.
This focuses on massive shifts, like replacing a legacy homegrown system with a commercial ERP. You need a formal methodology, the Systems Development Lifecycle, or SDLC.
But the single most critical and often overlooked control here is the backout plan.
It's everything. We saw a catastrophic failure during a Y2K conversion at a major equipment rental company. They relied on an internal, untrained IT team to handle the cutover. In the confusion, millions of dollars of receivables, data, and customer history were just lost near fiscal year end.
They didn't have backups.
They thought they did, or they assumed the old system was viable for restoration. But due to poor planning and testing, the restoration failed. The loss of data was so severe and the process of recreating the ledger so expensive, it caused major financial losses and disrupted operations for months.
The lesson being, have a tested backout plan.
And adequate technical assistance. Never do it alone.
Finally, we have operations and maintenance.
This covers two primary functions: analysis of user complaints and, most importantly, backup and disaster recovery planning. This is the ultimate preventative measure against system loss.
The leaky roof problem.
That's it. You only need the plan when everything is going wrong, yet you only create it when everything is fine. Electronic data is the lifeblood of the company, so management needs a rigorous risk assessment to determine the criticality of each system and the recovery time objective.
And the location of those backups is just as critical as their existence.
Absolutely. Disaster recovery plans have to account for geographically broad disasters. We know of the devastating case study of a company that lost its main office in the World Trade Center on 9/11, only to later discover their offsite backups were stored in the second tower. A major, localized event can compromise backups stored miles away. A truly effective P11 control requires geographically dispersed backups, redundant hardware, and regular testing of the recovery plan.
One final point on ITGCs. The historical anomaly regarding deficiency severity.
Yes. Historically, severe ITGC failures, say terrible change management, were sometimes downgraded by auditors. The logic was ITGCs are overarching, but they don't cause a transaction error directly.
So they'd wait for something to actually break.
They'd wait to see if an underlying application control failed as a result. If it was okay, the ITGC weakness might not automatically get a material weakness rating. However, since the 2013 framework gave ITGCs their own principle.
Principle 11.
This view is changing rapidly. Weaknesses in security and access, for instance, arguably meet the standard for a material weakness if they could reasonably permit a material misstatement to occur, regardless of whether a transaction failure has been proven yet. P11 weaknesses are now being treated with the high severity they deserve.
Okay, so we've completed the design phase, we know the risks with P10, and we secured the technology with P11. Principle 12 is arguably the most practical and crucial principle. Deployment. It's about execution, making sure management's directives transition from policy into daily action.
This is where we see the most practical failures. They often trace back to human error, competence issues, or accountability gaps. Principle 12 is all about ensuring directives are converted into clear policies and procedures and then executed by competent personnel in a timely manner.
Even for simple companies.
Even for entities without complex ERP systems, you still need documentation. A procedures manual outlining control execution for processing, estimates, accruals, and the critically important period end close.
Let's talk about documentation format, which is often a source of debate. Narratives versus matrices.
Both are acceptable, but they have major trade-offs. Narratives, which describe the process flow in detail, are thorough, but they are often criticized for being difficult to read, time-consuming to update, and sometimes they fail to clearly delineate the actual control from the routine process.
Right, it all gets blended together.
Exactly. Matrix templates, on the other hand, are highly efficient. They usually list the control, the responsible party, the frequency, and the direct linkage to the assertion. They simplify the documentation burden and make it much faster to update or trace back to a specific risk. Efficiency and clarity often favor the matrix approach.
Now, let's move away from documentation and into implementation. Instead of just reading the checklist of the 6 points of focus for P12, let's frame them around the top reasons deployment actually fails on the ground.
That's a great approach, because P12 failures are rarely due to the policy existing, but rather due to the policy not being followed.
So what's the first failure point?
The first one revolves around establishing responsibility and accountability. This is Principle 3 structure and authority driven down to the detail level. If a control requires a senior manager to review a reconciliation, that line of responsibility must be absolutely clear.
But if it's ambiguous?
If it's ambiguous, or if exceptions arise, a large, unusual transaction, for example, and the employee doesn't know who to channel the exception to, the process just stalls. This gap in accountability is often a cause of significant control failures, where exceptions simply pile up unresolved.
And the second failure point relates to the clock. Timely execution.
Absolutely. A detective control that is performed 3 months late is nearly worthless. Failure to execute on time means delays in detecting and correcting errors. Management needs mechanisms in place to detect these processing delays.
What does that look like?
It can be as simple as open lines of communication. But more effectively, it involves analytical procedures or programmed flags in the system that signal when a transaction is overdue for review. A key P12 failure often involves management neglecting to review system-generated exception reports.
I imagine the third point, corrective action, follows directly from that.
It does. Timely identification of issues is useless without timely and complete resolution. The corrective action phase requires a closed loop. If an analytical procedure flags a variance, the issue must be investigated, the control weakness that allowed it must be addressed, and the records must be corrected. A deployment failure happens when management identifies issues but fails to follow up.
The fourth point focuses on use of competent personnel. This sounds like a Principle 4 failure that manifests as a Principle 12 deficiency.
It is a critical link. Performance deficiencies at the control activity level, an employee repeatedly failing to perform a required check, often indicates a weakness in Principle 4, competence, or maybe reflects inadequate management specification of the position or poor training.
So a good procedure manual can help.
A well-written, accessible procedure manual, which is part of P12, is an essential guide. It significantly reduces the pain of learning experiences for new employees. A clear procedure manual is itself a form of control over competence risk.
We can't ignore the fifth point, assessing segregation of duties.
So SHEDI has to be assessed continuously. The intent is to reduce the opportunities for any single person to initiate, approve, execute, and conceal errors or irregularities. And this extends critically to the IT environment. If a systems administrator who has broad access to make changes under P11 also has access to process financial transactions, the risk of fraud or undetected misstatement just skyrockets.
And finally, policies can't be static. The sixth point is reassessing policies and procedures.
Policies have to be living documents. They must be reevaluated continuously based on operational feedback, employee suggestions, and most importantly, changes in the business environment. For example, if a line of business that was formerly immaterial suddenly becomes a major revenue driver, the risk assessment changes immediately.
Which means the controls and policies need to change too.
It signals the need to beef up the associated control activities and documentation under P12. If management neglects these signals, the deployment of controls rapidly becomes outdated and irrelevant to the entity's current risk profile.
This has been an incredibly detailed look into the engine room of control activities. We've systematically dissected the scaffolding of internal control, the risk-based foundation that drives necessity, which is Principle 10,
Right.
the essential technical security and development infrastructure in Principle 11, and the necessary execution and human infrastructure required for follow-through in Principle 12.
You know, the greatest enduring insight from the 2013 framework is that shift to financial statement assertions as the primary language of control documentation. While those familiar with the older objectives approach may experience a learning curve, the assertion framework provides a more durable, efficient, and complete methodology for ensuring all risk areas are covered.
The goal is the same, no gaps, but the tool is more robust.
Exactly.
And for you, the listener, we have consistently highlighted how deeply intertwined these 17 COSO principles truly are. We saw how a breakdown in the human element of deployment in P12 can be caused by a lack of competence from P4, and how a weakness in Principle 11, the ITGCs, can compromise your reliance on transaction controls in Principle 10. We also discussed the paradox of IT security and access controls, that they're often the easiest, most straightforward deficiencies to fix, yet they remain high on the list of identified weaknesses in businesses globally. That gap speaks volumes about the challenge of moving from a well-written policy to disciplined daily execution.
I'll leave you with this final thought. The framework implies that solving a control problem often requires fixing an organizational or cultural problem first. Consider the implication that a failure in one of the lower-level principles, like P11 or P12, often demands action at the highest levels, impacting Principle 1, tone at the top, and Principle 3, organizational structure. Exploring the documented linkages between all 17 principles is the ultimate challenge in understanding internal control, because it shows that a robust system is truly holistic. A failure in one component affects the reliability of all the others.
That is all the time we have for this deep dive. Until next time, keep those books balanced and keep asking why. Welcome back to the deep dive, where we take these really intimidating piles of policy documents, compliance requirements, and just dense financial frameworks, and we turn them into knowledge you can actually use.
Right.
You are here for the shortcut, And today we are delivering some pure cognitive gold from the world of financial controls.
Today is a really crucial mission. We're navigating the foundational architecture of corporate accountability. We're going to be diving deep into the Committee of Sponsoring Organizations of the Treadway Commission.
Better known as COSO.
Much better known as CO, yes.
Mm-hmm.
Our source material today is, the technical bets of the operation excerpts from the 1992 Internal Controls Integrated Framework and also the 2006 guidance for smaller public companies.
And this is really the stuff that defines whether a company's financial reporting is trustworthy. For most people, COSO is just this high-level acronym they hear about. But our sources today, they provide these highly spiralized matrices that show how the COSO principles, which is really the why of control, must map directly to specific control activities, the how.
And that's the key, the how that's necessary to satisfy the core financial assertions that auditors and regulators like the PCAOB are actually verifying.
Exactly.
Our goal for you is to really understand that precise mechanical link, the link between a high-level corporate objective and, say, a daily safeguard in the purchasing department or the shipping warehouse.
We're moving beyond just the textbook summary.
Way beyond. We're getting into the customized operational detail that ensures financial integrity in the real world.
So if you're prepping for a critical meeting, or maybe you're documenting your own compliance, or you just want to truly understand what happens when a control fails, this deep dive is going to provide that structure.
It's a framework for not just documenting controls, but for critically analyzing their effectiveness.
All right, let's start with the essential building blocks.
So the COSO framework, it's structured around 5 components, but the practice aids we're looking at today, they focus really heavily on the practical application. So they're providing sample control objectives for 4 of those 5 components: the control environment, monitoring, information and communication, and risk assessment. These objectives are kind of the translation layer.
And what's really important to understand right away is that the source material comes with a major warning label, right?
A huge one, yes.
It explicitly says these are only practice aids and that customization is mandatory. You can't just copy-paste your way to compliance here.
Absolutely not. That's maybe the most valuable takeaway from the very beginning of the document. It stresses that these objectives must be customized to specific industries, specific business circumstances, specific organizational risks.
Can you give us an example of that?
Sure. Imagine trying to use the inventory control objectives designed for, say, a fast-moving retail operation, and applying those to a heavy manufacturing plant that only produces a few highly complex custom pieces a year. The risks are a completely different ballgame.
That immediately challenges that whole idea of a simple compliance checklist. It forces you to actually think. It does. So what are the key considerations the source material tells us to review when we start documenting these controls?
It tells readers to consider 3 key elements right up front: completeness, avoiding redundancy, and capturing the appropriate level of detail.
And getting that balance wrong is a huge problem.
It is. If you try to document too many controls, you get redundancy. That wastes resources, and frankly, it just confuses employees. But if you don't capture enough detail, you leave dangerous gaps.
So the goal is the most efficient, targeted control necessary to mitigate the risk.
Exactly.
Okay, so we've established that controls must be bespoke. Now let's define what those controls are actually protecting, which brings us to the core language of financial integrity. The PCAOB assertions.
Correct. These are the claims management is making about the financials that auditors have to verify. Every single dollar amount, every disclosure, every line item in the financial statement is implicitly a claim by management.
And those claims are grouped into these assertions.
And understanding these is the key to assessing any control. A control is only effective if it successfully addresses one or more of these assertions.
Let's take a minute then to really nail these definitions, because they are the framework for the rest of our deep dive.
Good idea. We can break them into a few categories. First, we have the assertions focused on, whether things are real and complete.
Okay.
That's existence and completeness. Existence is basically asking, does that asset or liability physically or legally exist at the balance sheet date?
And completeness is the flip side of that coin.
It is. It's the inverse. Have all transactions or balances that should have been recorded actually been recorded? A failure of existence could mean you're recording a fake asset. A failure of completeness could mean you're hiding a liability.
So that's the is it real and is it all there the bucket. The next major category focuses more on the numbers and ownership. That would be valuation and rights and obligations.
And valuation is arguably the most subjective area. It asks, are the accounts recorded at the correct dollar amount? And that includes using proper estimates, reserves, accounting principles.
This is where we worry about mispricing inventory or under-reserving for bad debt.
Exactly. And rights and obligations is all about legal ownership. Does the company legally own the assets it's claiming, and are the liabilities truly the entity's obligation?
Okay, that's clear. We also have assertions that are focused on timing and classification.
That brings in occurrence and allocation cutoff. Occurrence is about the transactions themselves. Did the recorded transactions actually happen and pertain to the entity during this period?
So this is what prevents fictitious sales or, someone recording unauthorized expenses.
Right, and allocation cutoff is critical, especially for annual and quarterly reporting. It's asking, are transactions recorded in the proper period, and are costs allocated correctly according to GAAP?
And finally, there's the assertion that sort of wraps everything up. Disclosure presentation.
That's the one. It ensures that all accounts are properly classified, described, and disclosed in the footnotes and the body of the statements. Even if the numbers are 100% correct, if a related party transaction is hidden, the statement fails the disclosure assertion.
So that's the whole matrix.
That's the entire matrix. Yeah. Every single control we're about to detail must map successfully to one or more of those 7 assertions.
With that architecture now in place, let's jump into the tactical application. We are moving into Appendix 5A, the transactional heart of the business cycle matrices.
Let's do it.
We're going to begin with the lifeblood of any company, the revenue cycle. This is where misstatements so often start and where fraud is notoriously frequent.
And before we even look at sales or cash, we have to acknowledge the one control that is foundational to all others. It's listed first for every single cycle we review.
And that is segregation of duties.
The foundational firewall.
So why must functions with potential conflicts, like, say, customer approval, sales authorization, and cash receipts, why must they be segregated? And why does the source link this one control to all of the assertions?
Because if you have perfect controls in every other area, but one single individual can perform incompatible duties, they can bypass the entire system with ease.
So it doesn't matter how good the other locks are if one person has all the keys.
That's a perfect analogy. Think of it this way. If one person can generate a sales invoice, that's execution, then post the revenue to the general ledger, that's recording, and then handle the cash coming in, that's custody.
Then they control the entire loop.
They control the loop. They can generate a fictitious sale, pocket the cash, and then cover their tracks by adjusting the account's receivable balance.
So by doing that, they violate occurrence because the sale was fake, existence because the cash disappears, completeness because the receivable balance is wrong, and valuation because the final numbers are misstated.
Wow. It's the single biggest risk factor. A breakdown here means all your other controls are just theoretical. They're not actually effective.
Okay, that makes perfect sense. Now let's look at the specific gears of sales and invoicing. First up is sales prices. The objective is to ensure prices used in recorded sales are accurate.
And this is a direct shot at valuation.
But how does a strong control handle this? Is it just like a paper price list sitting on someone's desk?
Oh no, a strong control here is almost always automated. It's about restricting access to the master pricing file and implementing system-enforced validation.
So you're saying the risk isn't just accidental typos?
Not at all. The risk is intentional manipulation. A salesperson deliberately underpricing a massive order for a friend or for a related party. The control has to be the system automatically validating the price against a price book that can only be changed by a non-sales manager, often with a 2-step approval.
So that moves it from a detective control, like checking it later, to a preventive control. It stops it before it even happens.
Exactly. That distinction is critical.
Okay. Next, we differentiate between fake sales and missing sales. For occurrence, the objective is that only valid sales orders are fulfilled.
This is crucial for weeding out fraudulent transactions that are designed to inflate revenue. The control here is typically the authorization process. You're ensuring the customer is real, their credit is approved by the credit department, which is separate from sales, and the order matches established terms.
And a failure here directly compromises occurrence and artificially inflates the existence of your receivables.
Right. You're recording revenue that you will never, ever collect.
Conversely, for completeness, the objective is twofold. All valid orders are processed, recorded, and filled. And a sales invoice is generated for every single shipment.
This protects the company from leaving money on the table. The failure risk here is usually operational. The shipping department sends the goods, but the accounting department never gets the paperwork to generate the invoice.
So how do you control for that?
The control is a system-based sequence check. The shipping document, which gets generated automatically when the goods are released, must trigger an invoice within a set time frame. The system then flags any missing sequence numbers. It ensures every dollar you earn actually gets recorded.
Okay, we also need to talk about timing, which brings in period cutoff. The control is that invoices and deliveries are recorded in the appropriate period. This hits valuation cutoff. Why is that such a commonplace for misstatement?
Because it's so often manipulated to hit quarterly or annual targets. If sales are a little low at the end of December, a manager might push the accounting team to record revenue for goods that actually shipped in January,
Which overstates December's revenue and understates January's.
and leads to a major valuation error for both periods. The control has to require strict physical evidence like dated shipping documents signed by the carrier and procedures that literally freeze transaction recording at midnight on the cutoff date.
And since revenue isn't guaranteed until the cash is in the bank, we need controls over estimates. Specifically, the allowance for doubtful accounts being properly estimated. This is a direct valuation control.
Absolutely. This is where subjectivity really enters the picture, and so controls have to be applied to the methodology itself.
It's not just we have an allowance.
No. The control is more like the model we use to calculate the allowance aging analysis, historical loss rates complies with GAAP, is periodically reviewed for current economic conditions, and the resulting adjustment is reviewed by senior management who are separate from the operations team.
And failure there means the net value of your accounts receivable is overstated, massively compromising valuation.
Yes.
Let's move to the physical side. Shipments. Controls need to ensure the correct goods are shipped and accurately recorded.
This ensures that the quantity and the type of inventory leaving the building actually match what the invoice says. It's a key preventative measure against both theft and simple error.
And it secures valuation, because if you ship 100 units of expensive item A, but record 100 units of cheaper item B, your sales revenue is just wrong.
Correct. The control often involves scanning the product against the picking list and the bill of lading and verifying that transfer of custody.
And finally, the most liquid risk of all, cash receipts. The control is that cash receipts are accurately recorded. The source maps this to completeness, existence, and valuation.
This is often secured through bank lockboxes or an immediate documented transfer of receipts to a treasurer who has zero access to sales recording.
So you're hitting all three assertions.
You are. Completeness is secured by ensuring every receipt is logged. Existence is secured by immediate bank deposit. And valuation is secured by matching the receipt amount to the expected payment, especially with discounts or foreign currency. If a receipt is short, the valuation control demands immediate follow-up.
All right, if revenue is about securing the inflow, purchasing and cash disbursements is all about controlling the outflow. This cycle is critical for liability management and expense control.
And once again, we have to start with the core segregation. Vendor approval, purchasing, and payment processing must be segregated. This remains the foundational firewall protecting all assertions.
And the classic failure here is the ghost vendor scheme.
The absolute classic. An employee creates a fake supplier and starts approving payments to themselves. Segregation stops this by requiring an independent, non-purchasing department to verify the vendor's existence and legitimacy before they're ever added to the master file.
Okay, let's focus on the beginning of the transaction, purchasing and receiving. Controls need to ensure purchase orders and service requests are authorized, complete, timely, and accurate.
This objective prevents the creation of unauthorized financial obligations. It secures occurrence, we didn't just accidentally create a purchase order, and it ensures the cost basis for future inventory or expense is correct, which secures valuation.
And what's a good preventive control there?
It's usually an automated limit. Any purchase order over a certain dollar amount requires 2 levels of management approval before the system even allows it to be sent to the vendor.
Got it. Then the receiving objective acts as the external check. All goods and services received were actually ordered and were processed accurately and recorded in a timely way.
This is the critical second step in that 3-way match we mentioned. You have the purchase order, the receiving report, and the invoice.
And the control is in the independence of the count.
Yes. The receiving clerk must count the goods and sign off, but they do it without seeing the purchase order quantity. It ensures an independent count. This confirms the occurrence, the goods really did arrive, and ensures accurate valuation. A failure here means we might pay for goods we never received.
Moving on to invoice processing. The objective here is to ensure all invoices are promptly and accurately processed, and critically, that duplicate processing is prevented.
Duplicate payments are a surprisingly common control failure, especially in manual systems or when systems don't properly tag an invoice as paid.
So this control hits occurrence, valuation, and existence.
It does. It prevents the transaction from occurring more than once occurrence, ensures the correct amount is paid, valuation, and makes sure the liability is cleared after the first payment existence. A strong control uses the unique invoice number as the primary system key and forces a block if that number is entered a second time.
Now for the ultimate outflow, cash disbursements. This objective is huge. It requires payments to be authorized, good services received, recorded in the proper period. And it adds that duplicate payments must be prevented, and long outstanding payments, like uncashed checks, must be investigated.
Right. This secures rights and obligations we are obligated to pay and valuation. And that investigation of long outstanding checks is a crucial detective control for completeness.
How so?
Well, if a check has been outstanding for 6 months, you have to ask why. Did the vendor lose it? Or maybe, was the payment sent to a ghost vendor who decided not to cash it yet? A proper control dictates that after a certain period, say 90 days, the check must be voided and the liability reinstated, which then triggers a full investigation.
That's a great example of a detective control leading to an investigation. And given the shift to digital, the source material specifically calls out EFT controls. Electronic funds transfers must be authorized in advance as to amount and payee.
This is so critical. EFTs move money instantly. You lose that stop payment cushion you have with a paper check. This makes pre-authorization a paramount preventative control, and it secures valuation, existence, and completeness.
And the control needs layers.
Layers are essential. Separate approval for adding a new PayESO master file access is restricted, and then dual authorization for any EFT over a high threshold. Failure here can lead to immediate, massive, and often irreversible financial loss through wire fraud.
Okay, let's move on to inventory and fixed assets. These involve the highest capital costs and require reconciling physical security with complex accounting rules.
The complexity here is massive, and for inventory, the foundational control, again, is segregation. You have to separate purchasing, inventory record keeping, the physical counting, and physical access. This protects all assertions.
Because if the person who counts the inventory can also adjust the general ledger.
They can steal assets and completely cover the loss. It's that simple.
In a manufacturing environment, inventory transfers are continuous and complex. So transfers between locations or categories, raw materials, WIP, finished goods, must be authorized, accurate, and complete.
This is vital because the valuation of that inventory changes at every single stage. Raw materials become more valuable as labor and overhead are added to work in process.
So the control is in the documentation.
It is. It requires documented authorization for the transfer and accurate accounting records that track the accumulated cost, the labor hours, the applied overhead. If a transfer is unauthorized or miscounted, it compromises valuation and completeness across multiple inventory lines at the same time.
The heart of this complexity, then, is in the costing. The objective requires detailed records of product costs, materials, labor, overhead at each stage. This is a pure allocation valuation assertion.
And this has to comply with GAAP. The control requires rigorous internal cost systems, whether it's standard costing or actual costing, that consistently track and apply all three cost components. If you fail to properly allocate overhead, for example, both your current inventory balance and your future cost of goods sold will be materially misstated.
And we also deal with various inventory methods, LIFO, FIFO, weighted average. The control is that these methods must comply with GAAP and be consistently applied.
Consistency is just as important as the method itself. If a company flips between FIFO and LIFO without disclosure and justification, or applies it inconsistently across different products, the financial statements become opaque and misleading.
So that severely compromises the allocation valuation principles.
It does. The control here requires written policies that dictate the method and a formal approval process for any necessary change in that methodology.
For manufacturers that use estimated costs, the standard costing nuances come into play. Standard costs must be updated, maintained, and changes approved and documented.
Right. And variances must be updated and applied to inventory and cost of sales per GAAP. If your actual costs start deviating significantly from your standard costs, say raw material prices spike, and the standard cost isn't updated, the variances become distorted.
And the company loses its ability to manage production efficiency.
Exactly. So the control requires a periodic review, maybe quarterly, of variance accounts and mandatory sign-off from both production management and finance when standard costs are changed. This ensures the new cost basis is documented and correctly applied for allocation valuation.
And what about loss of value? Reserves for obsolete inventory must follow GAAP, and timely write-downs have to be authorized.
This is the anti-optimism control. It's focused purely on valuation. If a product line is discontinued or technology makes a component useless, that inventory has to be written down to its net realizable value.
And the control for that?
The control requires a committee independent of the inventory purchasing team to conduct regular obsolescence reviews based on sales forecasts, product life cycles, and how long it's been sitting on the shelf. This ensures that write-downs are authorized and happen in a timely manner.
Tying it back to physical reality, the physical controls protecting inventory from theft, misuse, or damage support, existence and completeness.
This means locked warehouses, video surveillance, restricted keycard access. The failure here isn't an accounting error at first. It's a physical loss that leads to an accounting error if it's not discovered.
So the control must require periodic cycle counts or a full annual physical inventory.
Yes, to reconcile the physical reality to the perpetual inventory records. That secures existence and uncovers any unrecorded losses, which is a completeness issue.
Okay. Shifting over to fixed assets. Let's look at capitalization. Expenditures must be approved and documented before acquisition.
This is a preventative control over the decision to spend cash. It secures occurrence, meaning the transaction was authorized, and valuation, meaning the recorded asset cost is accurate. Capital assets are large, infrequent purchases, so the control often involves a formal capital expenditure request, or CER, that requires board or senior management approval before a PO is even generated.
And for completeness and rights and obligations, all fixed assets, including new ones, have to be recorded accurately and timely, and the assets recorded must actually be owned by the entity.
The control must ensure the tracking system, the subledger, captures the asset immediately upon receipt. And a key control for rights and obligations is retaining the legal documentation like deeds or purchase agreements in a secure file to verify the company actually has title.
And a failure to record assets accurately is a completeness failure.
It's a common one. Minor assets get inadvertently expensed, and that leads to an understatement of the balance sheet.
The decision to capitalize or expense is a high-risk classification point, so the policy adherence is key. Assets are capitalized or expensed according to GAAP and company policy.
This is a major control supporting valuation. If an expense that should have been capitalized, like a major engine overhaul that extends a truck's life, is immediately expensed, it understates current period income.
And then it overstates the next period's income because there's no depreciation.
Exactly. The control requires detailed policy thresholds like we only capitalize items over $5,000 and review by an accounting manager to ensure consistency.
And then there's the ongoing impact, depreciation. The methods must comply with GAAP and be accurately accounted for in a timely way.
The control here is focused on ensuring consistency and computational accuracy. Whether the company uses straight line or an accelerated method, the control requires that the depreciation schedule is reviewed periodically and that the calculation is automated within the system, using asset lives that are reasonable and supported by data. A failure in that calculation directly compromises asset valuation.
Finally, impairment and disposal. Assets have to be regularly reviewed for impairment, and disposals must be pre-approved and recorded per GAAP on a timely basis.
The impairment review is a detective control for valuation. If an asset sits idle for a year, the control mandates a review to see if its book value can still be recovered. For disposals, pre-approval and timely recording secure existence, it's gone, and trigger the necessary disclosure of any gain or loss.
So if disposals aren't recorded on time, the balance sheet continues to show assets that no longer exist.
Which is a major compromise of the existence assertion.
All right, let's move to payroll, equity, and treasury. These are specialized high-risk areas.
They are, often because of regulatory complexity, high volume, or just the potential for catastrophic financial loss.
Let's start with payroll. The basis for payroll objective is that payroll is authorized only in accordance with time records or contractual agreements.
This control addresses the twin risks of ghost employees and time card padding. It secures occurrence, the work happened and the payment is valid, and valuation, making sure the payment amount is correct.
And a strong control here.
It requires direct supervisory sign-off on hours worked and a comparison against budgeted or expected hours. That acts as a crucial preventative check.
In the broader objective of completeness and valuation, payroll must be complete and accurate, paid to the proper person, and recorded in the proper period, including all the deductions.
The accuracy of deductions is paramount, especially for compliance. If you calculate tax withholdings incorrectly, the company faces penalties and potential liability. The control here is really the integrity of the payroll system itself. It's the IT general controls over that application, which is Principle 11, ensuring withholding tables are accurate and timely updated.
The source also points to follow-up. Missing, duplicate, or long outstanding checks have to be investigated.
This is a critical detective control. In large organizations, the distribution list for payroll checks has to be cross-referenced against the current employee master file. If a check goes unclaimed, it must be investigated immediately.
Because failure to do so could indicate a ghost employee is still on the books.
Or that an employee left, but their final check was never handled properly. It compromises completeness and potentially occurrence.
Moving to equity, which is always highly scrutinized. The objective. Only authorized changes in shares or partner equities are recorded accurately and in the proper period.
Equity changes affect the ownership structure of the company, and they always require board approval. This control secures existence, the shares recorded actually exist, and rights and obligations, meaning the recorded owners are the legitimate owners.
And this supports the ultimate valuation of the entity.
It does. The control often involves using an independent third-party transfer agent. They maintain the official record of ownership, ensuring accuracy outside of internal management's influence.
Stock options were singled out because of past scandals. The controls must ensure grants adhere to a board-approved plan and prevent backdating or spring-loading.
Yeah, and for any listener who might be less familiar with those terms, backdating is selecting a grant date in the past when the stock price was lower, which immediately makes the options in the money.
And spring-loading
is granting options right before a positive non-public announcement that's expected to drive the stock price up. Both are highly unethical, if not illegal.
So the control here has to be incredibly strict.
It does. It requires the grant date to be strictly governed by the approval date of the board or compensation committee. This secures occurrence and the accurate valuation of that compensation expense.
And the related accounting control requires the valuations of options to record compensation and the retention of appropriate disclosure information.
Right. Option valuation is complex. It relies on models like Black-Scholes. The control requires that the inputs for that model volatility, expected life, risk-free rate are approved by an independent finance function and applied consistently. That ensures accurate valuation and provides the detailed data needed for compliant disclosure.
Finally, treasury and debt management. First up, bank accounts. They have to be properly authorized to open or close, reconciled periodically and in a timely way, and activity has to be monitored for unusual patterns.
Reconciliation is the ultimate detective control for cash. It hits completeness and valuation accuracy. It ensures your internal records match the external reality from the bank. But the authorization control, who can open and close accounts, that's preventative, and it secures existence.
And the failure there is opening unauthorized bank accounts to skim funds or hide transactions.
It's a classic method of large-scale fraud. Cash transfers are inherently risky. Wire transfer transactions have to be limited to authorized individuals and controlled as to amount and timing.
We revisit this because it's just so critical. The control has to include a multi-layered check, the request, the approval, often with a secure online token, and the execution, all performed by segregated individuals.
And this preserves existence and valuation.
A robust control even involves a confirmation phone call by the bank to an authorized signatory on any wire transfer that exceeds a specific threshold. It adds a human-based detective element to the electronic preventative controls. For debt, the borrowing's objective is really broad. Third-party debt and related interest must be complete, authorized, accurate, and recorded in the proper period. And appropriate disclosures must be made, especially for hybrid debt.
Because of the high financial risk and potential for complex covenants, the source rightly maps this to all assertions. The controls need to ensure the debt agreement itself is authorized, rights and obligations, the related interest is calculated correctly, valuation, and that all the embedded derivatives or convertible features, what we call hybrid debt, are identified, valued, and disclosed according to GAAP.
And misclassifying debt can profoundly mislead investors about the company's financial health.
It can. It can hide risk and make the company look much safer than it is.
And the regulatory hot button. Off-balance sheet arrangements have to be identified and accounted for appropriately, in compliance with GAAP.
This control objective directly targets the failure that led to scandals like Enron. The control requires continuous review of legal agreements, contracts, and special purpose entities to ensure no liabilities are being inappropriately kept off the balance sheet. This secures completeness, existence, and valuation.
This brings us to the universal control that underpins every single cycle we just discussed. If the systems fail, every control we've mentioned, from segregation of duties to cutoff, it all collapses. We're talking about the data files objective.
Precisely. The reliance on automated processing means the underlying integrity of the data is the ultimate firewall. And the first control is simple. Access to data files and worksheets is restricted to authorized personnel.
Because these data files contain the master records for every customer, vendor, employee, and loan. So restricting access is key to safeguarding all assertions. What does restricted access look like in practice?
It means role-based access controls. A sales clerk should only be able to view customer master data. They should not be able to change pricing or credit limits or the accounts receivable ledger.
And the control requires regular reviews of those user access lists.
Quarterly or even monthly, to ensure employees who change roles or leave the company immediately lose their access. A failure here creates the opportunity for fraud across every single cycle.
And the second critical control. Approved changes to data files, like withholding tables or loan master files, are recorded accurately and in a timely manner. Standing data must be complete and accurate.
This is maybe the most dangerous single point of failure in a modern financial system. Just imagine a single unauthorized change to the interest rate in the loan master file, or a change to the sales tax rate for an entire region.
That one error propagates instantly.
Instantly, it compromises the valuation and completeness of thousands of subsequent transactions across all business cycles. The control requires a robust change management system, which we'll detail more in Section 3, to ensure changes are tested, approved by both IT and business owners, and logged before they're ever moved into the production system.
That makes the shift to governance incredibly logical. We've seen how these specific controls work, but now we have to understand the structure that ensures people follow the rules and that the systems themselves remain protected.
We now move from the transactional what to the governance how and why. This is Appendix 5B, connecting the 17 principles of COSO to the policies that create the ethical and organizational context necessary for those transactional controls to even survive.
Because if the governance fails, then the strongest control structure in the world is just going to be ignored.
Exactly. Starting with Principle 1, commitment to integrity and ethical values. This is the bedrock.
So what are the controls that demonstrate this commitment beyond just, a plaque on the wall?
It requires comprehensive codes of conduct. These have to be actively developed, maintained, and periodically acknowledged and signed by all employees from the CEO down. And the board of directors must demonstrably set the example, the tone at the top.
Because if the board violates expense policies, why should a junior accountant follow them?
They won't. Furthermore, the source mandates communicating ethical standards to outside parties like vendors and customers, and establishing formal mechanisms for management to respond to reported policy violations. Inaction on violations sends a much louder message than the written policy ever could.
Principle 2 covers exercise oversight responsibility, which is the role of the board and the audit committee.
This oversight requires governance to review management's processes for identifying fraud risks and the implementation of anti-fraud measures. They oversee the establishment of controls and monitoring activities. A key control here is the requirement for the board or a dedicated committee to review and approve significant accounting principles chosen by management.
So that provides an independent check on complex or aggressive accounting before it's implemented.
Yes, exactly.
Principle 3 focuses on establishing structure, authority, and responsibility. This is about aligning the org chart with control requirements.
The structure itself has to facilitate the necessary flow of information, making sure financial results are communicated upstream, operational issues downstream, and accounting issues horizontally across departments. Authority, responsibility, and accountability have to be delegated logically. And crucially, the policy has to explicitly ensure that in delegating authority, the boundaries reinforce that segregation of incompatible activities we talked about.
It makes the organizational structure an active control, not just a passive chart.
Precisely.
Principle 4 addresses commitment to competence. The control system is useless if the people running it aren't capable.
This requires robust recruiting and hiring policies designed to secure competent individuals for key control positions. Training needs must be evaluated and provided continuously to all personnel, including specialized training for the board and audit committee to stay current on financial reporting matters.
I've seen companies face major misstatements just because accounting wasn't consulted early when structuring some non-routine transaction.
It happens all the time. The control requires early involvement of qualified personnel on complex issues.
And Principle 5, establishing accountability. How do you measure and enforce these standards?
Policies must clearly communicate responsibilities and expectations and link them to performance evaluations and disciplinary actions. A critical policy control is ensuring incentives and target goals are congruent with performance objectives.
Because if compensation policies are overly aggressive and only reward short-term financial metrics,
They inadvertently incentivize unethical or reckless behavior to override controls. And finally, the disclosure committee, the audit committee, and the board must review all control issues and material weaknesses identified and be required to take appropriate documented action. That closes the accountability loop.
okay, moving to risk assessment. You have to know your enemy, the threats to your financial integrity, before you can design a defense. Principle 6, specify relevant objectives.
This is about defining what success looks like. Management has to verify and articulate its risk tolerance. The controls here involve documenting that the financial objectives align with GAAP and that they are consistent with operating objectives.
For example, if an operating objective is cut production cost by 20%, the financial objective has to ensure those cuts don't compromise inventory valuation.
Correct.
Principle 7 is where the strategic assessment happens. Identify and assess risk.
Risks have to be identified at a sufficiently high organizational level to capture their full implications. We need to look at risks arising from both external sources, like regulatory changes, technology, and internal sources, like personnel turnover or management override.
And this is where the source material introduces a highly sophisticated detail, the need to assess the timing of the risk.
This is a massive distinction, and it's often overlooked in basic risk modeling. We have to assess not just the likelihood and magnitude, but also the potential velocity, how quickly the risk materializes, and the persistence, meaning how long the impact lasts.
Can you give an example of that?
Sure, think of a sudden catastrophic system outage. That's high velocity, but it could be low persistence if your recovery is quick. Now compare that to a gradual, long-term erosion of a key market segment. That's a low velocity, but very high persistence.
And the control response for those two is completely different.
Completely. The response for a high-velocity risk has to be instantaneous, probably an automated preventative control. The response for a high-persistence risk needs strategic, long-term monitoring and adaptive planning.
That reframes the entire risk prioritization process. Principle 8 then focuses specifically on assessing fraud risk.
The control objective here is to manage the opportunity side of the fraud triangle. Policies must mandate implementing anti-fraud procedures. This includes formal, periodic brainstorming sessions among senior management, internal audit, and the audit committee to identify unique ways fraud could occur in this specific business.
So you're studying past fraud patterns in similar industries.
Yes, and you're identifying specific compensation policies or internal incentives that might motivate unethical behavior. And finally, there has to be a secure mechanism for employees to report concerns confidentially, and all alleged fraud incidents must be investigated appropriately.
Principle 9 is about identifying and assessing significant change, which is so often the precursor to control failure.
Every major shift introduces risk. A new accounting system, rapid expansion, a large acquisition, a change in GAAP interpretation. The control requires management to proactively review and adjust the entire internal control structure as a result of these shifts.
And the source material explicitly reminds public companies of their legal responsibility under Sarbanes-Oxley.
Right. Under Section 302, they have to review and disclose changes in internal control effectiveness on a quarterly basis. The control ensures change is managed, not just reacted to.
Okay, with the risk identified, we can now design the solution. Principle 10, select and develop control activities.
The controls must be designed explicitly to address those financial reporting and fraud risks we identified in Principles 7 and 8. Special attention has to be paid to the difficult accounting areas: fair values, complex transactions, estimates, revenue recognition, contingencies.
Because these areas are subjective and require the highest level of detail in the control design.
That's right.
And the composition of the controls matters too,
Right.
right? You need a mix of preventative and detective controls.
Absolutely. Preventive controls are generally more efficient. They stop the error before it enters the system, like that automated three-way match. Detective controls, like bank reconciliations, find the error after the fact, allowing for remediation.
And the source provides a crucial technology linkage here.
It does. It says automated controls should be implemented when practical, but only when the general controls over technology are assessed as effective.
That leads directly to Principle 11. Select and develop general controls over technology, or ITGCs. If the system itself is unreliable, the automated control is unreliable.
This requires executive commitment and adequate funding for the IT infrastructure. ITGCs cover four main areas: the organization of IT, logical access and security, system change controls, and operations recovery, like backups and disaster planning.
Let's elaborate on system change controls, because this connects directly to the risk we discussed with the data files.
Change management is the absolute backbone of ITGCs. Controls must operate over every modification changes to applications like the payroll system, database schemas, and operating system updates and patches. A robust control requires that all changes follow the system development lifecycle.
Meaning they're requested, reviewed, developed, and tested in a separate environment.
Formally approved and then moved into the live production environment. If changes skip the testing environment, a bug could instantly compromise the integrity of the data files, which brings us right back to that high-velocity failure scenario we discussed. The SOAR also calls for periodic network penetration tests to assess and mitigate external threats.
And finally, Principle 12. Deploys through policies and procedures.
This is about codification. The risk assessment and control design have to be formalized in a policy and procedures manual that is maintained and kept current. And crucially, the control objective is that adherence to the manual must be part of the entity culture. A policy gathering dust in a folder does nothing.
The control requires regular sign-offs that employees have read and understood the relevant procedures.
Correct.
We built the system, now we need the feedback to know if it's actually working. Principle 13. Generate relevant information.
Management has to first determine the information needs of personnel, the board, and external stakeholders. The control requires that data integrity is maintained, meaning the information must be valid, accurate, secure, retained, sufficient, and timely. And the information gathering processes must be reviewed and updated continually.
Principle 14 deals with communicate internally.
The control mandates that information flows to the right people in sufficient detail and in a timely manner. This includes accounting policy changes and unusual transaction reports. And again, the confidential reporting mechanisms are reinforced here. The ability to report fraud or policy violations without fear of retribution is a critical communication control.
And Principle 15. Communicate externally, which focuses on transparency.
Here, management has to assess the clarity and transparency of the financial statements and disclosures. The control requires that non-financial communications like earnings press releases or investor presentations are previewed and approved to ensure they're consistent with entity values and the financial disclosures.
So this prevents management from making misleading non-GAAP statements that conflict with the formal filings.
Exactly. And required public disclosures, like an 8K, must be timely and reviewed for accuracy by the Disclosure Committee.
Principle 16 covers monitoring. Conduct ongoing and separate evaluations. How do we ensure the controls don't just atrophy over time?
Monitoring involves management's ongoing review of key business metrics for anomalies, unexpected spikes in expenses, sudden drops in gross margin, and formal evaluations by internal audit. The critical control detail here is the requirement to introduce elements of unpredictability into the monitoring program.
You mean in the scope, frequency, and extent of the testing?
Yes. If internal audit always checks inventory in the same warehouse during the third week of October, that control can be easily bypassed temporarily. Unpredictability ensures that controls operate continuously, not just when you know someone is looking.
And the monitoring has to be adaptive.
It has to be. If a monitoring control detects a high number of duplicate payments one month, the scope of monitoring must immediately adapt to focus on that specific risk area. That links right back to Principle 9, significant change.
And finally, Principle 17, evaluate and communicate deficiencies. This is closing the loop with action.
Management must establish clear policies for the timely communication of non-trivial control deficiencies and material weaknesses to all the relevant parties: the Audit Committee, CEO, CFO, and the independent auditors.
And controls have to exist over the assessment of the severity of those deficiencies.
Yes. Determining if a control failure is a simple deficiency, a significant deficiency, or a material weakness. But most importantly, Policies must mandate the monitoring and documentation of the remediation of those deficiencies. It ensures corrective action is taken, tested, and verified as effective. A failure to remediate a known weakness is often considered a failure of the entire control environment itself.
What an extensive tour through that control framework. We successfully navigated the entire organizational map, starting at the high-level governance policies set by the COSO principles,
Right.
connecting them all the way down to the minute, specific daily control activities in the business cycles, and then verifying their effectiveness against the PCAOB financial assertions.
The takeaway for you is clear. Effective internal control is not a compliance check. It is an integrated system where the ethical integrity of the board principle 1 defines the reliability of the accounting data files, which in turn determines the accuracy of inventory valuation and the timing of cash payments.
Break one link, especially the foundational ones, and the entire chain of financial assurance just snaps.
It does.
We've seen that the strength of the system relies on segregation of duties, consistent policy adherence, and critically robust IT general controls that protect the integrity of the underlying data.
Absolutely. The system is only as strong as the processes governing its maintenance.
Which brings us back to our conversation on risk timing. We discussed Principle 7, which requires assessing both the velocity, the speed of occurrence, and the persistence or duration of risks. We then spent considerable time detailing the universal risk posed by the data files, which impact all 7 assertions simultaneously.
And we noted that Principle 11 mandates rigorous IT general, controls ITGCs over system changes, applications, and operating system patches, all to ensure the system environment is stable.
So think about this. Given that modern high-volume transactions, like electronic funds transfers, have near zero latency, how quickly could a high-velocity, unauthorized change to a universal control like the data files say, an incorrect interest formula, or a malicious change to a vendor's bank account number compromise the entire financial system?
In seconds.
And what does that imply about the necessary speed and rigor of IT change management controls from Principle 11? If the risk materializes in seconds, the preventive control must operate with near-zero tolerance for error or delay. The integrity of that change control process is truly the ultimate firewall against catastrophic financial collapse. Chew on that the next time you hear about system maintenance. Welcome back to the Deep Dive. Today we're digging into the COSO Internal Control framework, but we're kind of leaving the basic financial rules behind for a moment.
We are.
Our mission today is to really understand the architecture that, guarantees a business is running on truth. Not just the inputs and outputs on a balance sheet, but the active nervous system of the organization, how information moves, how it's filtered, and ultimately how it's monitored.
That's absolutely right. And if you think of internal controls as, let's say, a complex building, we've already talked about the foundation, the control environment, and maybe the blueprint, which is risk assessment.
Right.
Our focus today is on these two interconnected pillars that provide all the movement, the communication, and the constant maintenance for that whole structure.
And those are information and communication and monitoring.
Exactly. These components are really the difference between a business that just, performs transactions and one that truly understands what it's doing and, more importantly, why.
And our goal for you, the listener, is to move beyond the textbook definitions here. We want to unpack what genuinely defines useful information.
The stuff that helps you make decisions.
Yes, the data that actually enables smart decisions. And also how an organization has to use continuous, and I think this is crucial, unpredictable vigilance to prevent some of these systemic catastrophic failures.
And we can jump right into probably the biggest paradox of modern control systems, especially when it comes to information.
Which is?
Mass communication and capturing data are incredibly cheap now. I mean, servers are inexpensive, bandwidth is almost limitless.
But human attention isn't.
Human processing capacity, that is finite, and it is very, very expensive.
That distinction, cheap data versus expensive attention, that leads us right to the problem of information overload, doesn't it?
It does. Data can be used to enlighten, of course, but it can just as easily be, weaponized to obscure.
Right.
We call this the needle in the haystack strategy. If you're trying to hide something, you don't necessarily delete the bad data.
No, you just create a bigger haystack.
You generate 1,000 times more useless data all around it. The sheer volume itself becomes a profound distraction.
And the most infamous example of this weaponization of data volume has to be the collapse of Enron.
Oh, absolutely.
During the investigations of that fraud, reports indicated that auditors were flooded with, and this is not an exaggeration, literal rooms full of data during their inquiry.
And the chilling part of that whole story is that much of that information, regardless of whether it contained actual clues to the fraud, it just went unreviewed.
It was just too much.
It was too much for any human to process in time. The fraud wasn't just hidden, it was buried under the weight of so-called compliance. The company satisfied the legal requirement to produce evidence, but that act of production actively defeated any human capacity for review.
So the key takeaway here, before we even get into the principles, is that for a control system to work, it's not just about capturing data. It's about designing a system to strictly filter, to synthesize, and to deliver only useful, reliable knowledge to the people who need to act on it.
Right. Otherwise, the noise itself becomes the control failure.
Okay, let's unpack this first crucial pillar then. Information and communication. We have to assume that employees, stakeholders, they're busy. They're not forensic accountants.
Not at all.
They need information that serves a clear, actionable purpose. So according to the framework, what are the sort of 3 non-negotiable requirements for good communication in a control system?
Well, the system has to meet 3 really vital criteria to be effective. First, the communication has to serve the specific purpose of the recipient.
So no one-size-fits-all reports.
Exactly. A sales manager needs completely different data than, say, the head of treasury. If they get the wrong info, they can't do their job. Second, the system has to actively avoid flooding the lines with data that just, numbs the senses.
The Enron lesson.
That's the Enron lesson applied practically. Data overload obscures, it doesn't reveal. And third, the information has to be reliable and timely so people can actually make decisions with it.
Because if the data is 2 days late, the decision window might have closed.
It's useless at that point. If you fail any of those 3, the entire control objective is compromised.
And that reliance on timely, reliable information, that brings us right to the foundational requirements for financial integrity. The auditing literature, especially what's consistent with SEC mandates, it's extremely strict about this.
It is. It's not just about debits and credits. It's about having the right mechanisms in the first place.
So what are those 5 mandated elements that a system absolutely must have?
Okay, so these 5 elements, they really establish the absolute baseline for all financial reporting. We can kind of group them thematically because they govern different stages of a transaction.
Okay, so let's start with the first 2. This is about capturing the activity and describing it, right?
Exactly. The system must have the methods and the records it needs to, first, identify and record all valid transactions. You just can't miss anything that's real.
And second?
And second, it has to describe the transactions in a timely way and in sufficient detail to permit proper classification.
So this is like the quality control on the raw data.
Precisely, making sure it's all there and it's categorized correctly from the very beginning.
And if those first 2 fail, if a major contract is just missed, or a huge transaction gets miscategorized, the rest of the process is basically meaningless.
Completely. So then the next 3 govern converting that data into monetary value and then presenting it.
Okay.
So third, the system must measure the value of transactions in a way that lets you record their proper monetary value. Fourth, it has to determine the time period in which the transaction happened. This is critical for, month-end or year-end cutoffs.
And the 5th and final one.
It must present properly the transactions and all the related disclosures in the financial statements. This is about complying with GAAP or IFRS, all the notes, all the context.
It sounds incredibly comprehensive, but here's where it gets really complicated, I think. The interconnected nature of these problems. The revised COSO framework puts a huge emphasis on the fact that when you find one problem, it almost never lives in isolation.
That is the core insight of the revised framework. We shouldn't just be symptom chasers. So if we find, say, inaccurate sales data, our first instinct might be to just fix the data entry control.
A single control activity.
Right. But the framework pushes us to realize that this single symptom, it likely compromises multiple principles at once.
So walk me through that. How does one instance of bad sales data suggest a much bigger, more systemic failure?
Well, because if the sales data is wrong, it suggests a bunch of failures. Yes, there's a deficiency in gathering the information. That's principle 13.
Right.
But think about the downstream effect. That inaccurate data fundamentally weakens management's ability to, manage the sales team or adjust inventory or even just monitor performance against a budget. That's a monitoring failure.
Principle 16.
Right. And furthermore, the inaccuracy might point to bigger weaknesses in the IT infrastructure itself. Maybe weak system security, poor access controls, or maybe a total lack of testing when a new sales software was installed.
So a single error is like a thread you pull, and it starts unraveling the whole tapestry. The danger isn't the one mistake.
No, the danger is failing to aggregate all those little failings into a cohesive picture of decay.
I see.
If management only focuses on fixing that one bad sales number, they might call that a minor deficiency. But if they connect the dots, bad data plus weak security plus untested software, they have to recognize a more severe systemic problem.
And that compels them to act on the root cause, not just the symptom.
Exactly. The framework forces you to connect those linkages so minor faults don't get ignored until they become a full-blown crisis.
Okay, let's move to the engine room of this section. Principle 13, generating relevant information. This is where the organization actively designs controls over the processes that guarantee all that good stuff. Completeness, accuracy, timeliness, and cost-effectiveness.
This principle really demands a systematic approach. If an entity has set up clear controls, the information you need to service those controls should just, flow naturally.
So what are the critical steps or points of focus that management needs to establish for this to work?
There are 5. First, they have to clearly identify information requirements. They need to document what management actually says it needs to do its job. Second, they have to capture internal and external data.
Then what?
Third, they process relevant data into information. That's the transformation stage, turning raw numbers into reports. Fourth, they have to maintain quality throughout that whole process. And then finally, fifth, they must consider costs and benefits.
Okay, that last point, costs and benefits, that feels like the perennial compromise, doesn't it? I have to be a little skeptical here. How can a company prioritize cost over absolute accuracy without just compromising integrity?
It's a necessary trade-off, but it requires really careful prioritization and an acceptance of risk. For instance, achieving absolute perfect accuracy in your inventory costing might require every employee to spend hours manually verifying raw material prices every week.
Which would be prohibitively expensive.
And probably too slow to be useful for daily decisions. So management has to define the acceptable level of risk. They have to ask, is speed more important than the last decimal point of accuracy? That priority determines the risk they'll accept, and that trade-off has to be transparently accepted by management and governance.
So how do we know if this system is adequate? I can look at a flowchart and see that reports exist, but how do I know management is getting the right information?
You can't just rely on the flowchart. Assessing sufficiency means you have to get out of the accounting office.
Talk to people.
You have to talk to people. Management, governance, employees, they all have to provide feedback. This means doing interviews, surveys, and critically observing the actual internal process for requesting reports.
Is the request actually fulfilled efficiently?
Right. Does the person who gets the report actually use it, or do they just file it away because it's irrelevant or too dense? It's about observing the effectiveness of the whole request and response process, not just ticking a box that a report exists.
Let's ground this in that retail example you mentioned. A large retailer with lots of stores. How does this continuous loop of gathering, processing, and checking information work in a fast-moving business like that?
A large retailer is a perfect illustration. To manage risk and shift strategies, management needs to closely monitor activity by location and product line, and not just annually, but daily or weekly.
So this would be like those rigorous weekly performance meetings we hear about.
Exactly. A weekly meeting with middle and top management, and they're monitoring all the operational stats: sales, inventory turnover, shrinkage, marketing performance. The controls here demand that any anomalies they find in that meeting,
Like a store suddenly losing all its margin.
or a product line with a ton of returns, that has to be followed up on immediately by internal audit or regional management.
And what happens when the system itself glitches? Say, a report on Monday has errors that are only found on Tuesday after the executive meeting has already acted on the bad data.
Those glitches are treated as major control breakdowns. They get investigated thoroughly, and they trigger a process of continuous improvement.
What would that look like?
Well, the fix might be installing automated edit checks for reasonableness before data is even accepted into the system, Or it could lead to requiring direct downloads into the reporting tool to eliminate manual input errors.
And then that report gets more scrutiny going forward.
Absolutely. Because those reports are now deemed essential for decisions, internal audit will mandate regular, independent testing of the reports and the underlying data to verify their integrity. The initial glitch actually elevates the whole process to a higher level of control.
Let's talk about the role of non-financial information. We're discussing financial reporting, but you're arguing that reliable statements need way more than just financial figures.
They absolutely do. Modern accounting relies so heavily on estimates and fair valuations, and these often hinge on non-financial metrics.
Like what?
Take inventory obsolescence. Setting the right allowance for that requires financial data, sure, historical sales, cost basis. But the real judgment call relies on non-financial data points.
Such as?
An assessment of current and future market conditions, any anticipated technology shifts, even consumer trends.
So if a company is making smartphones and a competitor suddenly announces some huge technological leap, that non-financial news immediately impacts the financial estimate for the current inventory allowance.
Precisely. The process for making these estimates has to demonstrate that management went out and considered various reliable sources of non-financial information. If management bases a huge valuation on some projected growth rate, they have to show they looked at external economic forecasts, regional data, and analyst reports to justify it.
So the control is on the process of gathering that context, not just the final calculation.
That's it.
And you mentioned that external sources can act as control indicators themselves. They're like a feedback loop from the outside world.
A vital feedback loop. There are 4 major sources that act as these flags. First, your external auditors. Their formal reporting of significant deficiencies and material weaknesses directly to governance is a non-negotiable feedback loop.
Okay, but second.
Second is regulators, the SEC, banking authorities, insurance regulators. They often do examinations that highlight control weaknesses, and auditors are specifically required to ask about those comments to make sure the board knows.
Now, the third loop is more on the operational side of the business.
Right. That's direct third-party feedback. Customers, vendors, and competitors. A flood of customer complaints about billing or frequent vendor calls about late payments, those point directly to system deficiencies. The volume of complaints is itself a non-financial control metric.
And finally, the modern challenge, social media and analysts.
The fourth source is social media and analysts. Information from blogs, analyst reports, trade publications, even shareholder groups. It all provides context on industry risks and shapes public perception. A responsible company has to monitor these sources to detect early warnings.
Before we wrap Principle 13, we have to talk about non-routine events. The system isn't just for recurring sales. What happens when something unique and complex occurs?
The information system needs a mechanism for that, for identifying, capturing, and communicating non-routine information. The classic complex example here is the formation of a variable interest entity, or a VIE.
Which used to be called a special purpose entity. For listeners who aren't CPAs, can you just briefly explain why a VIE is such an accounting headache?
Well, VIEs are complex because they're often created off balance sheet, but because of their structure and the risks involved, they might need to be consolidated back onto the main company's financial statements.
And you don't create them every day?
No, they're non-routine, but the accounting ramifications are huge, requiring really complex GAAP presentation and disclosure. The entity needs a specific, probably manual mechanism to ensure all the formation documents, legal obligations, and all the subsequent transactions related to that VIE get funneled immediately to the right financial reporting team.
And if that mechanism is missing, the VIE is basically invisible to the control system until it's way too late.
And that's a disaster waiting to happen. The information architecture has to support future compliance, not just what's required today. The design of how you capture data is really the ultimate control.
So we've established the need to generate relevant information. Now we pivot to the delivery system communication, starting with Principle 14, communicating internally. We tend to focus on the formal channels, but COSO sees it as much broader.
Yeah, it's vital to recognize that communication is continuous. It includes all the informal interactions, conversations with colleagues, quick calls to a customer, as well as the formal vehicles like email, policy manuals, group meetings.
It's a really complicated mix of things to try and control.
It is. And the method of communication has to match the message. We had a pretty stark reminder of that in the source material.
Yes, the Malaysian airline tragedy.
A grim reminder, yes. A text message was used to communicate the definitive fate of Flight 370 to the families. Now, A tech that's fast, it's a common vehicle, but it was just profoundly inappropriate for a message with that kind of sensitivity and finality.
So choosing the relevant method of communication is a key part of Principle 14. It requires judgment, not just speed.
Exactly. And once that important information is communicated, it has to be documented because memories fade, especially when problems come up later.
Documentation is the backbone of accountability.
It really is. Important issues, policies, changes in control activities, ethical findings, they have to be documented to ensure there's a shared understanding and to establish clear follow-up responsibility.
So besides documentation and choosing the right method, what are the other key focus areas for internal communication?
There are three others. You have to communicate internal control information clearly and often. You need to communicate with governance, making sure the board or audit committee gets the vital, non-routine information. And you have to provide separate communication lines.
Which are essential for ethical reporting.
Absolutely.
Let's link this back to control activities. You mentioned that ineffective communication can let issues fester or even be actively concealed.
Yeah, effective internal communication has to be tightly integrated with control activities. For example, people who are performing control functions, they need clear communication on their specific duties, how their monitoring roles are defined, and crucially, how their activity relates to the work of others.
Why is that last point, the relationship to others, so critical? Isn't it enough to just know your own job?
Because that awareness helps employees recognize a potential problem that's outside their immediate silo.
Ah, I see.
If the sales clerk knows what data the shipping department relies on, they're more motivated to investigate a discrepancy rather than just shrugging it off. It turns passive activity into proactive problem recognition.
And management has to keep communicating that when something unexpected happens, you look for the cause, not just the event itself.
Yes, that requires consistent, clear communication of that policy.
And since businesses are always changing new products, new regions, new software, the system has to be adaptable.
Absolutely. It can't be static. As the business evolves, management has to identify any information gaps that might open up. Did the new software integration completely change the data flow? Does the control system still capture everything it needs to?
So they have to constantly assess whether the system is keeping up with the changes.
Right, because today's efficiency gap is tomorrow's control weakness.
We mentioned the separate communication line, which usually means the anonymous hotline. How does management check if that's actually effective?
Well, just having a hotline is only half the battle. Management has to assess its effectiveness, especially if it's outsourced.
So they're looking at what? Response rates?
Response rates, the types of issues being reported, whether those issues are being addressed properly. But most importantly, they have to gauge employee trust. Do people feel comfortable using the line, or do they think management will just dismiss their report?
Employee trust is the ultimate control over that channel.
It is.
And finally, on this, cross-functional alignment. It's not enough for accounting to just talk to finance. They have to talk to the warehouse manager.
This is exactly why fraud standards require auditors to inquire outside of just the accounting and finance departments. We have to make sure the views of production, sales, admin, and IT are all aligned. Auditors need to confirm that people in these non-financial roles are getting the information they need, ensuring that data from monitoring is available to the right people at the right time.
Let's pivot now to Principle 15, communicating externally. This covers a huge range of interactions, from customers to regulators.
The scope is massive. Formal financial reporting, disclosures, but also informal mechanisms with customers, vendors, shareholders, the general public.
And while public companies have huge regulatory burdens like Sarbanes-Oxley, non-public companies have external reporting requirements too.
Oh yeah, defined by loan covenants or private equity agreements.
What are the key focus areas for external communication here?
They kind of mirror the internal focus, just pointed outward. So you have communicate with external parties, enable inbound communications, which is a crucial and often overlooked piece, communicate with governance, provide separate communication lines, and again, select relevant methods of communication.
Let's dive deeper on enabling inbound information. How do traditional complaint records act as a control mechanism?
Well, billing complaints, shipment errors, warranty claims, these are significant real-time external sources of information about internal problems.
So a high volume of billing complaints means the system is flawed.
Exactly. And a process must exist to assess and decide which of these inbound issues need to be communicated up the chain to management and governance. Management has to show that these issues are being addressed effectively and in a timely way so they don't keep happening.
And this brings us to that critical overlap between regulatory reports and the governance group. Auditors are often the gatekeepers.
They have to be. Regulatory agency reports say, from a bank regulator criticizing lending controls, they can't be allowed to just die on some executive's desk.
There has to be a formal process.
A formal, mandated process has to be in place for getting this information to governance, usually the board and the audit committee. And independent auditors are expected to ask about these reports and make sure governance is aware of what's in them.
And there's a huge legal danger if auditors fail to make sure the board is informed.
Massive liability. There are documented cases of governance failure where top executive management deliberately blocked a scathing regulatory report from ever reaching the board.
And that was part of a bigger fraud.
It was part of a multidimensional fraud. And if the independent auditor fails to ensure governance is informed of known, serious control weaknesses, especially ones compromised by fraud, the governance group may have a clear legal claim against that auditor for failure of duty.
That is a stark illustration of why communication is a control, not just a function. Now let's tackle the modern nightmare, the peril of social media.
This is a massive risk area, and the SEC is highly aggressive here. Public companies can face prosecution for revealing non-public material information on social media, even if it's inadvertent.
The line between personal and business communication is basically gone.
It's completely erased, and that blending creates immense risk. You hear these stories of seemingly innocent comments causing huge market swings.
Like what kind of thing?
Well, take the example of an employee or a manager posting a note on a neighborhood blog about, looking for new housing in a distant city to staff a position for an unannounced business combination.
Oh, wow.
That is non-public material information. And that accidental disclosure can set off a market firestorm and lead to a regulatory investigation.
So many companies adopt the Wall Street Journal test.
They do.
Right.
And the test is simple.
Which is?
Employees shouldn't write anything in any medium that they wouldn't want printed verbatim on the front page of the Wall Street Journal. It sounds severe, but in a world where every written word is discoverable, the only viable control is restraint. External communication, in this context, is often what the organization actively works to prevent.
That sets the stage perfectly for our second major component, monitoring. This is the continuous, active process of assessing and ensuring the quality and ongoing performance of internal controls over time.
And monitoring is a continuous internal process. It is an entity responsibility, and this is a crucial distinction. That role cannot be assumed by the independent auditor.
So even if the auditor tests controls?
Even then, the responsibility for continuous monitoring and for taking corrective action remains squarely with management.
And monitoring has to be timely and periodic. This is where we get to that fundamental principle of predictability.
Indeed. We have to apply a basic principle of effective auditing here. A highly predictable process will not yield reliable results over time.
Because people will game it.
They will. If employees know exactly when, where, and how a control is being monitored, they can, and the evidence suggests they often will, find a way to circumvent the system when no one is looking. Monitoring has to be a clever mix of predictable routines and essential unpredictability.
I recall the source material mentioning the historical context here, specifically the 2009 COSO guidance. It addressed this issue of relying too heavily on high-level, infrequent reviews.
That was a key philosophical struggle after the framework was first implemented. Many companies and auditors argued over whether these infrequent, high-level management reviews of aggregate data,
like looking at quarterly ratio.
Right. Whether that could adequately compensate for weak transaction-level controls. Sometimes these powerful detection capabilities were ascribed to these reviews without any real proof of their precision or effectiveness.
So the guidance needed to be more rigorous about how you assess that precision.
It did. The 2009 guidance focused specifically on how to design and assess the effectiveness of monitoring. It gave concrete guidance on how the precision of a monitoring process, like a specific trend analysis, should be assessed, and how that really relates to the effectiveness of individual transaction controls. It added the practical depth needed to make monitoring an active process, not a passive one.
Let's dive into Principle 16 then. Selecting, developing, and performing ongoing and/or separate evaluations. What are the key operational checkpoints here?
Management has to systematically address 6 areas. They need to consider a mix of ongoing and separate evaluations. They have to consider the rate of change in the business, establish a reliable baseline understanding of the data, use knowledgeable personnel, ensure evaluations integrate with business processes, and finally, they have to adjust scope and frequency to stay objective and prevent that predictability.
Let's start with the ongoing monitoring activities.
Right.
What are the common examples management uses every day, and how do they need to be documented to count as a control?
The most common are the regular management and supervisory activities, reviewing exception reports, sign-offs, approvals. But to function as a control, management needs to have an inventory of these activities and, critically, have evidence of performance.
You have to prove it happened.
Was the review actually done? Was the exception cleared? Without evidence, it's just a theoretical control that will fail an audit.
Then we have those external feedback loops again, telling us how the system is performing in the real world.
Exactly. Communications from external parties are vital. When customers pay their invoices, they're implicitly corroborating the billing data.
And when they complain,
When there's a spike in complaints about invoice amounts, that immediately signals a system deficiency. Management needs a formal process to assess that feedback.
and what about the feedback loop from the auditors themselves?
External auditor recommendations, particularly the management letter comments and communications about significant deficiencies, are immediate indicators that you need corrective action. Monitoring ensures management has fully addressed these communications, not just filed them away.
That covers the routine, ongoing stuff. But we said predictability is the enemy. This is where separate evaluations come in.
Separate evaluations are that necessary element of surprise. They're initiated to focus on known weaknesses, potential problems, or new risks. They can include the random selection of a specific process, a location, or a product line for a really intensive, deep review.
And this random check provides the deterrent.
It provides the essential deterrent factor.
As you said, every time you build a better mousetrap, the mice get smarter. You have to keep changing the trap.
That's absolutely it. Varying the mix and adding unpredictability prevents people from gaming the system. Internal auditors often do this, scheduling unscheduled visits to remote cash-intensive locations precisely to verify the baseline data that their centralized monitoring relies on.
They verify the physical assets to make sure the digital reports are true.
Exactly.
And that analytical monitoring using trends, ratios, dashboards, it requires a reliable baseline for comparison. This seems like a massive risk area for fraud.
It's the Achilles heel of centralized monitoring. If you use analytics to assess the performance of a remote facility, you are assuming that the base data, the benchmark, is reliable. But what if the data being sent from that location is intentionally misstated to look normal?
It would just fly under the radar.
Completely. And you shared a fascinating anecdote about a fraud that succeeded entirely because the baseline was unreliable from the very beginning.
Yes, this was a deeply deceptive situation at a remote operation. It was discovered that the local manager was consistently reporting only a part of the location's operations to headquarters.
And the other part?
The other unreported segment of the business, which was profitable, was generating direct, unreported income for the local managers who were using the company's software, brand name, and assets to run this shadow operation.
So they weren't stealing from the reported profits, they were just hiding profits altogether.
Correct. And because this fraud started almost from day one, the historical baseline for any analytical comparison was unreliable from the start. Any dashboard comparing current to historical performance would just show normal activity, even though a huge part of the business was completely invisible.
And that fraud was only discovered by chance.
Only through a random, unscheduled visit by internal auditors was it uncovered. This is a profound warning. Analytical procedures are essential, but they are subject to catastrophic risk if the underlying baseline data is never verified periodically and unpredictably. So those beautiful, efficient dashboards, the graphs, the metrics, they're only as powerful as their foundation.
They're critical tools for directing management's attention. But if the metrics being monitored are static, if they're not continuously reassessed and updated to meet changing business structures, a dashboard can provide a false sense of security.
Finally, let's address monitoring outsourced services. This is a huge issue now with cloud computing and SOX compliance.
Yeah, outsourcing requires rigorous monitoring. Entities rely on Service Organization Controls reports or Associate reports. They move from a Type 1 report, which just assesses the design of controls, to a much more rigorous Type 2 report, which assesses the operating effectiveness of those controls over time.
And for cloud computing, you need a SOC too.
Often a SOC Note 2 report for data centers and cloud services, focusing on things like security, availability, and processing integrity.
What's the specific monitoring challenge for management with these reports?
Timeliness and completeness. A SOC Type 2 report might cover a calendar year, but if your company's fiscal year ends on September 30th, that report doesn't cover the last 3 critical months.
So you have a gap.
You have a gap. Management has to do additional steps, called gap procedures, to extend those results to their year end. Oversight is needed to make sure the inventory of these reports is complete, that they're reviewed by knowledgeable people, and that any significant issues, especially around emerging risks like cloud security, are communicated immediately.
Okay, we've identified the information, we've established the monitoring, and now we have to deal with the problems. Principle 17, evaluating and communicating deficiencies. How does COSO define a deficiency, broadly speaking?
COSO uses the term deficiency for pretty much any condition in an internal control system that's worthy of management's attention. The more severe ones are called major deficiencies in COSO, which align directly with the SEC and auditing standards for significant deficiency, and the most severe level, a material weakness.
And the criteria for assessing that severity are notoriously difficult, often misunderstood. It's not about the dollar amount that already went wrong, is it?
That is the single greatest point of confusion. The classification is not based on the size of the misstatement that was generated, or even if a misstatement happened at all.
It's based on what could happen.
Severity is based on whether it was reasonably possible that a misstatement could occur and whether that potential misstatement would be material to the financial statements.
Can you give us a practical scenario to illustrate that difference between the actual loss and the potential risk?
Sure. Imagine a small accounting division uses a piece of software to calculate accrued liabilities. Due to a control flaw, the software consistently messes up the calculation for that one small division, resulting in only, say, a $5,000 misstatement in the current quarter.
Clearly immaterial.
On its face, yes. However, that control flaw resides in the core software code that is used globally across the entire organization.
So the actual loss is $5,000, but the potential risk is massive.
Exactly. The person assessing the severity has to look beyond the $5,000. Because the system flaw is pervasive and it's reasonably possible it could manifest across the whole global organization, the potential misstatement could be massive. This elevates the deficiency to a material weakness, regardless of the small current dollar amount.
That subjectivity creates a real gap, which is why we see that statistic that 70% of management's assessments of major deficiencies were overridden by auditors to a higher severity level. Why does management tend to undervalue the risk?
Well, management is closer to the daily operations, so they often suffer from a kind of operational bias. They focus on the results they did achieve, and they minimize the potential for failure because they're confident in their people.
But the auditor has to be skeptical.
The external auditor is mandated to adopt a much higher level of professional skepticism. They have to consider what could happen if the current staff left, or if an economic downturn pressured people to override controls. That difference in mindset accounts for the huge gap in assessments.
And even a simple, small problem needs a deep investigation into its cause. You can't just fix the symptom.
Never. Even a small, misdirected payment has to be investigated for the underlying cause. That seemingly innocent $100 error could be the tip of an iceberg of fraud if it turns out the system allowed a vendor's bank account number to be changed without proper authorization. Monitoring requires critical judgment, not just mechanical tasks you can push down to inexperienced staff.
The final step is the critical path of communication. Targeted reporting of these deficiencies.
Right. Findings have to be reported to the individuals who are in the best position to take action. This means reporting not only to the person directly responsible for the flawed activity, but also to at least one level of management above them.
And that ensures oversight and accountability.
And the necessary authority to mandate a corrective action.
And if the deficiency involves potential fraud, that requires a completely different communication protocol.
Oh, suspected fraud demands heightened attention and sensitivity. It cannot be treated as a routine error. Great care has to be taken about how and to whom it's reported, because if perpetrators are alerted too early, they might take drastic steps to hide what they did.
Like destroying evidence.
Destroying evidence, systems, data.
Which means internal resources aren't enough. You have to bring in lawyers.
You need legal counsel involved immediately. Management needs to have clear guidelines and awareness of regulatory and legal requirements for public disclosure, and often rules for reporting violations outside the organization. This is a complex situation that demands significant experience and sensitivity to navigate successfully.
So this deep dive has really shown us that the architecture of control is this fundamental duality. It requires two opposing continuous efforts. On one hand, Reliable information demands proactive generation, but also strict filtering.
Right. We have to avoid that Enron trap of information overload where data is weaponized to obscure the truth.
And on the other hand, true monitoring demands continuous adjustment, verification, and that essential unpredictability.
The control system has to be flexible enough to defeat the fraud mice who will game any predictable routine. Control effectiveness really relies on both the quality of the information going in and the absolute unrelenting vigilance of the system watching that information.
And the knowledge from today helps you, the listener, understand the full scope of internal control. It goes far beyond the accounting department. It touches market intelligence, customer feedback, IT security, and even the dangers of social media.
And this raises one final provocative question that builds on everything we've talked about today. We spent a lot of time detailing how crucial non-financial information market shifts, economic data, customer sentiment, how crucial that is to the accuracy of internal financial estimates.
Fair value calculations.
Exactly. So if an entity relies heavily on those non-financial metrics to set its allowances or estimate fair values, and external forces like a sudden social media trend or a new trade publication analysis begin to rapidly and credibly challenge those underlying assumptions, how quickly must governance respond to those outside signals before the financial reports based on those internal assumptions become materially misleading? The integrity of the financial statements may depend entirely on the speed and efficacy of that external communication monitoring system. It demonstrates that, ultimately, governance responsiveness is the ultimate control.
That is a deep dive for another day. Thank you for joining us.
Until next time.
Welcome back to the Deep Dive. Today, we are really moving beyond the headlines and plunging straight into what you could call the engine room of corporate accountability.
We're talking about financial internal controls.
Exactly. These are the guardrails, the checks and balances, all the things that are supposed to keep companies operating honestly and, keep their financial data accurate. It's about protecting investors at the end of the day.
And this is really where the high-level ideas of governance meet the really granular, nitty-gritty details. We're not going to spend a lot of time today talking about what a control is. I think our listeners get that.
No, we're focused on the proof. How do companies, and maybe more importantly, their external auditors, actually generate the evidence to prove that these control systems are working?
That's the billion-dollar question. It's not enough to say you have a control. You have to prove it functions effectively.
So our mission today is pretty ambitious. The source material is... well, it's dense. We're digging into key excerpts on evidence gathering, on testing methodologies, sampling techniques, the whole 9 yards. All the documentation that underpins these massive regulatory frameworks like COSO and SOX.
And the goal for you, our listener, is to walk away with some really concrete principles. Whether you're a manager designing these systems or an investor who's trying to evaluate corporate integrity or an internal auditor.
You need to understand the rigor.
You need to understand the rigor, or sometimes the lack of rigor, that goes into assessing whether the evidence is good enough. We're basically trying to turn this highly technical audit guidance into practical knowledge that helps you assess an organization's integrity right at its core.
Okay, so before we dive into the hard numbers and the statistics, let's set the stage a little. When we talk about these frameworks, COS, SOX, and you hear about the regulators, the PCAOB, the SEC, it sounds like there's a universe of really specific rules.
It does.
But you mentioned something interesting when we were prepping for this, that when it comes to the actual how-to of testing, the official guidance is surprisingly sparse.
That is the crucial context. It's what drives so much of the professional practice. The frameworks, like COSO, they establish what good control design looks like. And the regulators, the PCAOB overseeing public company auditors, the SEC, they lay out the what and the why.
They mandate that controls must be effective.
Right, they mandate it. But they offer surprisingly little concrete instruction on the specifics. The nature, the timing, and the extent of the testing you have to do, the how.
So if the big regulators aren't giving you the exact playbook, where does it come from? That seems like a pretty major gap.
It is, and it creates this deep reliance on professional practice guides that have evolved over decades. For auditors, for internal control specialists, the AICPA's Audit Sampling Guide, we call it the AGS, is really the de facto standard.
Even for public companies under the PCAOB.
Well, it's not strictly mandatory for them, but it was absolutely crafted with SOX and public company practices in mind. It provides statistically supported guidance on sample sizes, on methodology. And look, the very scarcity of these prescriptive rules from the PCAOB is precisely why your documentation becomes so vital.
Because you have nothing else to fall back on.
Exactly. If an inspector comes in and challenges your sample size of, say, 25 items, you can't point to some SEC rule that says 25 is the magic number.
Yeah.
It doesn't exist. You have to be able to point to your own statistically sound internal justification that aligns with accepted professional standards, like the ones in AGS. That's your defense.
Okay, so with that stage set, let's get into it. Let's start with what you call the Achilles heel of the audit profession. When auditors get inspected, what's the number one thing they get called out for?
It's always the same thing, year after year. It's the failure to satisfy that foundational requirement of all auditing, obtaining sufficient, appropriate evidence.
What does it actually mean? Is it that they didn't get enough paperwork?
It can be. It means they either didn't get enough evidence, so it wasn't sufficient, or the evidence they got wasn't relevant or reliable enough, so it wasn't appropriate. Either way, they couldn't support their conclusion, they couldn't prove they could rely on a control, or they couldn't prove that an account balance was fairly stated.
And this isn't just a problem for the big multinational public audits.
Not at all. It applies right across the board. Public, private, government. It's the fundamental building block of an audit.
And often, this problem, this insufficiency, it starts inside the company, doesn't it? Before the external auditors even arrive.
Absolutely. The internal documentation gap can be massive. Companies, they're under pressure, they're trying to be efficient, and they often cut corners on their own internal controls testing. That testing is essential for management's own public assertion of effectiveness.
So they don't document the basis for their tests, or they don't test everything they should have.
Yeah, exactly. Or they do the test, but the documentation is so poor it's useless. And this immediately handicaps the external auditor. It just severely limits their ability to leverage or rely on any of that internal work.
So if the company's work isn't rigorous enough, the external auditor just has to start from scratch.
They have to step in and do it themselves, and that's where you see these huge cost overruns and, frankly, a lot of friction between the company and the audit firm.
This brings us to a really fundamental fork in the road, audit strategy-wise. We need to clearly distinguish between private companies, which are under AICPA standards, and the big public companies, the accelerated filers, under the PCAOB.
Yes, this is a critical distinction. For non-public companies, the auditor gets to operate on what we call a continuum of reliance.
The continuum.
They can choose to place no reliance on controls, some reliance, or high reliance. It all depends on what's most efficient for them to achieve a low risk of material misstatement. And here's the key part. For these private entities, testing controls beyond just, looking at their design and making sure they exist, it's entirely optional.
It's optional, so it's just a strategic choice for them.
It's a cost-benefit analysis. If direct substantive testing, just going in and reviewing a ton of transactions, is cheaper and faster than going through the whole process of testing the controls, they'll just do substantive testing.
But the moment your company gets big enough to be a public accelerated filer, that option just vanishes.
It completely evaporates. The mandate for accelerated filers is that the external auditor has to provide an independent attestation on the effectiveness of internal controls. That's SOX 404B.
And that changes everything.
It changes everything. That mandatory attestation immediately dictates that a high level of evidence must be gathered to support that conclusion. You are, by definition, forced onto the path of high reliance testing, no matter what the relative cost is. The choice is gone.
Okay, so that high reliance path demands rigor, which means we have to talk about sampling. And you mentioned this earlier, this historical myth that sample size was just a matter of audit judgment.
Yes, that was the old school position, that your sample size was purely a matter of your professional judgment, your experience, and therefore it was untouchable. An inspector couldn't really question it.
So you could literally just say, my gut tells me it's 60 items, and that was the end of the discussion.
That's a bit of an exaggeration, but yes, that was the spirit of it. And I have to stress this. That is definitively not true today. This is the era of statistical justification.
So audit judgment is no longer a sufficient answer if a client or a regulator asks why you picked 40 items instead of 80.
It is not a sufficient answer, not on its own. Today, your sample sizes have to be quantitatively comparable to what a statistical sample size would be based on certain standard agreed-upon parameters.
You have to show your work.
You have to show your work. Using tables, charts, or formulas is absolutely crucial, not just for your own documentation, but for facilitating that third-party review. The moment you use a standard, documented statistical approach, you immediately lower your risk of being challenged. An inspector can pull out their own standard chart, look at your confidence level, and see if your number makes sense. It creates an auditable trail for the judgment.
Okay, let's unpack the science behind this then. We're talking about attribute sampling for controls testing, basically. Is the control attribute present or not, yes or no? What are the 4 essential parameters that drive how big that sample size needs to be?
Great. So we're using statistics to figure out the maximum rate of control failure we can live with or tolerate and still be comfortable relying on that control. So number 1 is risk, or its flip side, confidence level.
Okay, what is that?
This is the allowable risk that your sample is going to lie to you, basically, that it will fail to reflect the true condition of the whole population of transactions.
So the risk that the control is actually failing a lot, but your small sample just happens to pull all good ones by sheer luck.
That's it, exactly. In statistics, we call it a type 2 risk. The risk that the auditor accepts the control is working when, in reality, the true failure rate is higher than they can tolerate. And the complement of that risk is your confidence level. If you set your risk at 10%, you're seeking a 90% confidence level.
And for something as high stakes as SOX compliance, what kind of confidence level are we talking about?
For critical controls, things that mitigate a significant risk, you are almost always looking for 90% or 95% confidence. Think of it this way. 95% confidence means that if you could magically repeat this test 100 times on the same population, you'd expect 95 of those samples to lead you to the correct conclusion.
The higher the risk of misstatement, the more confident you need to be and the bigger your sample gets.
Precisely. Which brings us to parameter number 2, the tolerable deviation rate, or TDR. This might be the most judgmental and the most crucial number in the whole calculation.
And this is what exactly?
It's the maximum rate of control failure or deviation that the auditor can accept and still decide to rely on that control as part of their strategy.
Okay, so our source material suggests that for high reliance on a control, the TDR is typically 10% or less. And I have to stop you there, because 10% sounds shockingly high.
It does.
If a key control is failing 1 out of every 10 times, how can I, as an investor, feel comfortable with that?
That is exactly the right question to ask. It connects the technical audit jargon back to the real-world risk. And the key is you're not tolerating a 10% misstatement rate. You're tolerating a 10% deviation rate.
That's the difference.
Let's take an example. The control is a manager must approve every purchase order over $5,000. If we test 100 of those and find a 10% deviation rate, it means 10 of them were missing the manager's signature.
Right, which sounds bad.
It is bad, but that deviation doesn't automatically mean the purchase was fraudulent or even wrong. Maybe the manager approved it over email but just forgot to sign the form. Maybe the purchase was perfectly legitimate, but the internal process just broke down on the paperwork. Because not all control deviations lead to a financial misstatement, we can accept a slightly higher deviation rate for the control itself.
I see. So there's a buffer.
There's a buffer. Now, if the control were fully automated, like a computer system that physically blocks a transaction from exceeding a budget limit, would demand a TDR very close to 0. But for human controls, which are messy, 5% to 10% is often the pragmatic, yet still rigorous standard for high reliance.
So for managers listening, the takeaway is the more robust your control is, the higher the TDR your auditors can justify, and that keeps your sample size and your audit costs down.
That is the efficiency lever right there, because if you want 95% confidence with the 5% TDR, your sample size is about 59 items. If your control is shaky and the auditor has to drop that TDR to 2%, your sample size for that same level of confidence jumps to around 150. That's a huge difference in effort.
Wow. Okay, so that's TDR. What's the third parameter?
Number 3 is the expected deviation rate, or EDR. This is the allowance for control failures that the auditor actually anticipates finding in the sample.
So you're building in an expectation of failure from the start. Doesn't that make the sample size bigger?
It absolutely does. The EDR increases the required sample size because you need a big enough sample to confirm that even with those few expected failures, the true failure rate in the whole population is still safely below your tolerable rate, your TDR.
It's a hedge against the test failing completely.
It's a hedge. If you go in assuming a 0% EDR, a zero failure expectation, and then you find just one deviation, your test might statistically fail. You might have to scrap it and start over. But if you had built in, say, an allowance for one error, you find that one error and you can still pass the test provided your initial sample was big enough to account for it.
And where does that expectation come from? Is it just a guess?
No, it should be based on evidence. You look at prior year audit results. Did this control have deviations last year? Were there related financial misstatements? If it's a brand new control, you might have to rely on its design strength alone and hope for the best. But here's a huge red flag for managers. If you find yourself estimating a high EDR, say 5% or more,
That's a problem.
that's a huge problem. That's a strong signal that the control needs to be fixed, that it needs remediation before you even start testing it. It's almost always cheaper to fix a broken process than it is to test hundreds of transactions just to prove that it's broken.
That makes sense. Okay, so that brings us to the fourth and final parameter.
And that's population size. This is the one that most people intuitively think is the biggest driver of sample size.
Right. The conventional wisdom is that a population of 1 million transactions must require a massive sample.
It's a very common misconception, but from a statistical standpoint, it's mostly incorrect. The reality is, once your total population of transactions gets over, say, 500 to 2,000 items, the impact of population size on the required sample size becomes negligible. It basically flatlines.
So for a huge company with millions of invoices, a statistically calculated sample size for 95% confidence and a 5% TDR is still only going to be around 60 items.
That's right. The statistical rigor comes from the confidence you require and the failure rate you can tolerate, not from the size of the haystack you're looking for the needle in.
That is a critical insight. It proves the value of investing in strong control design rather than worrying about transaction volume. But what about the exception? When controls don't happen thousands of times?
That's the one place where population size matters immensely. We're talking about infrequent but often very high-risk controls. For example, a monthly review of the general ledger reconciliations. Your population is only 12.
Or a quarterly calculation of a major reserve?
Yeah.
Population of 4.
Exactly. For those, the AGS and other guidance provides specific small population rules. For a quarterly control where you want high assurance, you'd test 2 of the 4 instances. For a weekly control, you might test between 5 and 9.
And in those cases, finding even one failure is a huge deal.
It's a catastrophe for the control, because the test is less about statistical projection and more about just covering the time frame and ensuring no failure occurred at all. One failure in a sample of 2 means the control failed 50% of the time you looked at it. You can't rely on that.
Okay, so that covers the statistical rigor for things you can count.
Mm.
But let's shift gears. What happens when we move from that precise science to the much squishier world of human judgment? How do you gather evidence on things like the tone at the top?
That's where we move into qualitative assessments. And you're right, sampling techniques become either inappropriate or just plain impossible. You can't draw a random sample of the tone at the top.
Or measure something like segregation of duties with a random number generator.
Exactly. These controls are often what we call entity-level controls. They permeate the entire organization. They're not tied to one specific transaction stream.
So what kind of evidence replaces the statistical sample in these really critical non-sampling situations?
The evidence gathering shifts to non-transactional procedures. It relies heavily on things like observation of key meetings, attending audit committee meetings to see how they challenge management.
You're also looking at resumes.
You're reviewing verified resume credentials of the people in governance. You're examining the minutes from board meetings. You might even use internal surveys or focus groups to gauge employee perception of the control environment. You ask questions like, do you feel the company actually follows up on issues reported to the ethics hotline?
And I assume the amount of this qualitative evidence you need to gather is different for a small private company versus a huge public one.
Oh, massively different. For a public company that is publicly attesting to its control effectiveness, the volume and depth of this qualitative evidence has to increase significantly. If you're going to assert that your control environment is strong, you need robust, documented evidence that management is competent, that the audit committee is financially savvy and independent, and that management overrides of controls are rare and investigated.
It all comes back to that same core question, doesn't it? Does the evidence I've gathered support a high level of reliance?
Always. Whether it's a sample of 60 or an observation of a board meeting.
Our sources reference a table that's often used in practice, one that details how these qualitative factors affect the extent of testing. Could you walk us through some of those? How do they translate into more or less audit effort?
Sure. These are the factors that drive the auditor's overall risk setting, which then determines how much work they do. The first is obviously the importance of the control.
So if it's guarding against a major fraud risk?
Right. Or a critical accounting estimate like revenue recognition, You're going to significantly increase the number of tests. That means demanding a higher confidence level, probably a lower tolerable deviation rate, which all drives the sample size up.
Okay, what else?
Frequency of performance. If a control happens multiple times a day, like a three-way match on invoices, you'll test more transactions overall, but you can spread that testing throughout the year. If it's a critical control that only happens once a month, you have to ensure that the few instances you test are highly representative and were performed perfectly.
And what about the human element?
That's a huge driver. The degree of judgment required. A highly judgmental control, like estimating a complex warranty reserve, requires more tests and probably more reperformance by the auditor, precisely because human judgment is so variable. It's not easily standardized.
And the complexity of the control itself.
Yes, a complex control, maybe one that involves multiple IT systems or has outsourced components, requires much more extensive testing to make sure every single link in that chain is effective.
Last one is the competence of the person performing it.
Right. The competence of the person. If the individual doing the control is known to be highly competent, well-trained, and well-supervised, you might be able to cautiously decrease the test count a little. But if their competence is questionable, or if there's high turnover in that role, you have to increase your testing to compensate for that higher inherent risk of human error.
So it's clear that even in these judgmental areas, it's not just a gut feeling. A good auditor is making a documented, methodical judgment that connects these qualitative risk factors back to the actual evidence they gathered.
That's it. Good judgment isn't just something you have, it's a process you follow and document. The work papers need to clearly show how these factors influence the scope of the investigation.
Okay, so we've established the rigor of sampling and how you approach qualitative controls. But before you can even think about sampling, you have to understand the entire control system. And that brings us to the mandatory starting point for all of this. The controls walkthrough.
The foundational test.
Why is this one procedure required for literally every single audit?
Because every audit, public, private, government, doesn't matter, has to start by assessing the control design and then getting at least some evidence that the controls described on paper are actually implemented and functioning in reality.
You have to see it in action.
You have to. The auditing standards are absolutely uncompromising on this point. You cannot simply rely on asking management what they do. Inquiry alone is never sufficient to establish that control exists and is operating.
So define the walkthrough for us. What is it precisely?
A walkthrough is a procedure an auditor uses to confirm their understanding of a company's process and control design. It involves tracing a single transaction, just one, from its absolute beginning, its inception.
Cradle to grave.
Cradle to grave. Through the entire information processing system, all the way to its final reporting in the financial statements. One purchase order, one sales invoice, from start to finish.
And what are the defining characteristics of a good walkthrough?
First, it absolutely must be a corroborative inquiry. You ask the personnel how they performed the control, and then you immediately say, great, show me. You demand to see the documentation or the system evidence that corroborates what they just told you.
And second, it's a test of one.
It is fundamentally a test of one item.
Mm-hmm.
The goal here is not statistical projection to the whole population. The goal is simply to verify the design of the system and the implementation of the controls within it.
And this leads to what seems to be a critical distinction, one that's often missed in practice. The walkthrough is not just about tracing the paperwork.
It is so easy to miss this. It's incredibly easy for an auditor to get lost in the complexity of the transaction itself and just follow the document trail. Okay, here's the invoice, here's the shipping document, here's the journal entry, it looks good.
But that's not the point.
It's not the point. The objective has to be laser-focused on the controls. At each step, the question is, did the control operate as described? Did the authorization happen at the right dollar level by the right person? Is there documented evidence that the control operated right at that point? Simply seeing that a transaction was processed correctly doesn't prove that the control designed to ensure it was correct was actually applied.
That's a great point. So an invoice being mathematically correct is substantive evidence. The signature on that invoice being reviewed against an authorization matrix, that's the controls evidence.
That is the distinction perfectly stated. And it's interesting, the revised COSO framework actually addressed this. It recognized that because of regulatory pressure, organizations often need to add more evidence of control operation like specific sign-off fields or system logs to their existing processes just to make them more easily auditable.
A good walkthrough obviously requires meticulous planning to be efficient. What are the best practices there?
You should plan to perform a walkthrough for every major transaction stream where you intend to rely on controls. Your sales cycle, purchasing, inventory, payroll. And that procedure has to be comprehensive. It should encompass the initiation of the transaction, its authorization, the accurate and complete recording, and then its final summarization. You want to pick that one perfect transaction that allows you to observe every single key control point in the cycle.
What about streamlining? What about functions that pop up everywhere, like cash disbursements?
That is a huge efficiency game. You've got functions like cash disbursements, cash receipts, or payroll that impact multiple account balances. The best practice is to walk through and test those shared common activities just once.
Not once for payables, once for payroll, once for expenses.
No, that's a waste of time. You test it once, holistically. It not only saves time, but it also gives you a much better, more integrated view of the overall control design and quality across the entire company.
When it comes to actually doing the walkthrough, who should you be talking to?
This is a huge inspection point for the PCAOB. You must inquire of the people who actually perform the control procedures and process the information every day.
Not just their supervisor.
If you only talk to the supervisor, you are getting the policy. You're getting the how it should be version. You are not getting the practice. You have to talk to the operations staff, the payroll clerk, the warehouse manager, sometimes people who are far outside the accounting department.
And the questions themselves, they need to be designed to find problems, not just confirm the process.
Exactly. The questions have to verify the person's understanding of their role, ensure they do it in a timely way. And critically, you have to ask things like, have you ever been asked to make an exception to this procedure? Or what happens when this information is missing? The auditor's job is to probe for the points of failure and pressure.
And since we know inquiry is the weakest form of audit evidence, how do we effectively corroborate what they tell us?
Corroboration is what gives the walkthrough its strength. You immediately support their answers by asking the person to demonstrate the procedure using live data. Show me on your screen. Pull up the last one you did. Show me the system log. Show me your sign-off queue.
And you talk to other people in the chain.
Yes, you strengthen the evidence by interviewing other people in the preceding or succeeding steps. You ask them to describe their understanding of the process to make sure the handoffs are clean and everyone's story matches. The documentation then has to detail exactly who you interviewed, whether they seem to understand their role, what live evidence you reviewed, and what your conclusion was.
Okay, let's bring this to life with a critical, sad story anecdote from our source material, because this demonstrates the absolutely devastating consequences of doing a walkthrough mindlessly without connecting the dots.
This story should be mandatory reading for every first-year auditor and every manager who writes a control description. It's a perfect storm of failure.
So we have a junior staff auditor. She's assigned to do a walkthrough of a commercial loan application process. She's got her checklist, she traces one transaction, and she dutifully notes that the loan amount was less than the property's appraised value. Check. And she confirms that an appraisal report was in the file. Check.
Checklist complete. On the surface, everything looks fine, but the control failed catastrophically.
Why?
The failure was entirely about context. The auditor confirmed the existence of the paper, but she missed the crucial policy context which gave that paper its meaning.
So walk us through what she missed, policy by policy.
The company's lending policy, which, by the way, was the entire basis for their very low loan loss reserve accounting, it required 3 specific things, and the single transaction she tested violated all 3 of them.
Okay, what was the first violation?
First, the policy stated that the loan could be for no more than half the appraised value, 50% loan to value. The loan she traced was for 90% of the value.
90%. A massive violation right there. What was the second?
Second, the policy required an appraisal by an independent, company-approved appraiser. The appraisal in the file was from a property developer, a clearly interested party, not independent at all.
And the third violation?
The third was that the valuation had to be for the property in its current state, as is. The appraisal she found valued the property at its completion after a bunch of proposed improvements were made. It was a speculative future value, not a current one.
So the staffer just checked the boxes. Appraisal present? Yes. Loan less than appraisal? Yes. She rendered the entire exercise useless because she missed the actual meaning of the control, which was defined by those internal policies.
The walkthrough documentation was fatally flawed because it failed to link the evidence she reviewed to the actual policy requirements that were designed to mitigate the risk of making bad loans. If she, or more importantly her reviewer, had identified these 3 blatant policy violations in that single transaction,
It would have been a massive red flag.
it would have immediately suggested either a deliberate management override of controls or a pervasive breakdown in the authorization process. You would have had to stop the audit right there and reevaluate everything.
And what was the ultimate consequence of this one missed connection?
The loans eventually defaulted. This led to enormous losses, the ultimate collapse of the company, sanctions against the executives, and, yes, jail time for those involved. It's a stark confirmation that the greatest danger in an audit isn't always a complex technical error. It's a failure of critical thinking and basic supervision. Mindlessly checking boxes on a walkthrough can have devastating public consequences.
And if we reflect that back on documentation in general, what are the constant complaints reviewers have about walkthrough paperwork?
It's often too wordy. You see these long narrative descriptions that just obscure the focus on the actual control points, or it fails to explicitly connect the identified risks, inherent risk, fraud risk, to the specific controls being tested.
So what does good documentation look like?
Good documentation is clear, concise, and it serves as an irrefutable proof of work. It needs to clearly show who was interviewed, what live evidence was reviewed, and how that specific evidence meets the policy objective designed to mitigate the specific risk. It tells a complete story.
That concept of avoiding stovepipe thinking seems vital here. You can't just look at the sales process in isolation from everything else.
Exactly. Stovepipe thinking is looking at one procedure narrowly without considering the overall reliance strategy for the whole audit. Your documentation has to show the whole chain of assurance. For instance, an auditor might take a really small sample for existence testing of receivables. In isolation, that looks weak.
But it might be justified.
It might be perfectly justified if the documentation clearly shows that, hey, the cash receipts controls were extensively tested and found to be highly effective, and the accounts receivable confirmation process was also incredibly robust. Those things together justify the smaller sample elsewhere, but you have to connect those dots explicitly in the documentation. Auditors are not mind readers. The reasoning has to be written down.
That devastating consequence from the loan story really takes us perfectly into the strategy discussion. If controls can fail that badly, how do auditors, especially for smaller private companies, even decide if relying on them is worth the risk and the cost?
This is where that strategy really pivots. And for private entities, for government organizations, there's a huge efficiency tip here. If they proactively document and perform adequate tests of their own controls internally, they can dramatically reduce the external audit effort.
Because relying on controls is ultimately more efficient than just testing transactions.
In a well-controlled environment, yes. The sample sizes you need to establish die control reliance, that 60-item sample we talked about, are generally much smaller and less disruptive than the sample sizes required for substantive testing, which could run into hundreds or even thousands of items. If the control works, the auditor saves a ton of time.
Now, our sources talk about audit leverage, especially under the PCAOB's AS5 standard, where the external auditor can actually use the company's own testing.
Yeah.
But how does that work without compromising independence? And aren't they just redoing the work?
It's a fine line. The auditor can't just take the internal work and accept it blindly. First, they have to perform a formal assessment of the competence and objectivity of the person who did the internal testing, whether that's management or, more commonly, an internal audit function.
So they have to audit the internal auditor first, in a way.
That's a great way to put it. If the internal auditor is well-trained, independent from the process they're testing, and has a strong track record, the external auditor can often place reliance on that work and use it as direct evidence to reduce the extent of their own substantive procedures. That's the definition of audit leverage.
But there has to be a line they can't cross. There's a high assurance barrier, right?
Yep.
Especially for the really sensitive stuff.
Absolutely. For areas that are highly prone to fraud risk or areas that require significant management judgment-like complex fair value estimates or assessing management's own competence, auditors are explicitly cautioned that they must gain that assurance themselves. They cannot simply rely on internal company assessments for those tricky subjective areas, no matter how good the internal audit team is.
Why not?
Because certain elements, especially the tone at the top and the anti-fraud controls, require the objective distance that only a third party, the external auditor, can provide.
This brings up a major complication in the audit world, something that came out of the Dodd-Frank Act back in 2010. It created an exemption for smaller public companies, the non-accelerated filers.
Right. They were exempted from the requirement for that separate auditor's attestation on controls effectiveness. The idea was to reduce the very high cost of SOX compliance for smaller businesses.
But the company itself, management, still has to publicly assert that its internal controls are effective.
They do, and this creates what we often call the non-accelerated filer disconnect.
So for an investor who's looking at the financials of one of these smaller public companies, what should they know about the difference between management self-assessment and a full independent auditor's assessment?
The historical lesson here is pretty stark, and it should worry investors. Research from the early days of SOX showed that the auditor's independent testing caught over 70% of all the identified control deficiencies.
70%.
70%. Management's own self-assessments were, quite predictably, often inadequate or just way too optimistic about the state of their own control environment.
So today, for one of these non-accelerated filers, the auditor has a choice. They can technically structure their audit based primarily on substantive testing, right?
They have that strategy choice back. They can focus on analytical procedures and direct tests of transactions and balances. They can effectively choose to ignore management's assertion of control effectiveness for their own audit efficiency plan. And some auditors prefer that. They believe direct evidence of financial fairness is always superior to the indirect evidence you get from testing controls.
But I imagine that causes some friction with regulators.
It does. Regulators generally prefer the efficiency of control reliance. But regardless of the auditor strategy, the SEC and PCAOB have an explicit auditor caution in place. Auditors of these non-accelerated filers must review the client projects that support management's assertion. They have to make sure management had an adequate basis for saying their controls were effective.
So it's a check, but not a full-blown audit of the controls.
Exactly. It's designed to provide some level of oversight without forcing the company to pay for the full, expensive attestation process.
And you think this is an area that's ripe for future enforcement action?
I do. It feels like a matter of time. A high-profile control failure at a smaller public company that's traced back to an overly optimistic management assessment that the auditor didn't challenge. That's likely to prompt a very public PCAOB or SEC enforcement action. For the investor, that disconnect is crucial to understand. You're relying on management's word, and history shows that word is often wrong.
Let's talk about methodology and how it's evolved. Our sources describe the initial implementation of SOX as a perfect storm. What was so chaotic about it?
It was pure chaos. You had this aggressive new regulation, incredibly tight timelines, and a high degree of unpreparedness in both the corporate world and the audit profession. You had companies that suddenly became accelerated filers mid-year and were forced into full compliance in less than 6 months.
And that led to what? Just testing everything.
It led to massive, costly, and often completely unnecessary overkill testing. Auditors, trying to protect themselves, were testing every minor control they could find, whether it was truly key to the financials or not.
And to combat that overkill, the PCAOB introduced the top-down concept.
The top-down concept was really elegant in its simplicity. It urged auditors to start at the highest level with the entity-level controls, the control environment, and the IT general controls.
The big picture stuff first.
Exactly. The goal was to identify and test these key, pervasive controls early in the process to find any potential showstoppers that could derail the entire audit late in the year. If you find a major deficiency in your control environment in December, it's far too late to fix it. That guarantees an adverse opinion.
That concept really highlights the critical challenge of timing. When you're relying on controls for audit efficiency, what period does your sample have to cover?
If you're relying on a control to reduce your other substantive procedures, your tests must be representative of the entire period of reliance. So if you plan to rely on that control for the full year, your sample transactions have to be pulled from January 1st all the way through December 31st.
But the attestation for public companies is different. That's made as of the balance sheet date, right? December 31st. How do those two timing requirements clash?
They create a very real practical dilemma. The need to support reliance for the full year clashes with the pressure to ensure controls are working perfectly right at the reporting date. And many companies react to this by adopting a disproportionate testing strategy.
Meaning they backload the work.
They backload it heavily. They might test, say, 4 items per quarter from January to September, but then test 10 or 15 more items in the last 2 months of the year.
What's the risk for companies that wait until the last quarter to do the bulk of their testing?
Well, the research on this is really clear. Late in the year testing is strongly correlated with unremediated material weaknesses and significant deficiencies. It's common sense. If management waits until December to really test their controls, they discover the problems too late to fix them before they have to issue their financial reports. Proactive, early testing is always the smarter investment.
And there's a specific PCAOB inspection focus related to this, right?
Yeah.
When controls are tested early, say in October, but the year end is December 31st.
Yes, this is a frequent finding. Auditors are often cited for failing to adequately extend their test results to year-end after performing that interim testing. If there's a gap between your testing date and the end of the period, you have to perform follow-up procedures.
What kind of procedure?
It can be a combination of inquiry, observation, or even some reperformance of the control. You have to do something to ensure the control hasn't changed or failed in that intervening time. And the longer the gap, the more robust your extension procedures need to be. Just asking, is everything still the same, is rarely sufficient if your gap is more than a couple of weeks.
That makes perfect sense. Okay, let's transition to the bedrock of all of this in the modern era, the IT infrastructure. That top-down approach mandated early consideration of IT general controls, or ITGCs. Why are these so fundamental that a problem here can potentially invalidate all the other testing we've just discussed?
Because ITGCs, which relate to Principle 11 of COSO, they are the infrastructure of the entire control system. They're critical because a deficiency in an ITGC doesn't cause one specific transaction error. It permits systemic errors or fraud to occur across the entire entity. The impact is pervasive.
Can you give me an example of that pervasive impact?
Sure. Let's say your system modification controls are weak. An unauthorized IT staffer could push a malicious code update that subtly changes how revenue is calculated for every single sale. Or, if your security and access controls are poor, any test you performed on the validity of transaction data is essentially worthless because you can't prove that unauthorized users haven't gone into the database and altered that data after the fact.
The system integrity is foundational to the data integrity.
That's the principle. And assessing these controls almost always requires specialized expertise. But it shouldn't be siloed off.
What do you mean?
Well, you need IT audit specialists, especially in complex environments. An integrated team approach is highly recommended. The IT specialists work closely with the general practice financial auditors. The financial auditor makes sure the IT testing is focused on the real financial risks, and the IT specialist brings the technical competence. It prevents the IT audit from going down a rabbit hole that doesn't matter to the financial statements.
Okay, so let's break down the 4 core elements of ITGCs that every manager and investor should probably have a handle on.
These are the pillars of system security and reliability. First, you have security and access, basically preventing unauthorized people from getting into programs and data.
Number 2.
Second is systems modifications. This is all about controlling changes to programs once they are up and running. Third is new systems development, which is the controls over implementing big new systems. And finally, number 4 is operations, keeping the lights on, hardware maintenance, backups, and disaster recovery.
All right, let's deep dive into the first 2. Let's start with security and access. As a manager, if I want to prove this control is effective, what specific procedures is an external audit team going to perform?
They have to move well beyond just asking questions. The procedures will include physically verifying access restrictions to server rooms. They'll map the network to identify all the key financial applications, and then they'll perform what's called a user entitlement review.
A user entitlement review? What's that?
It's a crucial procedure. The audit team takes a sample of users, often focusing on high-risk roles like accounts payable clerks, general ledger accountants, or system administrators, and they review their actual system access rights against their required job functions.
So they're asking, does the AP clerk really need the ability to change the vendor master file?
Precisely. Does the payroll supervisor have the ability to change tax rates in the system? You're looking for those incompatible roles and for people who have excessive access rights that they just don't need for their job. They'll also test password policies. Are changes forced periodically? Are terminated employees removed from the system immediately?
And what's the role of system logs in all this?
The logs are the evidence. Auditors will review system logs to detect unauthorized access attempts or changes to critical data. And for the entity itself, the risk here now goes way beyond just accounting data. The standards now force auditors to consider the entity's ability to protect sensitive personal information.
Because of all the data privacy laws.
Exactly. Failing to protect customer data can lead to massive state and federal penalties. So the auditor is now looking for proactive controls to prevent data theft and privacy violations, not just financial misstatement.
Okay, let's move to systems modifications. ITGC number 2. When a system is updated, how do we make sure that change is intentional, tested, and doesn't break everything?
The control here is the change management process. The auditor needs to verify that this process actually works, so they'll test a sample of program changes that affected financial reporting during the year.
And they'll trace it from start to finish.
From the initial written request for the change, to the authorization, to the evidence that it was rigorously tested in a separate, non-production environment, a staging server, and critically that it received formal sign-off from the user department before it was pushed live.
And what if a company just had no program changes in the period?
Well, that's the one easy win here. That element of the ITGC, systems modifications, is considered not relevant for that year, and it doesn't need to be tested. But you have to confirm there were genuinely no changes, which usually means reviewing the system's own internal change records.
Okay, so that brings us to new systems development. This is on a much grander scale than just modifications, and it's where the consequences of poor planning are really exposed, as we see in the true story anecdote.
This anecdote is just a perfect illustration of being penny-wise and pound-foolish. You have a major corporation, and they decide to replace a critical but old inventory and receivables system.
And to save money on expensive consultants.
To save those professional consulting fees, they decided their internal IT staff, who were experts in the old legacy system, only needed a 3-day training orientation on the complex new system, not a full professional implementation with experts.
And the outcome was predictable, I assume.
It was a disaster. The implementation failed spectacularly. It led to immediate and widespread data corruption and the material loss of critical accounts receivable information.
So what did the company do?
The accounting department was faced with this impossible choice at year-end: either record massive estimated losses or try to assure the public that the data was somehow recoverable. Eventually, the situation was so severe they had to get an independent report just to confirm their accounting judgments, and they recorded huge financial losses in the following year, all directly related to the system failure.
The lesson being, what? Don't skimp on implementation?
The lesson is undeniable. Robust controls over new system development, including detailed specifications, careful data mapping, rigorous user acceptance testing, and proper professional installation, they were absolutely non-negotiable. The money they tried to save cost them 10 times as much in the end.
Okay, finally, let's cover operations, ITGC number 4. This is about maintenance and recovery.
Right. Operations is about ensuring the environment stays stable and available. This includes maintenance policies, having an efficient user help desk, and, most importantly, robust backup and recovery procedures. The auditor is looking for evidence that the entity consistently follows its own policies for maintenance and for backing up critical data.
And this brings us to that powerful and very somber best laid plans anecdote about disaster recovery.
It's a tragic story, but a vital piece of perspective. There was a high-tech computer service business located in one of the World Trade Center buildings. They had a state-of-the-art, very sophisticated backup and recovery system.
But it failed on 9/11.
It failed completely because their sophisticated recovery site was located in the other World Trade Center building that also collapsed. The risk of failure was perfectly correlated across both their primary and backup sites. It highlights the critical need for creative, truly critical thinking when you design recovery plans. You have to ensure your plan accounts for systemic, catastrophic events that could affect both your primary and backup locations simultaneously. Geographic separation is key.
So does an auditor actually have to perform a dry run of the disaster recovery plan to test it?
Not explicitly for SOX compliance, no. Not if the plan is well documented and seems adequate on paper. However, a feasibility assessment or an actual dry run is an incredibly wise investment for the company itself. And here's why. You cannot reliably identify deficiencies in a disaster recovery plan during a period where that plan wasn't actually used.
You only find out it doesn't work when you really need it to work.
And by then, it's far too late.
So after this incredibly detailed journey, what does this all mean for our listener?
Well, I think if you're a manager, the big takeaway is that your efficiency, your audit cost, it depends entirely on your ability to justify a higher tolerable deviation rate. And that means your controls have to be designed impeccably from the start. If you're an investor, you have to appreciate that the reliability of the entire financial statement can hinge on these pervasive IT general controls like security and change management. It's not just about the numbers.
There's this constant tension, isn't there, between the precision of statistics and the necessary nuance of human judgment.
That's the whole game. And proactive, clear documentation is the only way to manage that tension effectively.
And that really leads back to that fundamental boundary, the one that must never be crossed.
That's right. The independent auditor is not part of the entity's system of internal control. Management is responsible. While collaboration on mapping processes and using tools is helpful and efficient, management absolutely must establish and maintain the controls independently. That integrity has to stand on its own.
The sad story of that loan application failure. It really brings it all home. The consequences of that simple failure to apply context were just so severe.
And that leads directly to our final provocative thought for you to consider. The most sophisticated, automated, AI-driven control systems in the world will still fail when the people executing the procedures operate on assumptions, when they just check boxes without critical thought, or when they override a policy without documenting why.
So if a key control procedure, like that review of a commercial loan, cannot be clearly and concisely documented to support the decision and link back to the underlying risk policy.
Does the control truly exist? Or is it merely a reflection of management's wishful thinking? Something to mull over as you assess the true integrity that lies beneath the checklist.
Welcome back to the deep dive. We're here to take on those, complex, high-stakes topics that professionals deal with every day.
And we really try to strip them down to the essentials, right? The
Ah.
core ideas you can actually use.
Exactly. Because we know you're busy. The last thing you want to do is wade through hundreds of pages of technical standards on your afternoon off.
Yeah, and that's really the big hurdle in the modern professional world, isn't it?
It is.
You're expected to use your professional judgment, which is based on all these established standards.
Right.
But the standards themselves, they often speak in these big, broad concepts, risk, assurance, reliability. They rarely just give you a hard number.
And our job is to sort of bridge that gap.
That's the plan.
Think about something like control testing, maybe in finance or in an audit. You could have a population of, say, 10,000 invoices.
A huge number.
And every single one needs a manager's approval. Now, checking all 10,000 of them is, it's basically impossible.
That's not practical now.
But the standard still demands you provide, high assurance that the control is working.
So you're stuck.
The only way out of that workload is through the precise statistical calculation of a sample.
And that is exactly our deep dive for today.
Let's get into it.
What we want to do is decode this rigorous method that professionals, auditors, compliance officers, risk managers use to turn those big professional standards into one single defensible number.
The correct sample size.
The correct sample size to test their internal controls. It's all about finding the minimum amount of work for the maximum statistical assurance.
So to do this, we've been digging into a really detailed tutorial on statistical sampling. It gives you all the nuts and bolts.
And we're also pulling heavily from established professional guidance. Specifically from the AICPA, their main standard on this is AUC number 530, audit sampling.
Right. And we're also looking at practices that are common at the PCAOB, which, oversees the big public company audits.
So for you, the learner, our goal here is to help you really internalize the logic.
We're not just giving you formulas to memorize.
No, not at all. We're going to explore the simple formula that gets you in the ballpark, then the detailed tables that account for reality, for error.
And then the decision rules, the pass-fail criteria you have to apply when the test is actually done.
Absolutely. Because if you can master the logic behind these statistical parameters, you really hold the key to robust control assurance.
Okay, let's unpack this. The goal of any sampling, really, is to get what's called a representative sample.
Right.
It sounds simple, intuitive even, but in a technical, auditing context, what does representative actually mean?
This is fascinating because the auditing definition, it kind of runs counter to what most people think representative means.
How so?
Well, when people hear that word, they assume the sample has to be a perfect, scaled-down replica of the whole population.
Like a mini version.
A mini version, exactly. With the exact same proportional mix of transaction types, dates, amounts, everything.
And that's not it.
That is incorrect.
Okay, so if it's not a mini-me of the population, what is it?
In this world, representative is all about the selection process, not the final outcome.
The process.
It just means that the selection was made without bias. The whole goal is just to make sure every single item in that population had an equal chance of being picked.
I see.
So if your selection method is unbiased, then the sample you get, whatever it happens to look like, is considered representative, and you can project the results onto the whole population.
So the focus is 100% on neutrality. How do auditors actually do that? How do they get this non-biased selection?
Our sources point to three main methods, and they're definitely not all created equal.
I can imagine.
The statistical gold standard, the one that's preferred above all others, especially for really rigorous testing, is random selection.
Yeah.
When you use a random number generator or some kind of statistical software, you guarantee that every item has a mathematically equal chance of being picked.
It takes the human element out of it.
Completely. It's the only way to guarantee you've removed human bias, and you can fully support statistical inference.
But what about, the real world, where you don't always have fancy software or the population isn't a neat digital file?
Right. And that brings us to the other two methods. The first one is called haphazard selection.
Haphazard? Sounds a little risky.
It is. It's an attempt to simulate random selection, and it's often used when you're not doing formal statistical sampling. The auditor just tries to pick items without any kind of conscious pattern.
But I've got to imagine that's where bias just creeps right back in.
It absolutely does.
You might think you're being random, but humans, we're pattern-seeking machines.
Exactly. The risks are, they're profound, and they're often really subtle.
For instance,
An auditor looking at a stack of paper files might, subconsciously pick the neat, clean folders and avoid the messy ones.
or if it's on a screen, maybe they gravitate towards the round dollar amounts.
Or transactions from the start of the month, or maybe they only test things that were processed in the afternoon because that's when they were working. It relies completely on the auditor's self-discipline.
Which is why the true statistical methods are always better if you can use them.
Always.
And method number 3.
Is systematic sampling. This involves picking every nth item, so say every 75th control operation in a list.
Okay, that feels more structured.
It is, and it's easy to execute, which is why non-statistical samplers often use it. It gives you a nice spread across the population.
There's a catch.
There is. It can get you into trouble if the population itself has some kind of hidden pattern that lines up with your interval.
Oh, I see. Like if every 50th item is processed by a specific faulty IT batch job.
Precisely. You could either miss it entirely or oversample it, skewing your results.
This all leads to, I think, one of the most important points in the standards, which is this tight link between statistical and non-statistical sampling.
Yes.
The guidance doesn't just let you throw out the math because you chose not to use software.
This is absolutely critical. I mean, it's central to the integrity of the whole audit. The AICPA standard, AUC 530, says that if you're using non-statistical sampling...
So like haphazard or systematic.
Right. You must still use your professional judgment to relate the very same factors that the statistical samplers use.
And those same factors are risk, tolerable rate, and expected deviation rate.
Precisely. And this creates what we can call the comparability standard.
Comparability standard.
The standard is basically telling auditors, look, you can use your judgment, but your judgment isn't arbitrary.
It has to be grounded in the math.
It has to be informed by the statistical reality. So the sample size you end up with from your non-statistical method, it has to be comparable to the size that a well-designed statistical sample would give you.
That stops someone from just saying, well, my judgment told me to pick 12 items. When the math clearly shows you need 55 to get to 90% assurance.
That's the exact preventative measure it's designed for. And you see the PCAOB, the ones setting rules for public companies, they are right in line with this. They often use specific tables and practice aids, which basically standardizes the inputs. They're reinforcing that even when you apply judgment, the answer has to land in a statistically sound ballpark.
They're rejecting arbitrary judgment.
In favor of mathematically justifiable efficiency, yes.
So this link really hammers home the idea that these complex formulas and tables, they're not just suggestions. They're the baseline for what constitutes enough evidence.
That's right. And the practical reality is that most professionals, or as the source kind of wryly puts it, most of us mortals, we need to reference these decision aids.
The tables or the formulas.
Yeah, it's a necessary safeguard.
But there's that interesting side note you mentioned about experienced professionals.
Right. They can develop this almost intuitive sense for it.
It's efficiency from repetition.
It is. An experienced pro who's run hundreds of samples at 90% confidence with a 5% tolerable rate. They just know the answer is going to be in a very narrow range.
Usually between, 40 and 70 items?
Something like that, yeah, depending on a few other things. But they can often estimate a number that's very close to the formal calculation without even looking at the table.
And the source gives some practical reassurance here, which I like. It says, if you estimate 59 and the table says 60, don't worry about it.
Exactly. That's negligible. We're talking about rounding errors at that point. That's not an audit quality issue.
The problem comes when the difference is huge.
The concern only materializes when you have a significant unjustifiable gap. If the parameters say you need 22 items for, say, a low level of assurance, but the auditor only tests 10.
That's indefensible.
It is. It's professionally and statistically indefensible. And that's the whole point of the AICPA guidance, to make sure non-statistical sampling doesn't just become a smokescreen for doing less work.
That whole discussion sets us up perfectly for our first big tool.
The simple formula.
Right. So say I'm on the road or I'm just drafting an initial audit plan. I don't need absolute pinpoint precision yet. I just need a quick back-of-the-envelope calculation. Where do I start?
Your starting point is the simple formula. It is a foundational method. It's best for that initial planning stage, for setting expectations, especially when you need to make fast decisions about, how many people to put on the job.
And it's manageable because it only relies on 2 core parameters.
Exactly, just 2 inputs. The first is your confidence level, which we'll call F. That's how much assurance you want.
Okay.
And the second is the tolerable deviation rate, which we'll call T. That's the maximum failure rate you're willing to accept in the population.
Let's define those really clearly for everyone listening. The confidence level, F, is basically how sure you need to be that your sample's result reflects the truth.
Right. If you choose 90% confidence, you're saying that if you did this test 100 times, 90 of those times, the real population error rate would be within your acceptable range.
And the tolerable deviation rate, T, that's a judgment call.
It's a professional judgment. It's your ceiling. You're asking, if this control works 98% of the time, is that good enough? If you set T at 5%, you're saying you can live with up to 5% failure before you have to conclude the control is ineffective.
All right, now for the formula itself, it's surprisingly elegant. It's just $1 equals of FT, though.
That's it.
N is the sample size we're looking for. F is that confidence level factor. And T is your tolerable rate, but as a decimal.
And the magic, if you want to call it that, is in that F factor.
The factor.
This factor is a constant. It comes from statistical distribution theory, specifically the Poisson distribution, and it lets us connect a probability, which is confidence, to a physical sample size.
And it comes with some big assumptions.
Huge assumptions, a very large population, and a 0 error rate.
Let's lay out those key F factors because these are probably worth remembering for anyone doing this regularly.
For sure. For the highest level of certainty, 99% confidence, the factor, F, is 4.61.
You probably wouldn't use that for most internal controls, though.
Yeah.
Too expensive.
Generally, yeah. Too costly, much more common. At 95% confidence, F is 3.0.
In the workforce, the most common level for attestation is 90% confidence.
Which has a factor of 2.31.
There are also factors for lower assurance levels too, right?
Yes. For example, 87% confidence has a nice round factor of 2.0, and 75% assurance is 1.39.
You might use those for internal management reports or something where the stakes aren't quite as high.
Exactly.
Let's run this through a standard example. Let's say we're auditing purchase order approvals.
Okay.
The population is big, 3,000 transactions. And we decide that a 10% failure rate is the absolute maximum we can tolerate.
So our tolerable deviation rate, T, is 10%, or 0.10.
And we need strong assurance, but not the absolute max. Let's go with 90% confidence.
Okay, so we just plug in the numbers. $1 is FT-NOS.
The factor for 90% is 2.31. The tolerable rate is 0.90.
So $1 is $2.31. The result is a required sample size of 23 items.
That's an incredibly fast calculation.
It is. It gives an auditor a statistically justifiable minimum sample size in seconds.
Okay, if you're listening, you should probably pause on that for a second. You're telling me that by testing just 23 items out of 3,000, I can be 90% sure that the real failure rate is no more than 10%. That feels like an almost absurd leap of statistical faith.
It is the power of mathematics. But that power comes with a huge monumental caveat.
Which is?
We have to be crystal clear. This calculation is only valid if you assume you will find 0 deviations in the sample.
That feels wildly impractical. Are we really supposed to assume 0 errors, even for great control?
It sets a very, very high bar.
Doesn't that formula just set you up for immediate failure the second you find one tiny non-critical deviation?
In many ways, yes, it does. It's a planning tool for a perfect world. If you find even one deviation in that sample of 23, the actual confidence you achieve just plummets.
A concept we'll get into later.
Right. But the simple formula is useful because it sets the absolute minimum evidence you need if and only if the control is flawless.
So how do we adjust this for the real world, where we might expect a very low, but not zero, rate of errors?
The source material gives a useful rule of thumb here. It's not perfectly statistical, but it works.
What is it?
If you plan to allow for a low level of expected deviation, you should double the computed sample size.
So in our example, 23 becomes 46.
Exactly. 46 items.
Why doubling? Why not multiply by 1.5 or 3? What's special about 2?
Doubling is a rough statistical shortcut. In general, it provides enough of an additional sample size to absorb one, maybe two minor exceptions without completely tanking your desired confidence level.
So it's an acknowledgement that we're not in that perfect world anymore.
Right. But it's crucial to remember that this doubling rule is a non-statistical adjustment. It's easy, but it doesn't give you the precise, verifiable assurance that using a proper table or software does.
And we also have to remember the formula's other big constraint, which is about the population size.
Yes. The simple formula inherently assumes a large population. Generally, that's defined as over 1,000 control operations.
Why is that?
The statistical theory behind that F factor, it assumes that the sample size is tiny compared to the population size.
So what happens if an auditor tries to use one IT on a smaller population? Say, a control that only runs 200 times a year.
In that situation, the simple formula will be overly conservative. Meaning the sample size it calculates will be excessive. It'll be more than you actually need for that smaller population.
So you end up wasting time and resources testing more than is statistically necessary.
Exactly. And for those scenarios, smaller populations, or when you know you're going to find some exceptions and you need high precision, that's when you have to move away from the simple formula.
And start using the more refined tools, like tables or computer programs.
Precisely. That transition from the simple formula to using tables is really driven by reality.
The reality that controls, even really good ones, are rarely perfect.
Exactly. The moment you decide to allow for an expected deviation rate, even a tiny one like 0.5%, the math shifts.
And you need something more precise than NFT.
Right. So we move to statistical tables. And these tables, they are basically pre-calculated grids that account for that complex interaction between your confidence level, your tolerable rate, and your estimated error rate.
Using them is still a systematic process, though.
Oh, absolutely. Step 1 is you select the correct table for your desired confidence level.
Which is always 100% minus your acceptable risk.
Correct. And as we said, 90 and 95% assurance tables are the most common ones you'll see in auditing.
And step 2 is finding the intersection point on that grid. You map your tolerable rate against your expected rate.
But here is the major upgrade you get over the simple formula. When you find that sample size on the table, it usually has a number next to it in parentheses.
And that number is key.
It's extremely valuable. It represents the maximum number of expected deviations you can tolerate in that sample and still meet your planned assurance level.
So the table tells you the exact pass-fail line for your test before you even pick the first item.
It does. It quantifies the statistical cushion you've built into your sample from the very beginning.
Let's walk through an example from the source material. We'll use table 8.8.1, which is for 90% confidence.
Okay.
Let's say this is a critical control. We need a high level of performance, so we're going to set a tight 5% tolerable rate.
A low margin for error.
And we know this client well. We have experience with this control, so we expect a very minimal error rate. Let's say an expected deviation rate of 0.5%.
So we go to our 90% confidence table. We find the 5% tolerable rate column and the 0.5% expected weight row.
And where they intersect, the resulting sample size is 77 items.
And what does the number in the parentheses tell us?
The table will show that a sample of 77 has a tolerance of 1 deviation.
And the precise statistical meaning of that is?
Testing 77 items gives you 90% assurance that the real population failure rate is 5% or less, as long as you find no more than 1 non-critical deviation in your sample.
So if you find 2 deviations in that sample of 77,
You failed the plan. Your reliance level collapses.
that clarity is invaluable. But we often run into situations where we just can't accurately estimate that expected deviation rate.
Right. Maybe it's a brand new control or one that was just completely overhauled after a previous failure.
That uncertainty creates a dilemma. If you assume a high expected rate just to be safe, you might end up with a huge sample that's really expensive to test.
And if you assume too low a rate, your sample might fail right away, and you have to abandon the test.
The technical solution for this exact problem is something called formal two-stage sequential sampling.
Okay, that's a mouthful.
It is, but it's designed to be highly economical while still being statistically valid. It's a really intelligent way to minimize your costs when the control's performance is a total unknown.
So think of it as a statistical screening process.
That's a great way to put it. Instead of committing to that big single-stage sample of 77 items right up front, you break the test into 2 phases.
So how does the two-stage rule work in practice?
It's based on sequential acceptance. You start by selecting a smaller initial sample, that's stage 1. If you find 0 deviations in that first stage, you stop immediately, the sample passes, you conclude the control is effective, and you've saved a ton of time and money.
But what if that initial screening finds 1 deviation?
If 1 deviation is found, you have to continue to the second, smaller stage. You test those additional items.
And then look at the combined total.
Right. After you've tested the combined sample stage 1 plus stage 2, if you still only have that 1 deviation and 1 is within the acceptable limit for that new larger sample size, you might still pass.
But if you find 2 or more deviations at any point,
the whole plan fails immediately. Game over.
the value here becomes really clear when you look at the actual sample sizes in Table 8.8.2, again for 90% confidence. Let's go back to our 5% tolerable rate.
Okay. In the single-stage test, we needed 77 items up front.
Right.
In the two-stage approach, for that same 5% tolerable rate, the initial sample size is 51 items.
So if the control's running perfectly, we stop at 51. We just save the work of testing 26 items.
That's the economic benefit right there. Now, if we find one deviation in this first 51, we have to proceed to the second stage sample, which is 39 items.
So the maximum we'd ever test in that scenario is 51 plus 39, which is 90 items.
You're right.
So that's the trade-off. Single stage is a guaranteed 77 items. It's a known cost. Two-stage has a lower initial cost of 51, but a potentially higher maximum cost of 90 if the control is just so-so.
It's all about your risk profile. If a control is brand new or has a history of problems, two-stage is often better because it minimizes your initial investment on something you suspect might fail quickly anyway.
It lets you stop and recommend remediation faster.
Exactly.
And just to make that concrete, what if we had a lower assurance target, say a 10% tolerable rate?
Well, the single-stage test for 10% tolerance might need, 35 or 40 items.
Okay.
In the two-stage setup, the initial sample size is just 23 items. If you stop there, you've saved a lot of time. If you have to continue, the second stage is 29 items for a max total of 52.
So it's a really smart way to balance the need for assurance with real-world budget and time constraints. You don't overinvest in an unknown risk.
Right. And while these tables are essential for really understanding the mechanics, the reality for most practitioners today is that this heavy lifting is done by software.
By computer-assisted audit tools or CA.
Tools like ACL or IDA, which is the one our source material uses for its main example, these are the powerhouses that turn those static tables into dynamic analysis.
What's the main benefit of using a program like that?
The primary benefit is precision. They determine the exact attribute sample size across a whole range of parameters, and they can properly account for the estimated population size.
So it gets rid of that over 1,000 assumption from the simple formula.
Exactly. A CAT can handle a population of 800 just as accurately as one of 8,000. It uses specific adjustment factors.
Let's dive into that IDEA software example to see what it gives you that a manual calculation can't.
Okay, so here's the scenario. We have a population of 800 control operations.
A specific number.
Yes. And we're seeking a robust 90% assurance that the control's failure rate is no more than 5%.
And for planning purposes.
We're being optimistic. We're assuming 0 exceptions expected.
So given those very specific inputs, what does the software calculate?
The computer-determined sample size is 43 items.
Which is more precise than what we would have gotten with the simple formula.
Right. That would have given us 46 items after we doubled the base of 23. The CIAT makes sure we're not over or undersampling for that specific population.
Okay, but now we get to the really critical value add from these programs, something neither the formula nor the tables can give you.
And that is the achieved confidence output.
That sounds important.
It turns the whole exercise from just a planning tool into a post-test risk assessment tool. It shows you, the auditor, the actual statistical reality if your test results don't match what you planned for.
So let's track the results from that IDA output for our 43-item sample plan.
Okay. If we test all 43 items and find 0 deviations,
Just like we planned.
Then our achieved confidence is 90.23%. We successfully met our 90% goal. The control is effective, full reliance is supported.
But this is where the skeptical auditor hat comes on. What if we find one single unexpected deviation?
If we find just one deviation in a sample of 43, the software instantly recalculates that the achieved confidence level has plummeted to 66.2%.
Wow, that is a staggering drop. That's a loss of nearly 24 percentage points of assurance from one single error.
And if the test is even worse, if we find two deviations,
It gets even lower.
the achieved confidence drops to a mere 38.08%.
This quantifiable drop is probably the most valuable piece of information you can get for exercising professional judgment.
It informs every decision you make after that. If you were testing this control to meet a strict Sarbanes-Oxley attestation, which demands high assurance,
That one deviation means you failed. You didn't hit 90%.
you failed the attestation objective. But finding that 66% confidence rating isn't just a failure flag. It's an actionable piece of data.
How so? How should a professional use that 66% number?
That 66% might still be enough to support some level of reliance for, say, internal risk mitigation. It tells management, look, this control is working, but it's only reliable about 2/3 of the time.
So you have quantifiable material weakness, but it hasn't totally collapsed.
Exactly. Without the SEAC analysis, the auditor would only know they failed to get 90% assurance. They wouldn't know the actual statistical extent of that failure.
So it allows for a more nuanced way to report control failures. It's not just a binary pass-fail.
Exactly. It provides crucial context for risk managers who are trying to decide if they need to immediately implement a compensating control or if they have time for remediation.
And beyond that post-test analysis, these tools are great for planning, for running those what-if scenarios.
That's the second huge benefit. Because the software does the math instantly, you can easily test the sensitivity of your sample size to different inputs.
Like, what if we decided a 5% tolerable rate is too strict and we're okay with 8%? How much work does that save me?
Or, we thought the population was 800, but now we think it's closer to 1,200. Does that significantly change the 43 items?
Being able to run those simulations is critical. It transforms sample size determination from a rigid rule into a dynamic, risk-based tool.
Okay, so we've covered the planning, the math, the technology. Now we get to the moment of truth, evaluating the results. After we've tested our 43 or 77 or 51 items, what are the clear, definitive pass-fail rules?
The rules link right back to the plan we set up. The test passes, meaning it achieves the planned level of reliance. If the number of deviations you find is either 0, when you plan for 0, or it's within that specified tolerable range, that number in parentheses from the tables.
That's your statistical boundary.
And conversely, the test fails if a deviation pops up when none were planned, or if the number of errors you find goes over that threshold.
And when that failure happens, the reliance plan has to change. You can't just wish it away. There's no middle ground on your plan assurance level.
So when a control test fails, what options does an auditor have?
There's a limited set of options, and it really depends on the scope of the engagement.
Option 1, probably the simplest, is to just reduce or eliminate reliance.
This is the direct consequence of a failure. If the control can't support the planned assurance, the auditor must increase their other testing, their substantive testing.
The detailed checking of balances and transactions.
Right. You shift your assurance strategy away from relying on the control and towards gathering direct evidence.
Okay, option 2 is critical, especially when an auditor has to formally attest to a control's effectiveness, and that is the decision to add additional items.
And this requires enormous professional discipline. You can't just do this casually. If you believe the failure was a fluke and the control is basically sound, you might expand the sample.
But the expansion can't be trivial. If you find one error in a sample of 45, you can't just test 5 more, see that they're okay, and call it a day.
No, the guidance is very strict on this. To retroactively get back to that 90% confidence level, the addition has to be substantial. The source suggests that if your initial sample was 45 items,
You would need to test an additional 45 items with 0 further deviations to statistically dilute that original failure.
and here is the absolute warning from the source material. Adding just a few extra items to the original sample is a meaningless statistical procedure. It does not support control effectiveness.
You're just fooling yourself at that point.
It is professional self-deception. It's what the source calls statistical triage, not an audit. You either commit to a full, statistically sound expansion, or you accept the failure.
I think that warning is so important because the pressure to pass a control, especially near a big reporting deadline, must be immense.
It is.
It's way easier to rationalize looking at 5 more items than it is to admit failure and test another 45.
The temptation is high, but the audit's validity rests on resisting it.
Okay, so option 3 is for when the failures are too widespread to ignore or patch over.
Remediate and retest.
Right.
If your testing finds multiple deviations, the first prudent step is always to double-check the test itself. Did the tester understand the control? Was it designed right?
But assuming the test was valid.
Then the immediate action is to recommend that management have the control remediated.
And remediation means?
It means fixing the root problem, redesigning the process, updating the software, or retraining the people who are supposed to be doing it. The control is broken, and it needs to be repaired.
And what's the consequence of that failure for the audit report for that period?
This is a crucial distinction. A remediated control can be successfully retested later on, which is good for management moving forward. But the failure during the original testing period precludes reliance on that control for financial reporting purposes in the period when it was ineffective. You can't say it was working all year if you found a high deviation rate in the middle of it.
The failure is a historical fact that has to be reported.
Right.
This all brings us to the ultimate caution, I think. This is the point where the math isn't enough and professional judgment really takes over.
The danger of qualitative deviations.
Right.
So far, we've just been talking about the quantity of errors, the incidence rate. But an auditor has to be incredibly careful about accepting a deviation, even if the number is within the plan, if that deviation has a qualitative characteristic that points to a much bigger problem.
And the source highlights 2 major ones: fraud and systematic errors.
Let's start with fraud. It's non-negotiable. If you find one single transaction that bypassed a control because of deliberate fraud, it doesn't matter what your sample size was or what your tolerable rate was.
That one qualitative deviation changes everything.
It shifts the entire focus of the audit. You're no longer measuring a deviation rate. You're now investigating the scope of fraudulent activity and the integrity of the people involved.
Because that one instance could be, as they say, the proverbial tip of the iceberg.
Absolutely. A clerical error is one thing. A control weakness that allows deliberate malicious behavior is something else entirely.
Okay, and the second major qualitative concern is systematic errors.
A systematic error is one that's likely to be repeated across the population under specific conditions. A classic example is a coding bug in an IT system that handles all transactions over a certain dollar amount.
So if the system fails for one $50,000 transaction, you happen to pick,
it will probably fail for all $50,000 transactions.
So even though you only found one error in your sample of 43, the nature of that error implies a 100% failure rate for a whole slice of the population.
Precisely. That one systematic error, qualitatively, is the same as finding dozens of random quantitative errors. It needs immediate remediation, not just an adjustment to your confidence level.
This discussion really puts to rest what the source calls the old concept of just excusing an isolated exception.
Oh, yeah.
Auditors used to spend hours trying to explain away the one error they found, calling it an anomaly so they could dismiss it.
That practice has largely, and thankfully, disappeared from reputable sampling, and for good reason.
Which is?
If you selected an unbiased representative sample, then the item you selected, even if it seems like a one-off or has a good story, the new employee forgot the sign-off.
It's still a representative exception.
It is. It represents the measurable incidence of failure in the population. Even if that new employee was retrained the next day and never made the mistake again, the deviation still happened in the population you sampled from.
And if you dismiss that one, you might be missing others with totally different causes.
Exactly. The core interest of an unbiased sample is the incidence of deviation, regardless of the story behind any single failure you find.
The message is clear. The math is crucial. But the judgment around these qualitative failures is what separates a good auditor from a great one.
It is. It's tempting to dismiss deviations to get a pass, but doing so just undermines the entire foundation of assurance.
Wow. Okay, this deep dive has really shown us how these high-stakes decisions in auditing are built on such a solid statistical foundation. We started with that simple zero-deviation formula, $1 is F2 tally.
Which is great for that quick planning, for setting expectations.
Then we moved into the reality of controls, that errors are going to happen. And we saw how tables let auditors precisely calculate sample sizes while building in a measurable tolerance.
And how that two-stage sampling gives you an economical way to deal with uncertainty.
And finally, We explored the incredible power of CIATs-like IDEA, which don't just calculate the sample size, they give you that crucial post-test analysis.
They show you exactly what assurance level you achieved when reality didn't quite meet your plan.
The key insight here for you, the learner, is that the numbers are there to guide your effort, but they absolutely do not replace your judgment.
The real value is knowing what to do when those numbers conflict with what you want it to happen. When to remediate, when to expand your test, and critically, when you have to refuse to place reliance on a control.
We saw in that IDEA example how finding just one error in a 43-item sample dropped confidence from a planned 90% all the way down to 66. And that's where the professional rubber meets the road. So here's something for you to mull over. The next time you look at a control test result, don't just ask if it passed. Ask yourself if you're truly willing to risk your reputation or your company's compliance on that 66% achieved assurance when you promised 90. Understanding that statistical difference, that's the real essence of professional judgment.
Until next time, keep digging deeper.
See you next time. Okay, let's unpack this. Welcome back to the Deep Dive. Today, we're tackling something that feels almost like the final frontier in corporate governance and assurance.
It really is.
We're asking, how do you gather reliable, auditable evidence about something as elusive as a company's ethical culture? It's one thing to sample a stack of invoices and, or test the mechanics of a financial reporting system. That's tangible.
Right, there's a clear population, you can pull a sample, it's methodical.
Exactly. But the real question we face now, and this is really driven by modern regulation, is how in the world do you quantify or measure or even sample integrity? How do you test the tone at the top?
And that's the core challenge, isn't it?
Our mission in this deep dive is based on your comprehensive notes, and it's all about this critical shift, not just for auditors, but for management's own responsibilities.
Yeah.
We're moving beyond those simple, substantive procedures on transactions to the really rigorous requirements for proving the effectiveness of internal controls. And specifically, we're diving into the more qualitative methods used to get this evidence.
Things like surveys, detailed inquiry, interviews, the human element.
Exactly, the human element. The context here, for public companies, it's non-negotiable. It's driven by Sarbanes-Oxley, but it also applies much more broadly now through updated AICPA risk standards.
So it's best practice for everyone, really.
It is. Relying on effective internal controls has become the central, most efficient way to conduct an audit, and this helps everyone. It benefits management, you get fewer surprises, better governance, and it lets auditors conduct a much more targeted, risk-focused engagement.
But none of that is even possible without rock-solid evidence that the controls that they actually work.
That's the bottom line.
It is. And what's so fascinating here is that this isn't just some, compliance exercise to check a box. It's a legal and a professional necessity. We are talking about critical evidential matter.
And the SEC has weighed in on this pretty heavily.
Oh, absolutely. The SEC, specifically in release number 33-8809, really nailed this down. They made it crystal clear that management's assertion about their control effectiveness has to be supported by, and I'm quoting here, evidential matter that provides reasonable support.
Reasonable support. So you can't just say, we think it's working.
No, not at all. This isn't just about noting that a control policy exists in a binder on a shelf. Management has to document the basis for their assessment. They have to detail the specific methods and procedures, the who, what, and when that they use to gather and evaluate that evidence.
Sounds like a much higher bar.
It's a regulatory hammer.
Yeah.
And it forces entities to confront these deeply difficult, sensitive issues that, frankly, were very easy to avoid or just sweep under the rug in the past. It raises the stakes for every single piece of information you collect, from a stray comment in a survey to, a nervous twitch in an interview.
So let's start right there with the uncomfortable reality of these qualitative assessments. The modern controls environment, it really demands that management and auditors engage in what your notes call difficult and sensitive inquiries. And we're not talking about, administrative questions about vacation policies. These are almost existential questions about the quality of the leadership itself.
Yes, you're getting right to the core of the control environment and the governance structure. For example, an assessment might have to determine if the CEO, the visionary, maybe the person who founded and built the entire company from scratch, is so overbearing and abrasive that his management style is actively interfering with effective governance.
And that would be a control risk.
A huge one. If that style discourages people from communicating deficiencies, if it poisons the whole environment, that's a material weakness.
Or On the financial side of things, you might have to assess if the controller, the number two finance person, is actually qualified to handle something really complex, like new revenue recognition standards or multi-jurisdictional tax compliance.
Right. And these aren't just competence issues anymore. They are failures of the control environment.
These conversations must be incredibly challenging professionally. So what happens if the auditor or the internal control manager just sidesteps them? I mean, who really wants to be the one to tell the founder of a billion-dollar company that his personality is a control deficiency?
The implications are massive. They're professional, they're legal. When a management style gets to the point of intimidation, when it creates a culture of fear, you create the possibility of management override of controls.
The ultimate risk.
It's the ultimate risk, and it's basically an unmitigable risk to the entire control environment. So if these governance and competence issues are sidestepped or ignored, that risk transfers directly to the entity, and just as importantly, to its external auditors.
So the auditors are on the hook.
Absolutely. The source notes are very clear on this. There have been cases, even litigation, where CPA firms were found liable because they failed to communicate serious control weakness issues they knew about, to the governance body like the audit committee.
Wow.
This new focus on responsible and ethical leadership, which is mandated by this need to prove the control environment works, has actually been credited with forcing top leadership changes in corporate offices.
Really?
Yes. Some leaders just realized their aggressive or, non-compliant styles simply would not survive this new level of independent scrutiny. They couldn't pass the tone at the top test.
That makes the whole process sound like a governance firewall.
Oh.
But okay, if we're assessing things like integrity, how do we generate formal auditable evidence? We already said you can't sample a batch of ethics.
Right, and that's the key distinction between testing control activities and testing the control environment. It's important to emphasize that sampling is the primary method for testing specific activities.
Like checking purchase orders.
Exactly. Confirming that, say, 50 out of 500 purchase orders were properly approved. But gathering evidence for the control environment, for the risk assessment process, for monitoring principles, that often doesn't involve statistical sampling because there just isn't a population of transactions to draw from.
So what do you do instead?
You have to rely on a spectrum of non-sampling methods. Let's take governance structure. How do we evidence the effectiveness of the board of directors?
Okay, good question.
We do it by thoroughly reading meeting minutes. And I don't mean just skimming for signatures. I mean analyzing the content, the depth of discussion, the questions that were asked.
And you also attend the meetings?
You attend meetings where you're permitted, and you observe the actual behavior and dynamics. Who speaks? Who gets listened to? Is dissent tolerated or is it shut down? And you have to review the board member qualifications. Are they truly independent? Do they have the necessary financial and operational expertise to challenge management?
So it's a combination of observation, inquiry, and document examination. It's less of a check-the-box exercise and more of a professional judgment based on multiple inputs.
Precisely.
But how do you make that kind of subjective observation auditable? How do you document it?
That is where documentation is key, and it ties into this. This ongoing, often overlooked evidence that's gathered daily by the project team or the audit team. I mean, we spend weeks, sometimes months on site. We are witnessing the environment firsthand.
Right. If you're a professional on the ground, you're constantly seeing how management interacts. The source notes mention that while keeping a full daily journal of every observation is, impractical and complete overkill.
Nobody has time for that.
No. But a summary paragraph of periodic observations documented contemporaneously by team members that can add considerable evidential weight.
Exactly. For instance, you might note an instance where a member of management, unprompted, questioned the lack of timely bank reconciliations in an email chain. That's direct, observable evidence of effective monitoring happening in real time.
And that reinforces what they might tell you later in a formal interview.
Perfectly. These pieces of informal yet documented evidence add texture and depth. They transform what could be a mechanical controls assessment into a truly informed professional judgment.
Okay, let's move to one of the more formalized tools for capturing this texture. Employee surveys. This seems to be the primary method we use to try and measure something as abstract as culture.
It is. Surveys are highly effective for collecting that documentary information you need to evaluate whether a company's culture and personnel policies actually foster an environment where controls can operate effectively.
And that's vital because, as we all know, A written code of conduct sitting on a shelf is pretty much useless if nobody follows it.
A company can post its code of conduct on every wall, but employee feedback is the only way to determine its actual operating effectiveness, not just its design effectiveness.
But I imagine the complexity here is in avoiding all the pitfalls that could make a survey worthless.
Yes. The reliability and validity can be destroyed pretty easily. When you're designing or evaluating a survey, you have to be acutely aware of these common problems.
What are some of the big ones?
First, just administrative overload. Questionnaires that are way too long or the formatting is just hard to read. That leads to response fatigue and people just start clicking anything.
Or they just don't finish.
Second, the language barrier. Using unclear, ambiguous language or what we call double-barreled questions.
Can you give an example of that?
Sure. A double-barreled question might be, are the training materials comprehensive and delivered in a timely fashion? Well, what if the materials are incredibly comprehensive, but they were delivered 6 months late?
The respondent can't answer that accurately.
They can't. The data is instantly invalid. Another simple failure is just asking the wrong person. If you poll a manufacturing floor technician about the efficacy of complex hedging derivative,
You're not going to get useful data.
you're going to get noise. They just lack the necessary information to answer, which makes their response misleading.
And then there's bias in how you frame the questions themselves.
A very serious pitfall. If questions are phrased to suggest or prompt a specific answer, you're essentially leading the witness. You completely defeat the purpose of an objective inquiry.
And finally, what's maybe the most telling problem of all?
The reluctance to provide written answers to sensitive questions. This is frequently a direct symptom of autocratic management and a corporate culture steeped in fear of reprisal.
So if you see a high drop-off rate or really evasive answers specifically on questions about, say, reporting wrongdoing,
That immediately tells you that the control environment itself, the culture, is broken. It doesn't matter how well that code of conduct is written.
the low response rate is the evidence of the control deficiency.
Exactly. Now, we should clarify the methods here. Even though we are using non-statistical sampling for these surveys, because we're assessing opinions, not transactions, the design should still incorporate some statistical concepts to maximize reliability.
Okay, like what?
First, quantity. Generally speaking, more respondents mean more reliable results. If it's feasible, the source suggests aiming for a significant proportion, maybe 5 to 10% of the total employee population, especially in a larger firm. That gives the data some real statistical weight.
And second, stratification, making sure the sample is truly representative.
Correct. Stratification means you systematically ensure your survey includes segments that reflect the organizational structure, different divisions, various geographical locations, and critically different levels, from top management all the way down to operational and administrative staff. The goal is a sample that lacks selection bias.
But let's clarify that. Representative doesn't necessarily mean you have to sample every single subgroup proportionally every single time.
That's a key point. A representative sample is one where selection bias is minimal and you can vary the focus over time. For example, maybe one year you focus heavily on a high-risk group, like a newly acquired international division or a segment known for high employee turnover.
And the next year you might focus on more established corporate segments.
Right. And this brings us to a point where we might overturn some traditional wisdom. The risk of knowingly excluding certain groups from your population.
What do you mean?
Well, if your engagement is primarily focused on testing controls over financial reporting, you might be tempted to only survey financial reporting personnel, the accounting staff, internal audit.
That seems logical on the surface.
It seems logical, but it is a profound mistake.
Okay, why is limiting the survey just to the finance people such a massive risk?
Because the operational and sales personnel often have the most valuable primary evidence about risks to financial reporting that the accounting department might never witness directly. They're on the front lines. They feel the pressure.
Give us a specific example.
Okay. Imagine the sales personnel consistently relate through the survey that management is applying excessive pressure to meet overly aggressive sales targets. What does that instantly flag for an auditor?
Revenue recognition issues.
Big time. It points directly to the risk of channel stuffing, where sales are recorded prematurely, maybe through complex bill and hold deals, just to hit a quarterly number. It signals potential period-end cutoff control failures.
And the accounting department would just see the final entry. They wouldn't see the pressure that created it.
Exactly. These insights are fundamental to a proper risk assessment, and they would be completely missed if you only surveyed the people who process the journal entries. The evidence isn't just about financial policies, it's about budget stress and management interference across the whole organization.
So the final piece is sufficiency. How do you know when you have enough responses?
Ultimately, that's a matter of professional judgment, and it's guided by control sampling guidance. But a low response rate is, in and of itself, evidence. It points to deficiency in employee engagement or internal communication. And when you do find exceptions, even if there are only a few, the need for further evidence is immediate.
So even one bad answer can be significant.
It can be. If even one disgruntled employee in a small sample makes a serious specific fraud accusation, that result requires a deep investigation. The source material actually gives a good example here. In a litigation scenario, an employee made an accusation. The company's audit committee was alerted, acted responsibly, hired independent forensic counsel, and ultimately concluded the accusation was baseless.
So the key was their response.
The responsible and documented handling of that situation neutralized the assertion that the company and its auditors were ignoring fraud risks. The response to the exception becomes the ultimate test of the control.
Let's talk about the mechanics of execution, starting with timing. This is always a challenge with control testing, isn't it?
It's a perpetual balancing act.
If you test too late in the year, you might find a deficiency, but you have no time left to fix it and retest before the deadline.
Right, but if you test too early, you run the risk that the results are stale by year-end and you have to update them or redo the work, which wastes precious time and budget.
And we also need to stress the administrative time commitment. Surveys are far from instantaneous.
Not at all. Even with full support from management, getting timely responses is difficult. People need time. You need time for follow-up reminders. And crucially, evaluating the open-ended written responses, which, by the way, often have the most valuable insights, is highly demanding for the analysis team.
So where does the biggest risk usually lie? Too early or too late?
Well, since the subject matter culture and personnel policies tends to change relatively slowly compared to, say, transaction processing, the source notes that the biggest risk is usually performing the tests too late.
Too late to allow management to implement a necessary correction before the period ends.
Exactly. If you identify a fundamental cultural flaw in December, you have very little hope of remediating it before year-end reporting.
But you can't just rely on old evidence forever. When do you need to resurvey or update your work?
Two main conditions trigger that. First, if the entity makes significant changes to its policies, or if they implement a specific corrective action to fix a known weakness, you have to test if the fix worked.
And the second?
The second is if other significant systemic events occur that could drastically alter employee perceptions.
Can you give an example of a systemic event like that?
A sudden, unanticipated mass layoff is a perfect example. That kind of shock immediately impacts morale, trust in management, and perceptions of ethical commitment. Any survey responses you gathered before that event happened would likely not reflect the post-layoff reality.
So you'd have to go back.
You'd have to update that evidence either with another sample survey or through observation or some targeted inquiry, specifically asking people if their perceptions have changed given the new context.
Okay, let's talk about quality control for the survey itself before it goes out. Pilot testing. How important is this?
It's absolutely essential. It's the quality control for your evidence gathering. It dramatically increases your final response rates and boosts the reliability of the answers.
And how detailed should this pilot test be?
It can be done in segments. You could test just the clarity of the instructions or the wording of one specific section to make sure it lands correctly. You're asking basic questions. Is this question clear? Can the person I'm sending it to actually answer it? Is there an option for them to clarify or give an example?
And you also have to test the tech.
Oh, you must test the administrative details. If you're using some complex online delivery system that needs unique logins or handles anonymous attachments, you have to test that entire technology flow. You don't want technical failures depressing your response rate.
So it doesn't have to be a huge formal process.
No, informal testing can be enough. Just showing the questions to a few prospective representative respondents and asking them to talk you through their thought process as they answer. That can be incredibly revealing.
So what are the red flags you're looking for in those pilot results that tell you the survey is flawed?
The indicators are usually pretty obvious if you're looking for them. A high rate of people just not answering certain questions, especially sensitive ones. Or seeing multiple conflicting types of answers to the same question. That signals deep ambiguity in the wording.
And what's the biggest indicator of trouble?
comments written in the margins or in the optional comment box. That usually means the respondent found the available choices incomplete, or the question was fundamentally confusing or misframed for their situation.
This all leads directly to the analysis phase. You have to plan in advance how you're going to analyze the data and what specific criteria will determine success or failure.
This is where the rigor often fails. The source material has a perfect example of this failure. Imagine a team submits a report to management that says something like this. We sent a survey to 750 employees, 400 were returned.
Okay, so a 53% response rate.
Right. Then it says, approximately 60% of those who responded were not even aware the company has a code of conduct. Only 15% had ever read it.
Wow, that's a huge exception rate.
Huge. But then it says, however, 80% of those who did read it agreed the code helps identify unacceptable business practices. And the final conclusion states that, as written, the code could contribute toward creating a control environment.
Wait, hold on. If 60% of the respondents don't even know the code exists, how can the conclusion possibly be that it could contribute to effectiveness? That conclusion feels like it was written before the survey even went out.
Precisely. That is a fundamental failure of setting criteria in advance. Potential effectiveness is not effectiveness. With a low response rate and an exceptionally high exception rate on awareness, you simply cannot conclude that the control is implemented effectively.
But you need to set the bar beforehand.
Yes. When designing the survey, management, and any auditor reviewing it must establish advanced criteria. Something like, at least 75% of respondents must acknowledge awareness of the code of conduct for the control to be considered effective. Without that, you end up with a confusing, unsupported conclusion that fails that reasonable support test from the SEC.
Okay, let's get into the craftsmanship of writing the questions themselves. Standardized vendor questionnaires rarely fit a company perfectly, so customization is key.
It's critical.
Your notes draw on advice from survey methodologists like Arlene Fink. It starts with making sure every question is meaningful.
Yes. For example, if you ask demographic questions, say about department or seniority, which might seem disconnected from an ethics inquiry, you have to explain why you are asking. Otherwise, people suspect some hidden bias or they just disengage.
Then there's the language, using standard English and avoiding jargon.
Strictly avoiding it. This survey is going out across the entire organization, not just to the accounting department. Jargon like entity-level controls, CARO-S principles, or technical fraud terms like kiting or skimming, those are not understood by operations staff and should be avoided entirely.
The advice on concreteness seems like the most actionable tool for generating real evidence.
It is. You have to make the question personal and concrete, drawing on the respondent's direct lived experience.
So you contrast the abstract question, do you believe management acts ethically, with something much more concrete?
Exactly. You ask, has your supervisor ever asked you to take action that appears unacceptable under the company's code of conduct? Or even better, have you ever been asked to take action that just made you feel personally uncomfortable regardless of company policy?
That specificity gets you real, actionable data points.
It does. And you also have to watch out for biased words, loaded phrases, and questions that are based on an incorrect premise.
This is where we get the classic analogy of the loaded question.
Yes. We have to explain the logical fallacy here. A loaded question contains an assumption that the respondent is forced to accept just to answer. It's asking for detail about a scenario that the respondent denies ever happened.
So it traps them into confirming a false premise.
It does. It
Yeah.
just boggles the mind and completely destroys the integrity of the data you're trying to collect.
And always, always enforce the single thought rule, one core idea per question.
Absolutely. The example we saw was, are the activities of the company's employees and board of directors consistent with the company's ethical values? Well, if I think the board is great but the employees are cutting corners, I can't answer that.
It's structurally confusing.
You have to split it into two separate questions to maintain any kind of data fidelity.
Now, there's some really counterintuitive research on framing, on negative wording. This feels like it goes against everything we just said about avoiding bias.
It does, but it's fascinating.
Yeah.
While Survey Design 101 teaches us to be neutral, some specialized research suggests that using negative wording can sometimes enhance a person's specific recall and force deeper cognitive processing.
Why would asking a question negatively generate better data? That seems so odd.
The research involved experienced auditors evaluating risks in companies they audited. When the questions focused directly on risks in a negative frame, for example, asking if there are instances of management ignoring control deficiencies, those questions were more effective in getting specific recall of engagement facts than neutral or positive questions were.
So, more effective than asking, does management respond appropriately to control deficiencies?
Exactly. The theory is that if you only ask positively framed questions, people can go on autopilot, just checking yes, agree, agree. But if you insert a pointed, negative framed question, it forces them to stop, critically assess their memory, and look for exceptions. It shakes them out of that mechanical responding.
So it's about varying the structure to keep them engaged.
Precisely. It avoids the bias that's inherent in having every single question framed identically. And as a result, some major CPA firms have adopted a mix of these more pointed, sometimes negatively framed questions in their tools.
Which just brings us back to the main point on customization.
It all comes back to that. Standardized questionnaires from vendors have to be thoroughly reviewed and customized, asking detailed questions about inventory control in a highly specialized service business. It's irrelevant, it leads to confusion, and it tanks your response rate. You have to tailor the tools.
Okay, let's transition to the art and science of the interview.
Yeah.
This is fundamentally different from a survey. It's a personal, dynamic exchange.
It is, and it's designed to deepen your understanding and corroborate the documentary evidence you've already gathered.
I think it's vital to clarify the purpose of an interview right up front. It is designed to gather reliable information, full stop. It is not designed to trip up the respondent or trigger a confession.
Yes. Anyone doing these procedures has to avoid modeling their technique after some aggressive TV news interrogation. That just risks alienating the respondent and shutting down the flow of information completely.
So what are the core uses of interviews in this controls context?
They're critical in a few areas. They're used to get that foundational understanding of processes, your classic walkthroughs. They are essential for gathering evidence for all 5 components of internal control. And critically, they are the primary tool for gaining consensus and gathering evidence on the overall control environment.
Especially things like tone at the top and how ethics policies work in practice.
Exactly. And we have to highlight the most critical area of all, management override. An AICPA study specifically called Management Override Senior Staff Bypassing Established Controls for Personal Gain or to Cook the Books, the Achilles heel of fraud prevention.
And interviews are the best way to probe for that.
Often the only way to probe for evidence that controls are being bypassed by those with the authority to do so.
Now, as an interviewer, you're not just a stenographer transcribing answers. You're observing the entire communication dynamic. This is where the skill level really elevates.
It elevates dramatically. An astute interviewer gathers far more than just the verbal answers. Nonverbal cues are often the most reliable evidence of underlying discomfort or even deceit.
What are some key indicators?
The respondent avoiding a clear, direct question, offering unclear, rambling responses that are designed to deflect, or exhibiting physical clues to stress, shifting posture, changing breathing patterns, avoiding eye contact. These cues signal that you need to follow up and investigate further.
There's a fascinating study from the Institute of Internal Auditors, the IIA, that quantifies just how much we miss if we only focus on the words.
It's a stunning statistic. They concluded that only 7% of a message communicated in an interview is conveyed through what is said, the actual verbal content.
Wait, only 7%?
That's
astonishing. If the actual words are less than a tenth of the message, we're missing 93% of the communication if all we do is take notes on the transcript.
That is the cold, hard data. 38% of the message is conveyed by word emphasis and tone. How they say it, the emotional inflection, the hesitations, the pauses that imply nervousness or fabrication.
And the other 55%?
The vast majority, 55%, is conveyed through nonverbal cues. Body language, facial expressions, overall demeanor. If an auditor's entire focus is just on transcribing that 7% of the message, they are failing the due diligence required to gather sufficient evidence. It completely elevates the skill and resource requirement for the interviewer.
That means we can't just train someone on a list of questions. We have to train them on psychology, on communication, on emotional intelligence.
Exactly. And that training has to include cultural context. You have to understand that corporate and country cultures dramatically impact how questions are answered and how nonverbal cues are interpreted.
Can you give an example?
The source gives the classic one. A head movement that might ordinarily mean disagreement, shaking the head in some cultures means I agree or I am listening. If you're unaware of that, you will fundamentally misinterpret the interview and draw a flawed conclusion.
And corporate culture matters too.
Immensely. Some companies have a relaxed, conversational atmosphere. Others are highly formal and memo-driven, where employees are reluctant to speak outside of established protective channels. These factors dictate the level of transparency you're going to get.
Let's translate this holistic view of communication into practical strategy. Planning is essential. And crucially, the interview has to be conducted by the right person. You can't put a new junior accountant in a room with the chief financial officer and expect a good outcome. It's a recipe for disaster.
The interviewer needs sufficient stature. They need the knowledge, the experience, the professional confidence to elicit thoughtful responses and to follow up effectively when sensitive points come up. For extremely complex issues, sometimes bringing in an experienced third-party interviewer can actually help, adding a layer of neutrality.
And what about the execution of the interview itself, the strategy there?
The process has to be designed to build comfort and establish rapport, not anxiety. A highly effective strategy is to start with non-threatening, factual questions to put the respondent at ease.
Like what?
How long have you been with the company? Can you walk me through your daily responsibilities? You establish a baseline of their normal communication style and demeanor before you dive into the high-stakes control questions.
And then you mix in the open-ended or opinion questions.
Right, you have to be prepared to restate or clarify questions. But here's a critical skill. You have to be firm and avoid being led into asking a different question if the respondent is clearly evading the original one. An apparent inability to understand a clear question often just means they prefer not to answer it.
And making it personal is key.
Very key. Instead of asking, how would the company handle a fraud allegation? You ask, have you ever become aware of an instance where a policy was bypassed? People find it much easier to speak for themselves and their own experiences.
Now, despite all the planning, you're going to encounter the unexpected. Surprising information, maybe even an outright accusation. The source calls this the blunderbuss risk. The instinct is to chase that new hot lead immediately, but that's often the wrong move.
That is the crucial warning. Do not play detective. The professional judgment call is whether the new information is so urgent that it warrants immediate follow-up. But the default guidance has to be, remember your main purpose, complete the planned interview, and then immediately relay the surprise information to your supervisors or the audit committee.
Why is that so important?
Because a bumbling investigation conducted by someone not trained in forensic techniques risks tipping off the perpetrator. That gives them time to destroy evidence that could have been vital if a careful, legally sound investigation had been conducted by trained experts.
So your job is to gather and report, not to investigate and confront. Protect the chain of evidence.
Exactly. And related to that is your note-taking strategy. Aggressive note-taking, scribbling furiously, or typing on a laptop is highly distracting. It's unnerving for the respondent, and it kills your ability to capture those 93% of nonverbal and tonal cues.
So what's the advice?
It's highly practical. Use short keyword notes on a small pad, and then schedule a buffer period immediately after the interview, 5 or 10 minutes, to flesh out the details, including your observations on demeanor, while your memory is absolutely fresh. If you wait until the end of the day, you will lose crucial subtleties.
How do experienced interviewers confirm the reliability of what they're hearing during the conversation itself?
By using corroboration and consistency checks. An experienced interviewer might ask a similar question, not identical because that's annoying, but a similar one later in the conversation, maybe framed differently, to ensure they get consistent answers on important issues. If the respondent's story changes, that's a red flag.
Okay, let's look at how the required scope of all this inquiry changes based on context. The source contrasts two very different companies.
This really shows how professional judgment impacts the work. So consider Company A, a massive public company, 5,000 employees, and they're legally required to make a formal assertion about their internal controls under SOX 404.
So the stakes are very high.
The highest. The testing has to be extensive. A detailed review of the code of conduct, testing HR records, maybe 30 high-level interviews, and a company-wide email survey covering a significant sample. The auditor needs a mountain of evidence to support that public assertion.
Now contrast that with Company B, a small private company, only 20 employees. They have a stable staff, they're profitable, and they recently drafted and circulated a new ethics policy. The auditor only places some, but not high reliance on their internal controls.
For Company B, the scope is logically much more limited, but it's still sufficient for that lower reliance level. They don't have the public reporting mandate. So evidence gathering might just be reviewing the minutes of the all-hands meeting where the policy was discussed, observing the policy is posted prominently, and then selecting, say, 2 employees, 10% of the staff, plus 1 manager for an interview.
So the key takeaway is that the degree of evidence required is directly proportional to the reliance you're placing on the internal controls.
That's it, exactly.
And finally, we have to reiterate the protocol for what to do if you have a serious fraud suspicion.
Yes. If you encounter a strong suspicion of fraud or direct objective evidence of it, communication has to happen immediately. And it has to go to a level above the suspected person. That usually means the audit committee or the board.
And get legal involved.
Legal counsel must be consulted immediately. Your average CPA firm staff are not trained as forensic fraud examiners, and any improper action on their part could compromise a future legal case. Management or the board should engage independent, trained forensic investigators right away to secure the evidence properly.
Okay, let's apply all these principles by looking at some specific sample questions structured around the COSO framework. The questions in the source notes are designed to be objective, focusing on actions, not just opinions.
Right, to facilitate a non-threatening discussion. Let's start with Principle 1, commitment to integrity and ethics. You want to begin with objective questions to establish a foundation. For example, what was the documented process you followed to develop the company's code of conduct? Or how often is the code reviewed, and what triggers those revisions? You're establishing process discipline.
And only once you've established that process do you move to the more sensitive inquiries that really measure the tone at the top.
Correct. Then you can ask something like, has the board identified any compensation policies or other incentives that might motivate unethical behavior or excessive risk-taking, like aggressive sales bonuses? This forces management to explicitly link their control environment to potential pressure points.
And the follow-up is critical.
Absolutely. If they say, yes, we have, you have to ask what they are and how they are monitored. If the response is no, we haven't identified any, you must follow up by asking what formal risk assessment process they use when setting incentive policies. You are always probing for documented, deliberate process, not just a vague assurance.
Next up, Principle 8, assessing fraud risk. This is the deep dive into the practicalities of fraud inquiry, which is a required procedure for every single audit.
And the questions here need to be targeted and systematic.
So the first step is identifying organizational vulnerability.
Right. You ask, in what specific ways is this entity vulnerable to fraud? You force management to think about the 3 main buckets: employee defalcation or theft, fraudulent financial reporting, and outright asset theft.
Then you move to process clarity.
Exactly. Is there a documented, communicated process that is followed if a fraud is alleged or suspected by an employee? This clarifies who gets involved, when the audit committee is alerted, and how confidentiality is handled. You're looking for a structured protocol.
And finally, the mitigation steps.
What controls does management actually implement to mitigate these risks? You ask about specifics: hiring policies, mandatory training, investigation protocols, disciplinary actions. You have to look for tangible tools, anonymous hotlines, formal whistleblower protection policies, the use of certified fraud examiners. The absence of these systematic controls is a big red flag.
Now let's explore the depth required for the most judgmental areas of financial reporting. Principle 12, deploying controls over estimates.
This is a huge risk area. Bad debt reserves, warranty liabilities, goodwill impairment, they all rely heavily on management judgment, which is fertile ground for bias and override.
So the first question has to be about structure.
Is the estimation process formal or informal? If they say it's informal, that is a massive red flag. Then you probe the inputs. How is the information and the underlying assumptions for this estimate gathered? And critically, how do you systematically verify that the information you're using is reliable?
Because inquiry alone is weak evidence. You need the support.
Always. You must demand the documentary support. If they use historical data to forecast credit losses, what controls ensure that historical data wasn't manipulated to get a desired outcome?
And what if they use outside experts, like for an actuarial estimate?
Then you have to probe the controls over those external resources. What formal controls ensure the competence, objectivity, and independence of the outside experts you're using? And finally, you have to ascertain oversight. How are senior management and the board involved in the formal review and approval of these significant estimates? For high-risk areas, the tone at the top has to translate into visible, documented challenge of the assumptions.
The final area we need to cover is monitoring Principles 16 and 17, which really closes the loop on control continuity. How do you know controls stay effective and don't degrade over time?
The questions here have to focus on continuity and proactivity. Management needs to identify specific benchmarks or KPIs they use to assess control effectiveness on an ongoing basis. You should ask, are there specific metrics you use, like error rates or turnover in a key department, that help you assess the continuity of certain controls?
And then you hit them with what you call the weakest link question.
Right. You force them to think continuously. How would you be alerted if a key control became ineffective other than during your scheduled periodic internal audit review? If they can only be alerted during an annual or quarterly check, their monitoring is reactive, not continuous.
And once a deficiency is identified, what's the protocol for fixing it?
You ask, how are control deficiencies communicated, prioritized, and demonstrably resolved? You want to see the evidence of follow-through remediation plans, retesting to ensure the entire monitoring process is robust and complete.
So to reiterate the golden rule of this entire process, inquiry alone is weak evidence.
It is the weakest form of evidence. When you're discussing any of these principles, ethics, fraud or risk, monitoring, you must always ask for specific, verifiable examples. Can you think of a recent example where this process worked? And ask for objective documentation to support the claims being made. The evidence spectrum always requires corroboration to turn a verbal assertion into reasonable support.
We have completed a pretty comprehensive unpacking of these essential tool surveys, interviews, detailed observation, that are used to transform the theoretical concept of internal control into verifiable, auditable evidence.
Evidence that's mandated by regulators and professional standards alike.
We've covered everything from navigating those sensitive inquiries with potentially abrasive executives to the counterintuitive psychology of using negative questioning to enhance recall.
And the critical need for that immediate post-interview note-taking buffer to make sure you capture the accuracy of both the verbal and nonverbal evidence.
It's clear that this shift in audit practice requires a true multidisciplinary approach. You're blending statistical concepts with crucial communication awareness.
Especially that profound finding that over 90% of a critical message is conveyed through tone and nonverbal cues, not just the words. This mandates a level of professional expertise far beyond basic accounting knowledge.
And this raises a really important final question.
It does. Given this heavy reliance on subjective evidence, on management's demeanor, on nonverbal cues, and considering the deep-seated difficulty, which is rooted in tradition and fear, of questioning authority figures in certain country and corporate cultures, what are the inherent, unavoidable limitations in truly determining the tone at the top for a globally distributed entity?
How far can these procedures really go?
Exactly. How far can these rigorous evidence-gathering procedures truly pierce the veil of cultural deference and self-reporting when trust and candor are, themselves, culturally conditional? It's a challenge that, even with the best tools, requires auditors to approach all evidence with perpetual skepticism and judgment.
A truly challenging thought to mull over as you deploy these demanding inquiry procedures. Thank you for diving deep with us.